We're breaking down key themes for you, the investor, to watch as the new year begins. 2025 was a year filled with volatility triggered by fiscal and monetary policy uncertainty and the concentration of market gains in tech tied to artificial intelligence. Many of the trends this year will carry over into 2026, and we have expert analysis and insight so you can prepare your portfolio. We've got you covered from stocks to bonds to crypto and more. Let's jump right in. One of the key hurdles for the economy toward the end of 2025, a record government shutdown. Not only did it affect growth, but also delayed or prevented the collection of key economic data. On the heels of the November jobs report, Julie Hyman sat down with RSM chief economist Joe Brusuelas and Academy Securities' Peter Cheer and asked them about their key drivers of economic growth.
Yes, I think strategically, our main thesis on the positive side is what we're calling ProSec, or production for security. So again, I think this does dovetail a little bit with Joe saying is that we are going to produce a lot more domestically where there is a national security interest. You saw some of that come out of the national security paper 2 weeks ago. And I think it's going to affect chips. It's going to affect data centers and AI where there's going to be help. It's really going to focus on electricity. I think electricity is becoming a far bigger election issue than the price of oil or gasoline. It's electricity. People are focused on it in and around the data centers, but away from that. And then I think you're also going to see this real focus on the rare earths and critical minerals, not just the extracted versions, but the processing and refining of them. So that's going to be kind of the growth side of it. I think you're going to see some states embrace deregulation and things that allow those businesses to grow. And I think you're going to see some states fight this. So you're going to see a little bit economy there. Away from that, I think tariffs are finally starting to have a little bit of a bite. I'm not seeing companies being very energetic in their spending and growth forecast for next year. So I think if the AI data center stuff slows, and I expect it to start slowing, you're going to see a drag on the economy. And I think that's what's going to force the Fed's hand. And a lot of these things, especially the tariffs, they take time to play out. We're now probably about $250 billion of tariff revenue collected. That is starting to have a meaningful impact to earnings potential, and it's going to start probably spreading its way to the consumer a little bit. So that's why I'm overall bearish with that ProSec, or production for security, is where I'm trying to invest heavily.
And Joe, on the flip side, you and I were talking during the break, and you are looking at this stimulus that's going to be coming into the economy as a result of the tax cuts. How much is that going to be able to offset some of the risks that Peter's talking about?
Well, you're going to get a pretty big and fresh injection of cash in the first half of 2026. Look, you've got pretty big tax cuts that are tilted towards the upper end households. You've got full retroactive expensing to January 19th of this year, right? You've got deregulation. I mean, I don't know if you guys have noticed, we're kicking the tires and lighting the fires on a pretty big credit expansion, right? Especially in private credit. The banks are going to join the party next year, right? And then you're going to get I think 2 rate cuts next year, right? As we normalize down to down to 3%. Mm-hmm. So I'm expecting at least $55 billion, perhaps closer to 60, right away as these tax withholding tables are adjusted. Then closer to 70 billion in corporates. So you're going to get a pretty big injection of cash here.
But how is that cash going to then be dispersed? In other words, by the entities that are getting it? I mean, also, if you say the tax cuts are weighted towards the highest income households, that doesn't help with our K-shaped affordability crisis situation.
That's not going away.
Right?
Yeah.
And do the companies use that cash to hire people, or do they use it to spend more on compute?
Well, they may actually invest in the companies in productivity enhancing investment, which is good for the real economy. The way I look at it is we've had 3 big shocks this year to the economy: trade shock, immigration controls, and then the government shutdown. This is 2025 ended up being a lost year. We're going to finish up probably 1 to 1.5% growth year over year. But I think that the dynamic properties inside the tax bill should facilitate 2.3 to 2.5% growth next year. Now, in a $30 trillion economy, that's a big move.
So
right?
I got to bring Peter back on this because, what do you think about the stimulus, the tax stimulus that's going to be coming in, and what effect that could have?
I think it definitely helps. Again, the question is, do companies really have the confidence in this economy to grow and spend on plant, property, equipment? Will they do much? Have they already questioning how much they're spending on AI? Will they take this as a buffer that last year maybe they had to loosen up some of their coffers to fill that. So I see the money coming in. I'm less convinced that, drags through, especially to the markets, right? Again, the economy and the markets have diverged a lot, right? This year we had kind of this jobless economy, and yet we had stocks do extremely well, especially since Liberation Day. So I could easily see a bit of a reversal of that, where you see the markets come down a little bit, the markets be a little bit nervous, while maybe the overall economy hums along okay. And I kind of refuse to call it the K-shaped economy. I really think we've shifted into what I call the little I-shaped economy, where you have this little dot that's doing extremely well, and the rest of the economy, the big stick, is kind of okay at best. So I think it's slightly more, isolated who's doing well. So again, I don't know that you see quite as much follow through to the broad economy. I think it will help smaller and mid-sized companies better because they bore the brunt of a lot of the problems this year. But I don't think it's going to be enough to be great for stocks next year. Yeah,
that kind of speaks to the firestorm, I guess, that Mike Green of Simplify ignited when he said the real poverty line for a family of four is $140,000, which speaks to the littleness of the I and the bigness of the rest of everybody else potentially. There's one more thing I want to ask you about, Peter, and that is the Bank of America December Fund Manager Survey, which was the most bullish in 3.5 years. And it feels like once again here that we are the vibes are not matching what's happening, right? Like the market, to your point, the market seems great, or the vibes seem great among fund managers, and yet there's this disconnect with how people in the real economy are feeling.
Well, also, that's always the danger, is right? Once everyone's kind of all in, any hiccup results in pretty heavy selling. You saw last week a couple companies, in the tech sector had small misses. You read the report, they didn't seem that bad, and yet the stock was down 10% that day, dragging it down. So I think this is, everyone's kind of all in. Everyone wanted to show they had as much exposure to some of these sectors that had been doing well. So it doesn't take much of a question mark to bring these down. And I think what we're going to see is, at least from some of the tech companies, it's not going to be a full-on debt diet. They're not necessarily going to, cut their spending plans, but I think they're going to have to be much more careful and not say, hey, we're going to spend at all costs. We went through, say, a year ago where if you said you were spending 10 billion, boom, your stock went up 20 billion, roughly, right? So you had almost free money. That has now changed. People are checking that spending. There is concern in the private credit market. There is some concern in the public credit market about the amount of money coming in, not just to fund the data centers and AI, but as Joe pointed out, it's going to be how do we fund the energy production and the electricity production more specifically to get those. So I think there's a bunch of headwinds, and that has been such a strong leader that's why I just don't think these markets can really go higher until we see some selling, get people back to maybe a little bit of nervousness.
Up next on Outlook 2026, a closer look at the bond market and what to expect from Washington when it comes to crypto regulation. The U.S. economy is entering the new year with notes of uncertainty drawn up throughout 2025, mixed signals on the state of the labor market, concerns of an AI market bubble, and the murky path for interest rates all carrying into 2026. So what could be ahead for the economy? Mohamed El-Erian, Chief Economic Advisor at Alliance, details it all with Yahoo Finance's Julie Hyman.
So let's take the AI-fueled productivity first. It doesn't feel like we're there yet. And so I wonder, do you think that does start to really take hold in 2026? Is it the later part of 2026? And sort of what does that look like? How do we see that unfolding?
I do see it taking hold. So right now we're obsessed with those working on AI. Gemini 3, how wonderful it is. Oh no, wait, OpenAI is going to come up with something. Yeah. It's all about those working on AI. We haven't focused enough on those working with AI, the adoption issue. We don't have an adoption policy. It's not hard actually to put in place an adoption policy. If you freeze those working on AI where they are and you simply implement throughout the economy what they have achieved, you have a major productivity growth. That is only in AI. What about robotics? That is coming down the pike in an important way. So I certainly think that we will see it play out over a number of years. There is a possibility, not a probability, a possibility that it could be accelerated, but that requires corporate America to really increase their adoption rate.
Are you using it? And which model are you using? Do you have a favorite one?
So I use it all the time.
Okay.
I use Gemini. Mm-hmm. I think it's incredible what it does.
Like, what do you use it for? I'm just curious. I mean, I use it when I'm doing research for interviews, for example. I've been using Gemini also So how do you use it?
So I use it for that.
Yeah.
I use it for checking what I write. I use it for looking at slides I use when I teach and ask the simple question, how do I make this more engaging? I use it for a whole range of things, and it has really increased my productivity. It also increases the time I spend on it because I get very intrigued by certain things. But it's incredibly powerful. I generate images, and you'll see, if you look at my weekly, you'll see the image generated. Underneath I put generated by AI.
Right.
And I simply say, when I read a long report, just to make sure I don't miss anything, I say, summarize the main points. So I use it all the time, and I find Gemini 3.0 incredibly powerful.
Yeah, like I say, I've been using that one too. So, okay, so that's the one side of it. Let's talk a little bit more about Treasury supply, the bond market, because we've already seen little glimmers of that, right? At a time when the Fed is cutting, very unusually, 10-year and 30-year yields are going up. So is that a sign of things to come next year, that we could see more of that phenomenon in the bond market, especially with more Treasury supply coming to market?
So there's tremendous supply from the public sector and from the private sector. Data centers now alone are going at a rate of 150 to 175 billion a year in terms of debt issuance. That is big. Then you have a 6% of GDP deficit. That's big for this part of the cycle. What I worry about is at some stage the bond market is going to say, you know what, we're not pricing in risk the way we should be pricing in risk. That is part of the downside scenario we talked about, is that the bond market's appetite, which has been incredibly strong, somehow becomes less so.
And where do you put that probability?
So I have, and that's not going to satisfy you, I have a 50% probability for the central scenario, and about 25% for each side. Okay. And the big message of this, whether you're a policymaker, whether you are a market participant, whether you are a CEO, don't fall in love with your central scenario. Just recognize that it's a multimodal distribution, and you've got to pay attention to the tails. And you've got to ask yourself, which tail can I navigate better?
Yeah, I mean, that's a good lesson over the past few years. Don't get too wedded to that central scenario.
2025 was the year of crypto as adoption went mainstream and Bitcoin hit an all-time high above $120,000. Crucial catalyst for the industry, the regulatory backdrop, and there is more optimism ahead. Here's what Coinbase Chief Legal Officer Paul Grewal told me on where things stand, where crypto meets Washington.
The Senate is considering their version of the Clarity Act. And what the Clarity Act, which passed the House earlier this year, would provide for the first time is a true market structure for crypto here in the United States. Now, earlier in the year, Congress passed and the president signed a bill regarding stablecoins, which is an important first step in providing clarity and certainty under the law for crypto and digital assets. But it's really time, it's essential that Congress finish the job. And that's what it will do when the Senate finally passes market structure legislation in short order and the president signs it.
Paul, you mentioned stablecoins there. Now, Brian Armstrong also did talk about that. He said banks are exploring stablecoins after Congress passed the Genius Act. I'm curious, Paul, what does that mean, do you think, for the adoption curve?
Well, there's no question that traditional financial institutions, including banks, now understand very well the power and the potential of stablecoins to bring transformation to the financial services industry. And what it will mean, of course, is greater adoption, greater utilization, and improved efficiency throughout the financial system. We are pleased to see banks finally wake up to the realization that it's time for innovation in the way we move money around on the internet, and we're delighted to have them as partners in this space and look forward to their full participation.
Now, Paul, it wasn't just Brian Armstrong, your colleague at Deal, but we had Larry Fink there too. There's another big name. He said Bitcoin, that was interesting, he said Bitcoin remains heavily influenced, Mr. Fink says, by leverage players. And I'm curious what you make of that, Paul. I mean, how much risk does leverage sort of still pose here? And how does Coinbase mitigate that?
Well, Coinbase has provided access to Bitcoin for millions of Americans, really going back to the earliest days of crypto. But it's a market like any other market that evolves with time, and it's natural to expect that individuals who may have been less familiar or even less comfortable custodying their own Bitcoin and holding it in their own wallets would want to rely upon intermediaries of all types in order to fully participate and finally participate in this market. We are seeing leverage and additional intermediaries relying upon leverage introduce new options for consumers to participate in the Bitcoin revolution. And that, of course, will require there to be new standards, new requirements, and new safeguards put in place. But we think that the market structure legislation is key to facilitating that. It will define for the first time which assets are subject to the securities laws of the U.S. and which assets fall outside of those laws. And we think that concerns regarding leverage and many others are best addressed by Congress and the agencies charged with writing rules once Congress acts.
Coming up, we hear from one expert on what America's corporate leaders are getting ready for in 2026. That's next. Tariffs, trade policy, and geopolitics move markets in 2025. Yahoo Finance's Julie Hyman spoke with EY Global's Courtney Rickard-McCaffrey about what's the top of corporate America's mind for 2026.
Certainly, almost every client conversation I had this year really did revolve around tariffs, which ones were likely to be enforced, how the outlook would proceed from here. And I think, unfortunately, the message for 2026 is that uncertainty around tariff policies remains. It may be a little less volatile than what we saw in 2025, but we do expect not only tariffs, but also export controls and other sorts of trade restrictions and incentives to continue to be introduced by various countries throughout the year. We could see new trade deals as well. So I think, in terms of how CEOs need to plan for these things, I do think we'll see continued volatility around specific product rates, as you were just mentioning, as well as rates for specific countries as well.
And so how do executives then, I guess they've had some practice this year, they've gotten some practice, but how do they go about tackling that when it is so volatile?
Yeah, absolutely. And thankfully they have built up those muscles this year, so they will certainly need to continue to exercise them in 2026. What we've seen is not only in terms of tariffs, but also, other types of geopolitical risks that are unpredictable in the current environment. We're seeing a lot more companies turn to tools like scenario planning. 66% of the 66% of the companies that are best at managing geopolitical risk use scenarios to set their strategy and to test their strategy. So I think that will continue to be a key tool in the toolkit going forward.
And I think one of the other things you highlight that's really interesting that's related to tariffs, because tariffs have been used as a tool in this way, is scarcity of various resources, whether those resources are critical minerals, which have been at the center of some of the tariff and trade back and forth, or talking about things like water as well, which has become, it's not only vital for life, but also has become important for things like data centers and cooling in some cases. So how is all of that going to play out, and what do people need to pay attention to?
Yeah, absolutely. So we do see geopolitical competition for either the continued control of those resources or for greater access to those resources really being a key story in 2026, and will drive a lot of the policies from governments, as well as a lot of the implications for companies, both in terms of risks as well as opportunities to expand in certain areas. So certainly freshwater. You mentioned critical minerals. Both of those are really key to data centers, to electricity production. So those are two really critical types of resources that we see governments that will really ramp up their competition in that area. And we could see some going it alone, others trying to reach out to allies and partners to really build those critical supply chains.
Now, here in the U.S., Courtney, looking at another one of the things that you're watching, here in the U.S., rates are trending lower, but we've not necessarily seen rates in the market trend lower. And what is happening with the borrowing cost atmosphere and environment around the globe, and what should we be watching for in 2026 there?
Yeah, absolutely. This is another one of those scarce resources broadly defined that we point to in terms of capital. So what we're seeing is a lot of geopolitical competition around access to capital and the growing politicization of capital allocation within different economies around the world. So we think this will really continue to reshape or refine the global financial system. So, there's, sovereign debt issuance is at an all-time high. Debt servicing costs do continue to grow, though, and so we could see some fiscal pressures in certain countries. And how this sort of plays out in terms of the private sector's access to capital and the cost of capital, I think remains to be seen, but bears watching closely as the year progresses.
Courtney, as you know, AI has been like the theme of this year. What are you watching with reference from your perspective? What's important about AI next year?
Yeah, absolutely. I think the buzzword this year has certainly been sovereign AI, and I expect that to continue next year. So we are seeing governments around the world really trying to accelerate the development of AI value chains and algorithms within their own economies, because that is seen as critical to economic security and national security going forward. So we'll see governments really focus across the AI value chain. It's not just about those algorithms, it's also about the critical minerals that go into the semiconductors that power the data centers. And of course, data itself is a critical resource as well.
Eric, I'm going to start with you here. It has been a heck of a year for markets. No pressure, but can this continue into next year?
I think it can, Brian. I think despite all the talk of a bubble this year, when you look at the forward price earnings multiples now versus 6 months ago versus 12 months ago, 18 months ago, they're pretty consistent. And this is not a runaway train multiple like we saw during the dot-com era at all, despite the bears insisting that it is. It's not straight up and to the right. There's a lot of pausing and reflecting and kind of people not sure that Nvidia can keep posting these, billion-dollar quarters and so forth. So I think that skepticism makes me optimistic that we can continue to grind higher.
Michael, of course, Nvidia could keep printing those billion-dollar quarters, right, next year? I mean, this is just almost like the Fed printing money.
Nvidia is an extremely strong company in a very robust space right now. So, of course, its growth is going to continue to be strong.
What are you concerned about next year? If I imagine we could we could very easily have the same conversation, Michael, next year at the same time, same place. And there really wouldn't be any reason why the market couldn't be up another 15 to 20%. I mean, the rates are likely to stay low. You have AI spending aggressively going on this country. All the factors that drove stocks this year higher are certainly in place for next year. I would even argue perhaps they're a little more bullish on the Fed side.
From my perspective, I'm actually in the bubble camp here. When you take the top 20 names in the S&P 500, and you drop Tesla out of the mix, they're still trading 28 times forward earnings. So those top 20 names in the S&P 500, their market capitalization is equal to half of the index. So it's a very top-heavy tape, and I think there's a lot of risk there. There's many attractively valued companies in the U.S. stock market right now, but the index itself is very top-heavy, and I think that is a risk.
And as I was thinking a lot about this AI bubble debate last night. I'm thinking about a lot of it this morning too as well. The reality is we don't know when a bubble has burst until it has burst and stocks have plunged.
Right, and we've spoken to a lot of strategists that talk about the fact that we will be entering a bubble. I mean, I know that you've spoken to some of them as well, but as far as going into next year, I mean, you've got BofA that has said we're not in a bubble yet. They do see that there is the possibility of an air pocket, but they're expecting that, some of these companies that are within this, the AI space, they have strong balance sheet. I mean, this is what they're all pointing to. Goldman Sachs recently also saying not in a bubble yet, but yes, the expectation is that eventually you do go into a bubble, but you're not exactly, as you mentioned, it's unclear as to when exactly that bubble pops or when you are in the bubble. But look, As far as the strategists are concerned with respect to the S&P 500 going into next year, you've got 7,700 as calls for the S&P. You've got even 8,000 as calls. And you have also a sort of run it hot policy that is expected to power the markets higher as well, and lower interest rates, as you just mentioned.
Eric, getting back to Nvidia, this is a stock you and I have talked about, I don't know, 12,000 times this year at various points. But we come out blasting next year. January 5th, you have Nvidia CEO Jensen Huang, key speech again at CES. What do you want to hear from him? If you're bullish the stock more broadly, it sounds like you are, what do you need to hear from him to stay bullish here?
I think it would be great to hear more success stories, case studies of the applications that people have started to roll out that really prove the payback from the investment. The street has been overly focused on just how much and how long the investment phase has gone into. And I think they're waiting for that kind of proof point of just how efficient or how quickly new revenues can ramp post AI bubble. So more stories like that, whether it's from Jensen or from the new CEOs of the new businesses themselves. I do want to point out though, Brian, one thing. Right now, Walmart and Costco are trading at 40 times forward PE. We never hear about a retail bubble. We never hear about a big box bubble. And even though Domino's Pizza has come down recently, and I think in the last 6 months, I think at this moment, Domino's Pizza still trades at a higher forward PE ratio than Nvidia. When do we talk about the pizza bubble, Brian? Like what's going on here? That's the part that amazes me when we get so fixated on the AI bubble.
Eric, you tossed at that bait. I'm going to take it. Michael, over to you, because Eric brings up a good point here. You have a Costco and Walmart trading at premium multiples to the broader market. Yet you look at the health of the U.S. consumer, they're not exactly doing great. The high end doing great. They've enjoyed a lot of gains on Nvidia and stocks, but that middle income and especially the lower income shopper have been really pressured. So it is almost bizarre to see those two stocks trading at a premium, or maybe they're just trading at a premium because they're viewed as defensive trades.
Well, it's funny. I don't think it's specifically an AI bubble. I think it's a bubble. There's the entire tape has a bubble nature to it. Whether it's the digital asset treasury companies, where people are buying stocks where the company's business model is to perpetually dilute the shareholders. Or in the case of a Walmart, it's a great company. It's executed great, premium valuation. Yeah, it's a tough environment out there that to find stocks that are attractively valued. The interesting thing with Walmart is its last push to 40 plus times earnings had to do with its announcement with OpenAI and integrating ChatGPT. So there is an AI element to that as well. But I did speak about the top 20, the 20 largest market capitalization names in the S&P 500. I didn't say a specific sector. It's just the 20 largest market capitalization names. They represent half the index by market cap, and they are expensive. And if you add Tesla's multiple in there, they're even more expensive. I was trying to be a little generous.
Fair enough. As you know, I'm coming to you on Costco. I know you're a big Costco devotee. Maybe I'm just making too much of this, but I think Costco is being viewed as a quasi-play on gold. Of course, they sell gold bars, and I would venture to say people, while they respect what Costco's selling, they have steady membership income, a lot of folks out there just say, if they're selling gold bars, I can get my exposure to gold via Costco.
Yeah, sure. And those gold bars tend to go very quickly when it comes to their selling gold bars. And look, I mean, the metals trade in general this year. I mean, if you there are some strategists that say it's gone too far, too quickly. But if you take a look at what Wall Street is also expecting for next year, since you mentioned gold, I mean, you're looking at strategists that are pointing to 5,000 for gold going into next year. You've got the silver bulls that are talking about silver being traded like an industrial metal because it's being treated like an industrial metal because it is also used in pretty much everything that has to do with electronics. It's one of these metals that countries are now hoarding. So there's a case to be made for this trade to continue into 2026, despite these massive gains that we've seen in the space.
Well, Nvidia has officially taken its $5 billion stake in Intel, carrying out a transaction announced back in September. And for more on Intel's deals, let's welcome in Yahoo Finance's Laura Bratton. Laura.
How's it going?
Very good. Walk us through it.
Yeah, so Intel said in a regulatory filing today that over last week it had completed the sale of $5 billion worth of shares to Nvidia. It was a deal that was initially announced in September and really boosted confidence in Intel. The two companies are co-developing CPUs for data center servers and also chips for personal computers. So really big deal for Intel to have kind of NVIDIA behind it. But notably, it doesn't include Intel manufacturing, and that's really what investors have been waiting to see, whether Intel's manufacturing business can turn around.
Now, NVIDIA, that was the only deal Intel struck, right, this year. What else has changed for that chip maker?
Yeah, a lot has changed. They have a new CEO, Lip-Bu Tan, that really bolstered kind of investor confidence in Intel because of his wide-ranging industry connections. Pat Gelsinger, the former CEO, had undergone like a really aggressive turnaround effort, and it just cost a lot of money. And the manufacturing business, which opened up to outside customers, has been losing a lot of money. Other things that happened, the US government, really big, they invested in Intel, so did SoftBank. And the U.S. government investment was a really big deal because the thought is that, now Intel might have sway over trade policy. The U.S. government could potentially pressure some of the bigger companies to use Intel's manufacturing business.
So, and by the way, this stock, I mean, as we should mention, it's up about 80% this year.
Yeah.
It has been just a rocket ship. Most analysts, by the way, on maybe not surprising after a move like that. I mean, look at that stock chart. Most analysts at this point on the sidelines. But what's ahead for Intel? Like, if I'm an investor in this name, Laura, what should I be looking for in 2026? What's on the radar?
Yeah, so Intel's latest manufacturing process, 18A, was a really big milestone for the company, but they didn't really get the big external customers that investors are really looking for Intel to get in order to be like, hey, this business is really, turned around. So that instead is being kind of used for Intel's own chips, but now they need outside customers for their upcoming manufacturing processes, 18AP and 14A.
Mm-hmm. All right, Laura, thanks so much. Appreciate it. Let's start here, Corey. We're wrapping up 2025. You're looking at the Mag 7, Corey, and the divergences here they're interesting, Corey. They're noteworthy. And over the past year, Google, it's a rocket ship, we know this. Nvidia, strong. Amazon, not so much. And I'm curious what you make of that, Corey. What you think investors are looking for? Is it monetization, Corey, or are investors looking for, okay, who controls the whole stack? Explain it for us. What do you think's going on?
I think the construct of the Mag 7 is a market phenomenon, not a business phenomenon, which is to say you have very different businesses under the auspices of the Mag 7 that were gathered together because of kind of the size of the businesses in general, the market caps of the companies, I should say, and the direction of their stocks. And as those start to fall apart, as they naturally, those correlations naturally will, because they are in different businesses, the whole notion of a Mag 7 is going to look sillier and sillier over time.
Let me ask you about a name, and I'm interested to get your take here. Nvidia. This deal with Groq, Corey, I want to get the Corey take here. To remind viewers, so licenses the AI technology for reportedly here $20 billion in cash. Key execs join Nvidia. What do you make of that deal, Corey? Was it a smart deal by Jensen Huang? And why did Jensen Huang decide, I'm going to structure this as licensing, not an acquisition?
Right, those are two important, different questions. So let's talk about what they're doing first and why it's different. And we can talk about this for days, except that we can't, but let's do what we can here. So the way that Groq chips are so different than NVIDIA chips is the way they the way they process information. Specifically, it's a phrase that's really hot in Silicon Valley right now, deterministic programming. So deterministic, or processing, I should say. Deterministic sort of takes a big chunk of data and analyzes it all at once. So if you were to ask, the example that Groq likes to use, if you were to ask a large language model using, if you were asked ChatGPT using NVIDIA chips, what sentence uses all 26 words in the alphabet, and the answer might be, the quick brown fox jumps over the lazy dog. Well, as you type that question in letter by letter, NVIDIA's chips and the ChatGPT model is trying to figure it out letter by letter. WHATSEN, what sentence. It's trying to determine what the next thing you're going to is, and it can be kind of slow. Whereas a deterministic model using a Groq chip looks at the whole question, figures out the answer, and dishes it out to you quickly. It's a different kind of processing that uses less high bandwidth memory, uses less processing power. The chip must be more powerful to do so, but programmed to do that. It's a very different approach. And as the artificial intelligence world goes from building the models, training, to using the models, inference, the Groq chip is a different approach that might work better. Nvidia had reasons to be concerned that they were going to lose share in the marketplace over time because of this deterministic approach being more simple and more elegant and cheaper to use over time. They're smart to get in there to try to make sure nobody else can take their lunch.
All right, so smart to get in there. You've laid out the strategic rationale. Is there regulatory risk for Nvidia with this deal? Is there FTC risk?
Right. Hell yeah. This is a huge risk. It's why they structured the deal this way, one would think, because the biggest company in the world with 95% market share in the GPU market, going out and buying maybe their biggest competitor in the future, not AMD, not Intel, not Huawei, right? But this Groq company has a very different approach to doing this. And to be sure, I've invested in a company called Positron AI that is in some ways a competitor to Groq and has some former Groq employees. So I've got some conflict here. I want to make sure all the viewers know what I'm talking about, why I'm hedging my bets here. But I think that what's interesting here is that if this were a clear acquisition, it would be a clear problem with the FTC. This is a less clear problem, except that the FTC has already gone out there and done some investigations of similar kinds of deals at Google and Microsoft and others as it relates to AI and chips. So the FTC is going to take notice of this and notice of the nimble yoga that Jensen Huang is doing in putting this deal together in a way that might avoid a Hart-Scott-Rodino review, but might not after all. Now, with a Trump FTC, and with President Trump's reported friendship with Jensen Huang, who knows if that matters as much. But clearly this is Nvidia trying to take a competitor off the boards.
Well, let me ask you, I am curious, the potential consequences of this deal, Corey, what would be, in your opinion, some of the ripple effects investors would need to look out for in terms of that just broader competitive landscape?
Look, it's really exciting for the investors in this deal. I've talked to a number of them over the course of this holiday weekend because my friends have nothing else to do but text me with their celebratory moments before Christmas. But if this deal goes through, it'll be a huge gain for a lot of the investors in this company. But it also will show how NVIDIA's really got a lock on things going forward as they both own the GPU market, expand into the world of networking as they build out more and more of the systems, not just the chips and even the networking that happens within those systems and connecting those systems. But now the notion that they can just go out and use the power that they have achieved with the success of their GPUs to acquire their future competitors, it's a sign of the times that they might be stifling competition down the road.
Corey, always great to see you. Always great to have you on the show. Happy New Year, my friend.
Happy New Year to you.
Adam, what's the best course of action for the average investor? Do they waste a whole day trying to find the next big play in AI, or do they just say, you know what, NVIDIA's going to win this whole damn thing. I'm just going to bet on them again next year?
Yeah, I definitely wouldn't just bet on NVIDIA. I think you do need to do your homework if you want to buy specific names. I think probably the general investor is probably better finding some sort of basket to kind of play the overall space. But we're very early innings in this, and obviously NVIDIA is the winner right now. But to say, in 5 years that we look back that they're going to be the dominant player still, very, very unlikely. Like I said, this is really an evolving space. So I would be careful with something that's so specific as NVIDIA. We kind of like to barbell this with, something like the big hyperscaler, like an Alphabet, Google, because that's really the type of name that you could probably have a little bit more comfort in, because they just, overall, the AI story is just benefiting an already existing business model that was doing well. So I think you would just want to be careful with what we're calling kind of the one-trick ponies, like a NVIDIA, a CoreWeave, or a Palantir right now.
Brooke, let me get over to you, because I think what you're seeing in industrial metals and some of the things that Adam's talking about fits nicely what we heard from Ed Yardeni this morning, that we are likely to see a broadening out in this rally. Investors doing their homework, trying to get outside of the tried and true Mag 7.
Yeah, Brian, what we did hear from Ed Yardeni over the weekend was really ongoing momentum in this market in 2026. He maintains that year-end target for the S&P 500 of 7,700. And he said largely it won't be really led by the Mag 7, but also what he called the impressive 493 of the S&P 500, as really this broadening out, this boost in productivity growth really leads to overall returns for the S&P 500 in 2026. Specifically, he went on to say that that is really where exactly investors should be thinking about this mindset. Not really overweight technology, but more so thinking about the other users of AI as opposed to just the producers of AI. And so certainly he's not alone in this momentum that he thinks will exist within 2026 ongoing from what we've seen so far in the returns in 2025.
And as I've been wasting a lot of my own personal time and thinking about who else will be the AI winners, I really don't have anything else to do at this point in the year. And I'm stumbling upon a company like Exxon for obvious reasons. Exxon stock has had a really good year. It's something not a lot of people have been talking about, and that comes alongside oil prices going lower. So are oil stocks the next AI play here, or am I just reading too much into it?
No, I mean, there's certainly a group of strategists that are talking about that you will be seeing commodity prices when it comes to oil going higher eventually. But you also are looking at natural gas that's been going higher. Natural gas is really the play. That is going to be the winner as far as the energy spectrum is concerned, or the energy players are concerned for AI, for data centers. And I took a quick look at the components in the S&P 500 that have done very well this year, that have beat the S&P 500. GE Vernova, they make gas turbines. They also are in the services business. That stock is up 100% year to date. You've got NRG Energy, a power company, up 75% year to date. Constellation Energy is also up. You even have Albemarle, the lithium maker, that is also up year to date, 76%. Because guess what? You also need a storage of energy, and lithium is used in battery packs. So there are a lot of other players within the AI space, and especially when we're talking about energy and upgrading the grid and all the energy that AI is going to need.
And I don't know if I asked you this, you watching that Landman show on Paramount Plus? I mean, that's a good show.
I have not been watching it because I just don't have time, but I've got to get on it.
No, it's good. I think their current episode, they are drilling for natural gas out in the ocean. Just a fascinating stuff. Adam, let me get back to you. What are some of your top picks for next year and why?
Yeah, so like I said, looking at kind of a barbell approach, we still like Alphabet going into next year, and we still like Microsoft. So those are kind of the big behemoth hyperscalers that we still like. And then, down the chain, we like I said, the things that overall the AI story will help prop up. And for us, it's cybersecurity becomes more and more important. So they've obviously done really well, but Fortinet, CrowdStrike are two of our top picks on the security side. So like I said, we're trying to play it with big hyperscalers with very robust business models, and then down the chain, just having a smaller position size. I think you want to be really careful with position sizing, but we're building a basket of, like I said, smaller names. Reddit is another name that we like within kind of. It plays into the AI story, but is much smaller. So the position sizing is done accordingly. But so that's kind of our approach right now is the hyperscaler matched with some of the very specific, kind of one-off names.
Adam, when you're crunching the numbers on some of these names, like a Microsoft, Alphabet, even a Reddit, they're all valued at a premium to the broader market. Are you willing to accept that these above market multiples if these companies are still in high growth mode? And they really all are.
Yeah, this is one where you got to be careful. I think, valuations are something that can get disregarded, and then suddenly they kind of become the narrative when they get a little bit stretched. But stocks don't go down because valuations are stretched. They go down because that valuation just starts to erode the margin of safety. So, like I said, you just have to be cognizant of that. You need position size. So as valuations kind of get a little bit more stretched, you want to be a little bit more careful, sure, but that should not be a cause for you to sell a stock outright unless there's just something in your model that it just tells you should fundamentally. But stocks can grow into their valuations as well. Just because the valuation is a little bit on the high side, maybe the stock slows down, it doesn't accelerate the way it has, but it doesn't mean that it has to go down. Like I said, the one thing to be careful about when you see valuations get kind of at their upper bound is just the margin of safety is smaller. So you just have to be more careful, and earnings miss, something like that will be more painful when valuations are stretched. But like I said, it doesn't mean the stocks are going to go down.
Tech is capping off a blockbuster 2025 driven by AI infrastructure spending that fueled much of the sector's gains. But as we head into 2026, the story is shifting from pure growth to execution, competition, and also risk. So for more on this, we're going to bring in Bob O'Donnell. He is the president of Technalysis Research. Bob, it is great to see you here. And we talked about this earlier in the year on Stocks in Translation. So give us an update. What do you see the AI? What has been the dominant theme of AI? Excuse me, I was leading you there, of the AI trade this year, and kind of heading into next year. What are you keeping your eye on?
No, fair enough, Jared. Thanks for having me, of course. Look, one of the things we talked about back on that program was this notion of hybrid AI. And by hybrid AI, what I was referring to and continue to talk about is this idea that we're seeing AI being deployed, of course, in the big clouds, and we're seeing a lot of benefit from Google and Amazon and Microsoft and those kinds of companies, Meta as well. But we're also starting to see businesses themselves start to deploy AI. And so this hybrid AI idea is that the fact that you can do some of this AI computing in the cloud with the big LLMs, but you can also do it on your own premises or within data centers and things like that. So that's where a lot of the excitement is, because that's where there's a huge long ramp of growth and opportunity. And so that's from companies like Dell and HPE, Cisco, some of these other companies who sell some of the servers that the companies are buying. Of course, they include Nvidia chips or AMD chips, and I think we'll see a lot more competition in AI accelerators in 2026 as well. But the point is, a lot of those companies and then the software that they're building and creating with that is driving a whole new wave of opportunity. And that's, like I said, that's sort of that hybrid AI story. We saw the beginnings of it in 2025. I think we'll see a lot more of that in 2026.
And let's shift the discussion right now to a little bit more forward-looking. I know one of the things you have your eye on for next year is also cybersecurity. Tell us about the importance of that and any plays you might have in that regard.
Well, I mean, look, what happens with cybersecurity is that both the attackers and the defenders have gotten much smarter and much more capable because of AI. And so there's a fast race to see who can outpace each other. I mean, that's always going on, but the speed at which that is changing is just incredible. So you've got all your traditional players. We've seen obviously a lot happen with Palantir. You've got companies like Palo Alto Networks. You've had CrowdStrike. We've got a bunch of the sort of traditional security names that are all diving in. There are a whole bunch of little startups that may make some kind of a play or be acquired sometime in 2026. But there's no question that every single organization who's doing this is going to have to be doing AI, that is going to have to think about it. And especially because, of course, the theme of 2026 when it comes to AI is agentic AI.
Yes.
The idea that we will have agents that are actually acting on our behalf using AI. And that notion of all this agentic AI has been a huge theme over the last couple of months. I expect it to continue in 2026, but security around agents is huge.
Let me ask you about that, Bob, because I know one of your talking points here is that we might have some of these agentic AIs or these AI agents go rogue. What this reminds me of is way back in the late teens when we were talking about autonomous vehicles, and it seemed like every time there was an accident with one of these vehicles, it just got national headlines and it spooked people. And I can't help but think the same thing is going to happen here, but what are the market implications? How do you think this affects the industry and some of the trading around it?
It's a great question, Jared. And yeah, I mean, one of my concerns is if we indeed get these billions of agents starting to run simultaneously, inevitably there's going to be huge questions around that, hence that point about cybersecurity. So look, I think we will see a lot of progress in agentic AI in 2026. And all of the major cloud players, all of the major LLM providers are all working on developing agentic capabilities. But I am very concerned that we're going to see a few stories where things go awry, and that's going to put a pause on some of that agentic work. And so I think there's going to be a lot of trust issues, and all of that could eventually, of course, have blowback on some of these big tech companies. And, again, even though I think that AI is going to do just fine in 2026. It's these little signs. If we see little signs like, agentic starts to become an issue, then that becomes an incentive for people to say, see, it's going to blow up. So that's part of the reason I'm concerned about it, is not just what it's going to happen, but the fact that it's going to present a concern that people who are sitting on the sidelines just waiting to pounce on a problem to go, see, there it is. And sometimes those things, snowball. Hopefully not. But that's something you got to be aware of and sensitive to.
Well, and another thing people have been, some of the critics have been pouncing on is all the spending, the capital expenditures, so-called capex. We saw that it's been exploding over the last few years. It's set to continue next year. But we've seen in the Mag 5, for instance, we used to kind of talk about them, or the Mag 7 as a whole. It's really only Alphabet and Nvidia, maybe Tesla as a come-behind story, that have really surged this year. So is it a game of have and have-nots, or how do you see this playing out?
No, it's a great question. I mean, look, I think Nvidia obviously continues to do well, but I also am certain that Nvidia is going to get a heck of a lot more competition in 2026. AMD is, an obvious one, but there's a lot of other little players. I mean, Nvidia's deal with Groq recently to bring more of their technology in is a reflection of the fact that we're seeing more specialized types of models being developed. We're going from the days of big general purpose LLMs that you can use for everything to much more specialized areas, and each of those are going to require different types of hardware, and I think in turn that's going to create additional opportunities, but it's going to create more diversity, which is going to be a little harder to figure out. But obviously I think you're going to continue to see folks like Nvidia, AMD do well. As I said, I think you're going to start to see some of the smaller the cloud guys who are doing custom chips, often through Broadcom, will also start to benefit. We've seen already, Google's been doing more with TPUs. Amazon has their Graviton chips. We've got a bunch of other companies. Microsoft is doing custom chips. A lot of these are ARM-based. So ARM is another company, we haven't been talking about them a lot lately, but ARM's helping drive some of this innovation. Intel, as you talked about, is doing well. They continue to plug away. Obviously, they had their challenges last year, but things are looking better in 2026. So I think we're going to see a lot of different players from different areas all start to come together. And we'll see some smaller companies. There's a little company called SiTime that does timing chips, and all these networks have to be completely aligned from a timing perspective. They're doing some interesting stuff. So I think there's a lot of different opportunities in different areas, but we're going to have a lot of the bears on the side, just again, waiting to pounce on these concerns that get raised, I think, around agentic AI.
And we'll have to see if those are dips worth buying or not. And Bob, what I'm realizing is we got to do another podcast real soon. So thank you for showing.
Yeah, man, I'd love to.
It was great seeing you here.
Thanks, Jared.
Tom, it is great to see you. So let's start on these pillars, Tom, that you say are holding up this market. Pillar number one, no surprise, AI. Lots of investor excitement, Tom. It's helped to carry this market in 2025. I'm curious how you see that AI trade and trend evolving in 2026, Tom.
Good afternoon, Josh. Thank you very much for having me on, and Happy New Year to everyone. Yeah, so we sort of described four pillars of the rally, and the most important and first one, as you said, is AI. And it's really been a rising tide that's lifted all boats, not just this year, but for the past 3.5 years, really. But we think that's changing a little bit in 2026. And importantly, it doesn't mean it's necessarily going away. But instead, I think that sort of AI enthusiasm is going to look a lot more like Q4 than it did, say, Q2 and Q3. And what I mean by that is that it's fractured. So we're not going to have every single tech stock just running away. It's going to become a selection of winners, say like your Micron, and then maybe some losers like your Oracle, and to a point Broadcom. And I'm not saying for those stocks specifically into 2026, but more as an example that we're going to have to be selective as AI matures.
Well, let me ask you, if AI is sort of more fractured next year, if I'm a viewer, I'm an investor, I'm listening to that, how do I discern, Tom, then the winners and losers in this AI fractured world you're describing?
So for me, I look at AI as sort of a cycle that's maturing, right? And really the first stage was sort of, it was the epiphany stage, right? Oh my gosh, we can do this. And then in order to do this, the first thing we need is semiconductors. And now we're going to run out and buy all the semiconductors that we can. And obviously, Nvidia, Broadcom, Taiwan Semi have benefited fantastically from this. I see it evolving a bit now into those companies that are really taking the leading edge. Probably my top AI pick for 2026 is Google. I like Gemini 3. I think their advantage on search gives them a huge sort of chip in the game against OpenAI. So I like Google from a search standpoint. I also like the memory because that's sort of the next stage of this data center build out, right? We need the compute power. Well, now all of a sudden we need all the memory to power all that we need. So I see it more of an infrastructure play evolving towards memory on the infrastructure side, but then also from sort of the hyperscalers. I really like Google with YouTube and then with Gemini 3.
Another pillar you talk about here, Tom, is economic growth. You know, it's looked stable, it's looked resilient. You are watching the labor market. How do you see that labor market evolving, Tom? What do you see now and ahead?
So the labor market is not bad, right? The only reason we're even talking about it is really because it's been so good for so long. I mean, there was a time, Josh, you can remember this, when we all would have prayed for 4.6% unemployment. Now we see it, and we're starting to get a little bit nervous. But here's the rub. We are stuck in a no hire, no fire labor market. That means that people aren't being laid off en masse, which is a good thing, but they're not really being hired either. And whether that's AI's fault or just the economy's fault doesn't really matter. It doesn't take much to go from a no hire, no fire to all of a sudden a contracting labor market. And the labor market is really what's keeping this economy afloat through the affordability crisis. If people start losing their jobs, and they have to start cutting back forcefully, then all of a sudden the affordability crisis gets exponentially worse. And that's the type of thing that can cause a recession. Watch 5% in the unemployment rate. If we get close to it early and breach it in the first half, that is a bad economic signal.
Another pillar, rate cuts. Tom, how many cuts do you think we get next year? What's your base case?
So I'm inclined to go with 2. Because I think that the Fed is sort of telling you there's one, right? And then I think we get a new Fed chair, and it doesn't matter whether it's one of the Kevins or somebody else. I think they probably push for an additional one. But I don't think we're going to see the type of consistent rate cut cycle that we have expected over the past 2 years. So there's room for disappointment on the 2. And if it's going to be a surprise, I think it's a surprise less.
Does the market, Tom, in your opinion, does it need those cuts to move higher in 26?
Yeah, I think it does. I think that sort of the synopsis of the pillars of the rally, the review, is essentially that they're all still in place, but all of them are weaker than they've been in the past couple of years. So it sort of begs the question, what's going to push us higher? Well, we need some positive surprises, right? And sure, AI can provide it, and sure, growth can be better than expected. But if we get a suddenly more dovish Fed that doesn't mess up the confidence of the market in Fed independence, then all of a sudden that could be a pretty good tailwind. Because if the doves are right and rates are still way too high, then that could really goose the economy and that could help the whole market.
Final pillar here, Tom. You mentioned tariff clarity. So what do you think we're going to hear from the Supreme Court, Tom? You think they're going to rule those Trump tariffs are illegal?
I do. I mean, I'm certainly not a legal scholar, but everybody that I read seem to think that same thing's going to happen. And then it's a big question of what if, right? What happens? I think most people expect that the Supreme Court just says, you know what, they're struck down, and the lower courts, you figure out what to do with the refunds. That's not the biggest issue. The biggest issue is then what does the administration do? And do they reapply for these tariffs? And then are they immediately sued? And do we go through this process over and over and over again in sort of a perma uncertainty? And what does that do to the economy? I think one of the biggest surprises of 2025 is that apparently you can jack tariffs up the highest in decades and it doesn't really break anything. Well, maybe it didn't break anything yet. And I think that we need to not be complacent about the risk that this takes over time. You know, the longer these things hang on, the more of an impact they can have.
Tom, great to have you on the show today. Appreciate your time. Happy New Year.
Happy New Year.
I've just realized I've spent too much time the past 2 weeks talking about Google and Amazon. I want to go to one of your picks for next year. That is Palantir. Make your case.
Oh, well, we love the name from a defense standpoint. They are the leader in AI and data. With Defense Department approval and usage, and then beyond that, corporate adoption and sovereign adoption. So we think the name continues. It's one of those names, Brian, you can't justify it from a valuation standpoint, just like one of our names in our 6 for 26, Tesla, which you were just talking about. Hard to defend the valuation, but the narrative is quite compelling, and that can drive stocks for a very long time, like it did Amazon for the first 20 years of Amazon's IPO life.
So Nancy, is it more, how do you, so when you're looking at a company like Palantir, do you just suspend everything that you've learned on valuation? I mean, I've done the same too when looking at Palantir. I mean, this stock is traded at crazy multiples.
Yeah, I mean, I'm a classically trained value investor. And one of the things that you had to learn as a value investor is when to pivot. And I don't mean it's different this time or change your discipline. You just have to look at things a little bit differently when the earnings are not what they might be based on valuation or at all. In the case of Amazon, I missed the first, 20 years of IPO life for Amazon. And the stock's up 180,000% since the IPO. When was it too late to get in? I mean, we eventually did. We began to understand the world was different in many ways in terms of this is a transformative company. And that's what Palantir is. It's what a number of the names in our 6 for 26 are.
What is the better buy, Nancy, Palantir or Tesla? Or should you have both of these names in your portfolio because they're both strong AI plays?
I mean, if I had to tip the scale, I would say Tesla is probably our favorite, and that's why it's in our 6 for 26. It is the transformative AI leader. It's not just full self-driving, but it's also robotics. And even if you look beyond that in the XAI investment the company is making per shareholder approval, we think all of that is super powerful, and we'd love to get a bite at the space business when they IPO. So I think this is a company that has a vision, and it's the CEO, obviously, unlike any other company that we own.
How much of a factor on Tesla is Elon's $1 trillion pay package? I mean, how do you grade that? Because that could be, even for the world's richest person, that could be something highly motivating.
Well, I think he's internally motivated. If you read Walter Isaacson's biography, he said, Elon said, I'm programmed for war. And that is when he is at his best. He often teeters on the edge of disaster, pulls back just in time, and then delivers on what many thought were ridiculous promises. And sometimes they've not happened in a timely fashion, for sure. But if you look at what he is envisioning, it's not just EVs, obviously. I mean, the car numbers are disappointing, but think of Tesla's EV business to the AI portion of the business, what Apple's handset business was to services in the ecosystem. And so Apple, had many years of underperformance in terms of delivering growth in the handset business, but they were growing the services business at a rapid pace and continue to do so. So we think he is the story. He delivered on the last sort of absurd levels of incentives for the company and is now actually going to get paid for that. It isn't the money for him. I think it's the control.
Nancy, I think people forgot about Amazon. Underperformed this year. I wrote a story yesterday on Yahoo Finance laying out why the stock could rise 50% next year. I got a lot of, let's say, negative feedback on that. Very important. I wasn't making this call. I was just laying out the reasons why it could happen. Am I out of my mind here?
Welcome to the investment business. No, I saw it, and I do agree. I think there are a number, it's been a laggard. They delivered robust earnings. I mean, really a massive earnings beat last quarter. The AWS business is very mature, but still growing at 20%. And they offered this tidbit that I didn't see many people talk about, and that is that October growth in that business was bigger than the whole third quarter. So I wouldn't underestimate them. Trainium is at full capacity and has a backlog. And it's a stock that's trading at a peg of 1.4 times. If you go back and look at the S&P historically, it's traded at a peg of 1.5 to 2 times. So I think this company is fairly valued and has the ability to deliver not just robust earnings growth, but free cash flow is going to increase next year to levels we haven't seen in 5 years.
And Nancy, you're in good company because Warren Buffett has also liked Amazon. That brings me on to my next topic. Tomorrow is his last day as CEO. It almost is surreal to see this day finally here, but nothing lasts forever. What have you learned from Warren Buffett's investing career, and what principles have you applied to how you do business?
Perspective, I think, Brian. I mean, I actually, little known fact, I managed a $100 million portfolio for Cologne Reinsurance, which was acquired by Buffett, Berkshire. And so for a year, they kept us on and we managed money for Warren Buffett. I think it was out of the kindness of his heart because we were new. I mean, we generated great returns for the firm, but he has a perspective and I would say that kindness matters in this business. There's a lot of people that are not humble. They don't learn from their mistakes, and they're not the kind of people you want to hang out with, as you saw as a result of your article. He has never engaged in that, and he has been steady at the helm. He has perspective, and when he pivoted to Apple, though we were already in the stock, I thought that was an important moment to pay attention to.
Is that one of the best ways to become a better investor, Nancy, to learn from your mistakes? Not every investment is going to work out.
100%. I have a team of analysts. That's all I talk about with them. And some can't do it. And we had one that recently left, and that was the reason. You have to have the humility to learn from your mistakes and also admit them. If you can't admit them, then you don't learn from them. So I make a mistake every day. We have I don't know what you call it, but a watchword or a watch sentence in our firm, which is investing is about being mostly right. And if you're mostly right, you'll generate top 1% returns. And we've been able to do that over the long term. But we're not right every day. And it's a humbling business.
Indeed it is. Nancy, always good to see you. Happy holidays. Happy New Year. I look forward to talking to you again soon.
You too, Brian. Thank you.
Go down a little bit. And the broad indexes have still held up well. This has been a rotational market where things like consumer discretionary and financials have kind of picked up some slack. So I think it's really reassuring that the broad market, in the US and globally, doesn't need tech to be firing on all cylinders to continue the bull market. So heading into 2026, we've got a lot of stimulus coming, rate cuts, as was mentioned, fiscal stimulus. And we've got strong profit momentum as well, which has driven indexes higher this year. So there's a lot to like. And if there's a risk, it's just that. It's sentiment. It's that everybody sees a lot to like. And that can be the thing that tips markets sometimes.
But Ross, you still do expect some volatility in the first quarter of 2026. So how should investors be planning ahead of that?
Yeah, so I think we're in the middle of a cyclical bull market. Started in October of 2022. Your average bull market is 5 years. I think this one has plenty of room to run. So when we get these pockets of weakness in a bull market like this, and especially, if it's just volatility related to some headlines or some profit taking, I think it's buyable. Every pullback, in this cycle has been very buyable, and you've needed to move quickly. Even the big sell-off in April, you only had a couple of days to get a buy-in before the market rebounded. So we've gotten used to these V-shaped rebounds when the market sells off, and I think there's more of that to come. So volatility would be buyable in 2026 is how we're going into the year.
Ross, one of the key concerns among investors right now is that AI bubble risk, that valuations are just too high right now. What's your message for investors who are a bit nervous, especially heading into this next year where AI is really going to ramp up?
Yeah, absolutely. I mean, valuations are stretched, that's for sure. That's why we're counting on profits to kind of carry the baton in 2026. And I think they'll do so. Valuation, as has been repeated ad nauseum, is not a good timing tool for the market. So, markets can stay expensive for a long period of time. As for the bubble conversation, especially if we're comparing it to the dot-com bubble of the late 90s, this has been a nice bull market, strong returns, but nothing comparable to the parabolic price move seen in the late 90s and the euphoric sentiment, right? Where every bear was throwing in the towel. You had IPOs coming every day, doubling on their opens. So I think we're in a tech-driven bull market, but I don't think we're even close to the bubble comp of the late 90s. We have plenty of room to run before we get there. And I hope we do, because a lot of money was made in the late 90s before things went bust.
All right, so Ross, you expect this bull market to continue. Do you buy international as well to sort of position yourself?
Yeah, absolutely. I'm very pro international. I think, anecdotally, just talking to our clients, I think a lot of U.S. investors have thrown in the towel after a really difficult 15 years post-financial crisis. But international meaningfully outperformed this year. The dollar has weakened, and I think that's a trend that likely continues, which is a huge boon to international stocks. You've got some real catalysts, right, with the European fiscal spending, regulatory reform and shareholder reform in Japan. So there's a lot to like international. I think, particularly just to get to market weight, I think a lot of U.S. investors would have to buy, because I think they've thrown in the towel over the last decade and a half. So I'm pro international. I like that trade heading into 2026, and I think it, quite frankly, is a nice barbell with U.S. stocks that are so tech heavy. International offers a bit more flavor.
Ross, at the top, you also mentioned that you like financials, you like discretionary moving into 2026. Why are those sectors attractive to you right now?
Yeah, I think the economy is in good shape. Rates are coming down. We want to own cyclical stocks that are exposed to the real economy. On the discretionary front, I think the worries about the consumer are a bit overblown. I mean, obviously, we're keeping our eye on the labor market, but the underlying trend is still solid. Spending was good. It was a nice holiday season by and large. And then on the financials, kind of the same idea. Real economy stocks, cyclicals, the banks have done quite well. I think 2026 is shaping up to be a year with a lot of deal making, some big IPOs in the pipeline, and obviously a good stock market, kind of rising tide that lifts all boats in the wealth management space. So I like those cyclical sectors. I would lean large cap and high quality. I wouldn't want to take too much risk at this stage of a bull market, but I think there's enough to like in those kind of rate sensitive cyclicals that I would be adding here.
Ali, I want to start here with Oracle's partnership with OpenAI, because one BNP Paribas analyst told Yahoo Finance that OpenAI's potential inability to pay for its AI infrastructure could be one of Oracle's biggest risks. We've seen this recent sell-off. What do you make of that? Is OpenAI's inability or ability to pay a major risk to Oracle moving forward?
It is indeed a major risk, and thank you very much for having me. I do believe it's a major risk. OpenAI, according to Microsoft's financial statements, is losing around $12 billion a quarter, and their financial disclosures are not very transparent. And as Oracle's largest customer, essentially they could be a source of risk. One of the biggest component of capex that Oracle has is building data centers that are contracted with OpenAI. And an open question would be, in case there is a failure to pay by OpenAI, how can those data centers be repurposed?
Ali, how do investors assess this long-term potential of AI while also taking into consideration the risks on their near-term balance sheet?
I do think that looking at balance sheets actually is a good place to start. If you look at Oracle on the surface, the financial statements show significant growth in the earnings. But if you look at the details of those earnings, the earning growth was come from a non-recurring item, which was a sale of a venture that they had with SoftBank. And that contributed roughly $2.5 billion to their earnings. If you take that out, Oracle is essentially operating income is growing at a fairly respectable 12 to 15%, which is, again, very good number in and of itself, but it is not the explosive growth that would justify equity valuation to move higher. And another factor that is impacting equity, and that's really like where my interest in Oracle is on the credit side. If you look at credit spreads, Oracle's credit spreads are moving wider and wider because their capex has gone from $6 billion over the prior 6 months period to $20 billion. And that's a significant growth in capex that is being funded by credit.
There are some key concerns around not just Oracle, but other even smaller AI players here like CoreWeave, some credit risk concerns. How do concerns over a company like CoreWeave sort of trickle into Oracle's and investors' concern there, but also the other larger, broader AI trade that has really led this stock market rally over 2025?
Sure. At the end of the day, Oracle, I think of it as a relatively safe company when it comes to credit. They have their software business. Other than OpenAI, if you look at their other major customers, they are Microsoft, there is Nvidia, there is ByteDance, and then you always have Mr. Larry Ellison, who is a genius. So on one hand, Oracle is I think of it as on the safer side of the credit play. But as you mentioned, CoreWeave and CoreWeave's business model is under threat. And I think some of the movement that we are seeing in Oracle's credit spread and cost of capital is more really because CoreWeave CDS is so expensive that investors that have exposure to data centers, rather than trying to hedge by CoreWeave, and you have to pay a lot to hedge CoreWeave's credit risk because they are a high yield company. They come and use Oracle shorts as a proxy for AI credit risk. And I do not necessarily believe that that's the best proxy for AI credit risk. And at the same time, as you are pointing it out correctly, like some of the concerns that people have in CoreWeave, because they cannot express it by shorting CoreWeave, because you have to pay a lot of money to short CoreWeave, they are just using Oracle as a cheap proxy.
And now, Ali, you mentioned it at the top of that, but now TikTok is something that Oracle has its hands on, especially particularly here in the U.S. operations. ByteDance, the parent company there. Investors hearing this, maybe for the first time, thinking Oracle is going to be part of a group of investors who own TikTok here in the U.S. How do you make that? How do you make way of that? Should this eventually come to fruition?
We think that anyway, Oracle and ByteDance have a relationship that has been going on for a few years, where Oracle has been providing their cloud services to ByteDance's U.S. operations, and that partnership has been growing. I do think that the joint venture, and it's important to note that this is not a merger per se, it's more a joint venture of which Oracle is a shareholder, is going to bring a very stable kind of essentially customer of their AI services back to them. So to some extent, that balances out the risk that Oracle has to OpenAI, where if you have an OpenAI credit event, you probably, that's going to be offset by the fact that you have other stable customers like ByteDance. And then in the event that ByteDance becomes a major revenue source, that could also further reduce credit risk and possibly be a source of profitability for Oracle.
So we all have to buckle up and see how 2026 holds out for Oracle. Ali Melli, thank you so much for joining us.
Thank you very much for having me. It was fun.
Dan loves tech. Dan, good to see you. Don't know where to start, so I'm going to start on Nvidia. I mentioned at the top, we're seeing the bulls return to Nvidia. Not in a big way, but I would say in a nice way. What's the play there?
Look, I think the reality is China's going to reopen, for Nvidia, and I think that's something that wasn't necessarily factored in fully. I think investors are realizing it's a big change in the beltway. And look, Saz, the reality is there's one chip in the world fueling the AI revolution, and that's Nvidia. And I think as it plays out, numbers are significantly underestimated. I think 15 to 20% at a minimum going in 2026. You put that together, I think we're looking at a $250 stock in a base case to end 2026.
Another case for Nvidia, Dan, is it this? And you can tell me if I'm wrong. You and I have known each other for many, many years. It's okay. We have a debate here. That Nvidia has less exposure to OpenAI than its rival AMD, because AMD might be partially owned by OpenAI in 10 years.
Look, right now, the reality is that, associated with OpenAI is a bad thing. Now, I disagree with that. You've talked about it, but no doubt from a trade perspective, NVIDIA, they're obviously, they're not wed to an OpenAI. And I think to some extent, I think you've talked about it. When you look at the divergence of those related to OpenAI, whether it's Oracle or Microsoft or whatever it may be, those stocks are obviously under more pressure. But look, my view is as we go into 2026, investors are underestimating the scale and scope of the AI revolution for NVIDIA for OpenAI, for Oracle, which I think is table pounded here, despite obviously a lot of the negative sentiment for Palantir and others. Because look, only 3% of companies in the U.S. have gone down the AI path, and for the first time in 30 years, the U.S. is ahead of China when it comes to tech.
Dan, later on in the show, I'm going to have Marianne Bartels on. Really excited to talk to her. She's making the case that tech might see, her words, not mine, a reset year next year, but then go off on a very strong bull run looking out over the next decade. If there is a reset in tech, let's just say the first quarter next year, what triggers that?
Yeah, look, and she obviously always has great thoughts. I think my view is, look, the white knuckle moments, whether they're resets or whatever you may call it, like they create the opportunities. I mean, go back to, we'll be at CES again, go back to a year ago, right? I mean, Jensen comes out, the black leather jacket, I think even maybe potentially diamond studs in the back or whatever. Talk about quantum.
I think that's your jacket, Dan. I think that's your jacket.
I think that could be your jacket, Dallas. but we're getting off topic. But the point is, look, the reality is negative on quantum. Remember the sentiment, going to DeepSeek moment in January. You're going to have these moments, but my view is like you're in year 3 of an 8 to 10 year build out of the AI revolution.
Outside of Nvidia, I love what some of the thoughts you've been putting on your X account, Dan, on Tesla. Now, I'm sure you saw the photos of Waymos getting stuck in San Francisco with the power outage, and my first thought was, this is everything that could go wrong with the Tesla robotaxi.
Look, my view is 2026 is going to be probably the most important year, I'd say maybe in its history, for Musk and Tesla. Because, look, the autonomous chapter now comes to Tesla. 30 cities where we see robotaxis, ultimately in the United States. Are there going to be issues? Are there going to be speed bumps? Could there be delays here and there? Yeah, I mean, obviously you saw the blackout in terms of Waymo in San Francisco. But look, I think next 3 to 4 years, 20% of vehicles are going to be autonomous. And I think that ultimately is where it's heading. And that's why I think when it comes to physical AI plays, the best physical AI plays in the world are Nvidia and Tesla.
How much value, Dan, are you assigning to Tesla's robotics initiatives?
$1 trillion is what conservatively we view. I mean, look, if you own Tesla here, you're not owning it for what deliveries look like on Jan 2nd, right? I mean, you're owning it for autonomous robotaxis. And we talk about bull case 3 trillion, base case 2 trillion. Now, look, if I showed you a year ago where numbers were going to go for Tesla this year, you'd be like, the stock's $250. The reality is that investors are looking through deliveries and near-term numbers to understand what the autonomous chapter is going to ultimately bring. Because I could argue numbers could be up 4, 5x when you look out over the next 4, 5, 6 years. I think that's the way to view a name like Tesla.
Dan, before I want to get to Palantir, but why I love you, many reasons why, as you know. But one is you cover you cover damn near everything. So if Tesla's going to dominate in robo-taxis, what does that mean to a General Motors and a Ford, who are not really playing in this industry at all?
Well, first of all, to lump GM and Ford together, I disagree. I mean, I think what Mary's done and Paul at GM has been Hall of Fame moment for them, right? The stock, I think, speaks for that. They've been able to navigate supply chain issues, pull back on EVs, but I believe like GM is in a much better situation. And again, they're going to kind of pick their spots. Ford obviously much more back against the wall, and we see that in terms of what Farley's trying to navigate. Look, I think what it means for the GM and Fords, they got to pick their spots. They got to figure out how they're going to go down the autonomous chapter. Do they eventually partner at one point with Tesla? I don't think that that's out of the realm, given where we see the autonomous world heading.
And Dan making some good points here. General Motors shares up about 56% year to date. Ford about 35% year to date. They're just coming off a big, almost $20 billion charge to their EV business. Dan, so on Palantir, I know you're watching this name. Is Palantir double next year? And if so, why?
I think it's $1 trillion market cap next 2 to 3 years. I think investors are underestimating how disruptive Palantir is on the enterprise. They've just started to tap into that market on the commercial business. So look, is it super expensive? Of course. But if you look at the next 3, 4, 5 years, like I view it as like it's going to be the next Salesforce, the next Oracle, however you want to think about it in terms of on the software side. And I think Karp's playing a different game. He's playing chess as a mastered wizard. And I think a lot of others are playing, checkers at the kids' table.
I'm loving this comparison, or this duel that erupted in the fall, Dan, between Mark Benioff and Alex Karp, kind of taking shots at the other out there in media and X, I believe. If Palantir is a winner, then is Salesforce a loser?
Look, I don't think Salesforce is a loser because I believe Benioff's going to be able to turn this around. Agentforce needs to be successful. They're probably going to have to do more acquisitions. But no doubt, look, Benioff, top of the mountain, the Hall of Fame, Mount Rushmore CEO. But for the first time in many, many years, there's, I won't call it a code red, but there's a threat to the business model. And I think they have to adjust. And that's why when you look at Palantir with no direct salespeople doing what they're doing, I think that it's a shot across the bow, not just at Salesforce, at ServiceNow, Workday, traditional software.
Dan, hit me with a tech stock you hate.
Look, Adobe's the one, I wouldn't say hate, but Adobe's the one that's probably under the most pressure, given you think about AI, what it's doing to their business model, what they need to prove. Massive success story, obviously, over the decades. But I think when you think about AI as a threat to a business model, I think Adobe, look, they're going through a turbulent little white knuckle period here.
Yeah, why do we're not going to be printing out PDFs anymore, right, Dan?
Look, they got to change, they're going to have to adjust and change part of their business model. But I mean, look, it's no different than Salesforce, no different than Workday. I mean, these are companies you either pivot or stay on the treadmill at 2.0 speed.
Lastly,
right?
Dan, this may be the last time I see you this year. And if it is, you've been traveling around the world all year, meeting with investors, covering this tech AI revolution. What has surprised you? Is there one thing that has absolutely blown you away this year?
Look, I think the thing that's maybe surprised me is just what I ultimately view as the enterprise adoption and how accelerated it's been. Go back to capex a year ago, right? Concerns about AI, big tech capex, and it's ultimately 50% higher than ultimately it was at the beginning of the year. I think that's ultimately the thing, that it's that acceleration that surprised me the most. And maybe the other surprise, obviously is, I was hoping for more from the Giants and Penn State, but what are you going to do? I mean, we got another year next year.
There's not much you can do, Dan. Sometimes we're just at the whims of bad decisions by our sports teams. Dan Ives, happy holidays to you, my friend.
You too,
Thanks for making time, man. Appreciate you.
Big picture, is your screening or kind of your framework changing, if at all, for 2026?
Well, I know I'm not the only one to say this. Hard assets, of course. I mean, we're seeing what's happening with the metals and how that's going to matriculate into other hard assets. I have not discounted agricultural sector, which has been under a lot of pressure, but yet we're seeing some nice moves this morning in soybeans, for example, sugar back at 15 cents. I think you have to keep your eyes on all of that. And you can look at DBA, which hasn't necessarily broken out, but has potential. Also oil. I mean, right now, everybody in the world seemed to be so bearish based on an oil glut, but yet here we are almost at $58 a barrel, not just because of the Venezuelan situation, but that could also wind up being more of a theme as the rig counts have gone down. And then beyond that, of course, Julia, I know we've talked so much about the vanity trade, but I still think that may be one of the hottest themes, and biotech in general, but looking at the diet drugs and looking at some of the consumer habits that occur because of the fact that there's been a lot of weight loss. I still like semiconductors and some of that space. I'm looking more into other types of more infrastructure aspect of that. I mean, you can't, of course, discount Nvidia, but even cloud computing coming in, or some of the other type of infrastructure plays like HUT, for example, or Teradyne. And then beyond that, really, I'd say those are my main, but robotics, I like Serve. Obviously, space now is back hot. And energy play, I think nuclear had a nice sell-off if you're looking at uranium, and that could come back as well.
A long shopping list for people to look at for next year. David, I want to bring you into this because I'm curious for you too. Are you is there anything that you're sort of adjusting in your screening process for next year, given what you're expecting?
Yeah, well, really what I try to figure out is where are the layup bets? Where are the things that are almost definitely going to happen because they're already happening? So I guess there's a few areas where I'm looking for that. One is these secular growth stories. It's a little confusing what's going to happen with the big picture, but an area like healthcare, for example, doesn't change as much with economies. So if you look at a company like an MEDP, for example, they're a CRO. They make it much easier for
CRO.
Yeah. So what they do at Contract Research Organization, they help biotechs go through the process of all of the FDA trials and facilitate those processes, and they do it at scale for many companies, which makes it cheaper, makes it more efficient, makes it just a much more efficient process. And it's a great margin business, and it can keep growing. So that's an area I like.
Gotcha. And then Transmedics is another one in that same, in the medical, obviously, category. Why that one?
Well, Transmedics is a really cool business, especially if they can accomplish their end mission, which is to create this end-to-end full ecosystem for organ transplants. Organ transplants had high failure rates. The transport hadn't been very efficient. Sometimes they just have to throw out perfectly good organs because they weren't transported in a safe way. They're building the whole ecosystem from point to point and making it a far better system. Their company is growing exponentially. Clearly, someone is willing to pay up for an organ that works and have their transplant work. It's pretty much, real life or death. So I think Transmedics could be a huge growth story over the next few years.
Yeah, it's interesting that you guys both have sort of medical picks, but in different areas. I mean, just one quick follow on Transmedics. The stock, doubled this year already?
Oh, yeah.
So I understand the appeal of finding something that works that you think will keep working, but at one point, does that sort of thesis get priced in, or do you get concerned about that?
When earnings don't keep up. But when you look at Transmedics, their revenue growth has been exponential, their earnings growth has been exponential, so it's actually not getting baked in the sense that they keep putting up consistent exponential revenue and earnings growth, and there's no reason to think that's going to stop as long as they can actually create that end-to-end system for organ transplants.
Gotcha. Mitch, I want to come back to you on one of your medical picks, which I believe AbbVie is one that you've liked for a bit here. That one isn't one, I don't think they're in the obesity game as far as I know. So what's the thesis there?
Well, twofold, really. They're not in the obesity game per se, but there is Botox, right? And that has become more and more popular and will continue to become more and more popular as a means to deal with skin issues that happen when you lose a lot of weight. So that's more in the vanity area, but it also obviously does a lot of immunology. So yeah, AbbVie had a really nice move this year in 2025 to the point of, can it go higher? It's been in this massive consolidation right now between 220 and 228. And I think this has a lot of potential to make much bigger highs as we go into 2026. And picking up on David's point, right, I like some of the other type of stocks that have done more antibody drugs like Replimune and also ADCT is another one that's working on immunology through antibodies, which is a different way to treat disease as opposed to just dealing with the symptoms of it. So all of these are very exciting for next year.
And Novo Nordisk is one that obviously that one is in obesity, very much so. But of course, it's sort of fallen behind Eli Lilly. So do you think this will be a comeback year for them?
Well, this is where I think, Julie, I mean, you can't deny the company has a real future, but you got to watch price on this, right? You look at Eli Lilly, well over 1,000. You look at this, it's hovering around 47, 48, can't really seem to get back over 50. So I think if you see a breakout over these more recent lows over the last couple of months, that is an indication that things are starting to improve.
And David, just finally to you, healthcare in general, do you think that, I mean, we've talked to a lot of investors who say they think it's going to come back and sort of outperform more next year. Do you share that broader view?
I do share that more broadly, but I think especially in healthcare, it's very important that you pick your spots because I think health insurance companies might be a bit under pressure. The benefits that they got from the enormous subsidies from the ACA aren't necessarily going to be there in the future, whereas these companies that are more the picks and shovels that facilitate the system of healthcare, that can pass through price increases for absolutely necessary mission critical services, I think those are the places you really want to own in the healthcare ecosystem.
Ted, always great to see you. So maybe start high level, Ted. we look at the tech sector, the AI trade and trend, as you know here, big winner in 2025. I guess now what, Ted? What do we expect in 2026? What do you think risk reward looks like given where valuations are at?
Well, Josh, Happy New Year, by the way, and thanks for having me. You asked the right question. And right now, I think if you look at 26, we're going to have a tremendous amount of volatility. The AI trade is very well understood, at least through my client base. You look at the infrastructure build really outpacing enterprise adoption. And that's the issue. We're going to spend at a 40% clip here for the next couple of years. The SOX is up, the semiconductor index is up almost 48% year to date. And if you look at the IGV or the software index, that's been the big laggard, only up 7.8%. So all I think of this is understood. As we look into 26, there's three issues that I'm looking at very, very closely, and we can go into that if you'd like to.
Yeah, I'd like to go into that. And maybe, Ted, on that point you just brought up, I just want to drill into that. This mismatch, as you say, between the data center build out and the real enterprise AI adoption. When would you expect, Ted, then to see that enterprise AI adoption story play out? Is that a 2026 story, Ted? Is it 2027? What do you think?
Right now, it's hard to nail down, but I don't think it's 26. The enterprise, there's only roughly 30% of the global 2000 that's ready to move to Gen AI. 70% is still going through data cloud migration and data cleansing to get into an LLM. So we've got, enterprise, it always takes so much longer than the street is looking at. That mismatch probably goes into 27, 28 is my guess.
And what are the signs and signals, Ted, as investors I would be looking for to say, okay, now we're really seeing AI monetization, not just AI marketing? I mean, am I looking at software spend? Am I watching the cloud businesses? Like, what should I be looking for, Ted?
I think it's well understood that the cloud titans are going to see it in token growth as well as just their overall cloud growth. Where I think it's really instrumental to see enterprise adoption is via your last few guests is in the software area, specifically on the agentic plays, whether it be, a CRM, a ServiceNow, a HubSpot, and then the whole security sector is moving to AI. I think if you see robust net new ARR, that's going to be a very good indication of enterprise adoption.
Another theme, Ted, I want your take on, what you wrote about was obviously, the massive capex by tech giants. But of course, we've seen these concerns creeping up, at least with some names, Ted, financial stress, debt loads. And I'm just curious how you're thinking through that dynamic.
Well, my clients do not want to play names that are negative free cash flow. This is one of these cycles because of this mismatch in infrastructure. It's very capital intensive on this infrastructure build. So the only real names that really have the businesses behind it to really fund the capex is Microsoft and Google, and that Google's up 87% year to date. So with that, I think there's a propensity to just watch and have some dry powder. I don't have a lot of interest in some of the negative free cash flow names at this point. And it's obvious, I think, as we go forward that you're getting indications that whether it be Anthropic or whether it be OpenAI or SpaceX, that the debt market is tapped and it's not big enough, quite frankly, to fund the infrastructure build. So all of these next generation companies are going to have to tap the equity market. And my worry there is very simple. After doing this for a few decades is when you have 4 or 5 major tech companies that have to raise just a boatload of capital, OpenAI has been rumored $100 billion. My worry is that we get some time in 26 where all these guys come public at the same time and we drain, quote unquote, the equity liquidity lake, if you will. And my PMs are going to be forced to sell some of their winners to fund some of these positions in these new companies.
Another theme you call out, Ted, rising component costs, memory, networking. How concerned should investors be about that, Ted? What could that ultimately mean for margins, for end demand?
That's $1 million question right there. I think it's under everybody's radar screen. I listen to over 70 conference calls during an earnings season and try to stitch together tech. And for some reason, this is under the radar screen of most. And if you look at the Micron report last week, DRAM, which is really the high performance bandwidth memory that goes into data centers, that ASP, their ASPs were up 20% sequentially for DRAM last quarter. That's a lot of pricing leverage, but in my career, I've not seen ASPs up this amount. Then you listen to the Dell call, and a lot of people are not out of their silos. They need to look at tech from a broad sector standpoint. The CEO of Dell basically, in a nutshell, said, I've got enough components for Q4, but I'm going to see shortages and I'm going to have to raise prices because of components. I think where the street really needs to now focus on is names like in the PC supply chain and the handset area. They're just not going to be able to get a lot of required memory for their products because the AI spend is so dramatic. Now, with these prices up, I think you're going to see a lot of elasticity of demand.
Finally, Ted, I want to just switch gears here hard. But given your background, Naval Academy, naval aviator, Ted, I thought of you when I saw this. I just wanted your take on this news. Chinese government sanctions 20 U.S. defense companies. And apparently, Ted, this is retaliation for Trump's, I guess, approval of weapons sales to Taiwan. I'm just curious, given the background, what do you make of that headline? I mean, American defense contractors not doing a ton of business, of course, in China. So what do you make of it? What was the point and purpose of that, do you think, by Beijing?
Well, the street discounts the whole geopolitical area, which is really a red herring going forward into 26. If you look at the China and U.S. relationship, if you don't get AI right, you're gonna risk your economic development and defense. The defense area is all pivoting, whether it be drones or related AI weaponry. The defense budgets are shifting very, very quickly on a dime to AI. So when we look at this sanctioning on both sides on entities that they view as competitive, this is really economic warfare at its best. And it's discounted. It hasn't mattered in years, but it's going, as we really go on a collision course with the overall China economic and defense standpoint, I think it's going to become much more of an issue in 26 and 27 if it gets out of hand and we don't go back to kind of this mutual assurance on the trade side. Unless we can find a happy medium, we're going to be entering some kind of new Cold War.
Ted, we're always so lucky to have you on the show. Happy holidays, my friend.
Yeah, Happy New Year.
Keith, I've been watching really all day long, actually since yesterday, I should say, this Nvidia deal for Groq. And if you zoom out, I think it says so much about the mindset of companies and how the AI bubble, it may only be just beginning, despite all this AI bubble talk.
Sure, Brian, and thanks for having me. We're looking at it in a similar fashion. It's not necessarily a bid for a competitor. It seems like, and this is kind of what we've gathered from it, is it's a investment into capacity expansion beyond the current GPU platform that Nvidia currently has. It's an investment alongside of a competitor, in not only in the vertical they're in, but also looking at it from an aspect of just a capacity growth that seems to be, this is a positive affirmation of that capacity growth that grows beyond what Nvidia currently has in their vertical. So this is, in our opinion, a very positive checkpoint for where we are in the cycle. There's a lot of questions about where we're in the cycle and infrastructure build and is it overpriced and have we gotten ahead of ourselves. Nvidia, with this investment, in our opinion, is saying no, we haven't. I see a lot to come in this investment phase.
And I got to give a shout out to one of my ex-followers here, watcher of the show, Sideline24. One of my resolutions, Inez, was to go out and visit an AI data center. This user telling me they have, he's working on a project out in Arizona to build an AI infrastructure plan. So it's fascinating to see what's happening in this country because of AI. And as a question to you on this, which I haven't seen brought up a lot on this Nvidia-Groq deal, was Nvidia potentially at risk at losing its number one spot, not today, not tomorrow, but let's say 5 years down the line to a company like Groq, and they figured, why not just pay big now, shell out a big check, and then nobody can touch us?
You know, Shazi, I was listening to an investor of Groq on his channel about why this is so interesting. And this is basically what he was saying is that NVIDIA is seeing the writing on the wall when it comes to specialized chips, because you played that sound of Jonathan Ross talking about the inference technology that they have. And this is where some are seeing that where the money is at with these specialized chips, and why NVIDIA would pay 3 times the value of this company. And by the way, Jonathan Ross is seen as an engineering genius within this industry. So yes, it may be that the NVIDIA chips, which are generalized chips, which are good at many tasks, are great, but now where the money is being seen going forward, where the reoccurring money may be, is in this specialized chip space. And that's why they are essentially buying this company in this deal that, by the way, is this licensing deal, which is an interesting also format for these. Now we are seeing more and more of these types of deals where the talent goes to now NVIDIA, where the company is still sort of more of a shell company, and this is because of antitrust issues to make sure that this goes through. But yes, Jensen Huang may be admittedly saying we have a great chip, but now we are now acquiring this specialized chip with Jonathan Ross, did the TPU over at Google. So it's definitely seen as where the market may be going.
And I should mention, reach out to Groq. They declined to make Jonathan available for an interview. Keith, let me get back to you here, because really next year, you're starting to get the sense, if we haven't gotten it already, some of the world's largest tech companies might go hunting in private company land. You know, the companies that have been raising money all the past 2 years at big valuations, they may go shopping to further boost, their capabilities. What do you think about that?
We absolutely think that has to happen in order for the story to continue to evolve beyond where it has started with the quote unquote picks and shovels over the last couple of years. We feel like to justify the valuations, the story has to continue to evolve in the spaces that we just haven't really grasped yet, in particular on the private market side. But we've seen some developments on the private credit side as far as the funding that have drawn some questions as to kind of how far this can go and how it will be all capitalized. So in 2026, the story has to continue to evolve away from some of the main culprits of the last 2 years into spaces that the market really hasn't appreciated the AI story to evolve to just yet. So we're looking for that evolution, and we feel like it has to come to justify valuations going forward.
Keith, how willing would you be to get outside of the Mag 7 and some of these big tech plays and get involved in the broadening out of the AI trade? And I'm even talking about something as companies that make concrete, companies that make steel rebar that are helping build these, put up these AI data centers, electrical power companies. Are you comfortable taking it to that level yet?
Sure. In our equity strategies, we've been taking it there for the last over the last year or so. Yes, we're looking at spaces, particularly in industrials, in that also in the utilities as well. Ancillary plays to the AI adjacent names and stories and industries that benefit from this build out, which might not have as much built in their valuations, also might not have as much debt or risk associated with this current trade. So we're looking at all those spaces that we can have a cheap entry into investing in this next phase of the build out that we feel like 2026 is really going to start to embrace more outside of the Mag 7. So we're absolutely been looking in those spaces.
Maybe we'll start at a high level, Brennan. You think about that U.S.-China relationship. I'm curious, Brennan, as we now roll into this new year, into 2026, over the next 12 months, Brennan, how do you see that relationship evolving, Brennan, and what do you think it means for the Chinese economy, Chinese equities?
Yeah, I think first and foremost, happy holidays, Josh. Thanks for the opportunity. I think 1.4 billion people in China wake up every day not thinking about the United States. They're waking up thinking about China's economy, and I think They're going to take the lead off. We've got the draft of the 15th five-year plan was released in October, really emphasizes domestic consumption and technology self-reliance. That's been followed by the Central Economic Work Conference, as well as more recently, President Xi released an article in a magazine talking about domestic consumption. So we as investors, we know, similar to investors in China, that's the two areas we really want to be focused on in 2026, domestic consumption and technology.
Let me ask you about the K-Web, Brennan. So we're up around 20% this year. How would you generally characterize valuations here?
So the K-Web companies are really offshore Chinese. So these are Chinese technology companies listed in Hong Kong. Those companies are very, very undervalued relative to their U.S. counterparts. These are companies like Alibaba, Tencent, JD, Meituan, Trip.com, etc. So we still think there's a real value opportunity in these technology companies listed in Hong Kong. That is going to be somewhat dependent upon foreign investor flow, something that we've seen start to percolate in 2025, which we think will continue next year. Based on some of the things you've been talking about, weaker dollar, that's kind of forcing some foreign investors out of U.S. equities potentially into growth stocks listed in Hong Kong like we hold in K-Web.
Brennan, there was this new report in the Journal. I want your take on it. I don't know if you saw this one. I'll read you the headline. It said, China's sprint for tech dominance can't hide an economy full of holes. The article is about how China is closing the gap with the U.S. for global tech dominance, Brennan. But the Journal goes on to say here, big parts of its economy are a mess. Their words. Curious just to get your take on that, Brennan. Does that kind of align with your view?
Not necessarily. I mean, I think no one's going to say that it's all rainbows and unicorns in China today. At the same time, they're growing at 5% GDP growth, so it's not all bad either. As well as I think, Josh, if you think about this narrative that China's going to fall off a cliff, I mean, how long have we been hearing that? I mean, how long have we heard China's about to invade Taiwan? I mean, Taiwan, it's been 76 years. That's 27,740 days China's not invaded Taiwan. So I think at some point, investors need to become a little skeptical about some of this always negative media reports and basically look to resources more data-driven like we tried to provide here at Crane Shares.
Would you expect next year, Brennan, do you think that the CCP, would you expect Chinese authorities to offer and inject more stimulus into that Chinese economy next year?
I think we'll continue to see targeted stimulus. We're not expecting any bazooka-style stimulus like we saw arguably in September of 2024. But I think you're going to continue to see support for around domestic consumption. They do a lot of subsidies. They obviously want to avert a housing crisis, so a lot of attention played there. But then I also do think maybe a little bit of a sleeper is, could we actually see better U.S.-China relations with a Trump-Xi summit coming in April, as well as the APAC conference is actually going to be in China in the fall of next year. So you arguably have multiple opportunities for Trump and Xi to meet. And I just really believe that maybe the market underestimates the potential for better U.S.-China relations.
Why, Brennan, speaking of U.S.-China relations, why do you think Trump decided, you know what, he's going to allow Nvidia to export those H200 chips to China? I mean, was it because, okay, Uncle Sam's going to get a taste, Brennan? Is it because Trump thinks, hey, for now at least, Xi has leverage when it comes to rare earths? What's the reasoning there, do you think?
I think President Trump, he's not a career politician. He's been a business person. And I think he looks to corporate leaders as almost like a shadow cabinet, where I think he wants to meet and hear the views of, if it's Tim Cook or Jensen Huang or other corporate leaders. As we've seen earlier this year, that after the CEOs of Walmart and Target and Home Depot met with him, the tariffs were kind of de-escalated. So I think President Trump is unique in that he does listen to corporate leaders, and I think Jensen Huang, arguably said, this is really, really critical for Nvidia. But at the same time, I also think Chinese companies want Nvidia chips. So why would you turn your back on that revenue opportunity?
Well, and here, Brennan, on this great AI race, AI hardware, AI software, Who, in your opinion, Brennan, still is in pole position, still is in the lead? Is it the U.S.? And if so, how long do you think?
I mean, certainly, using Nvidia as Nvidia is very, very far ahead of its Chinese equivalents. So I don't think there's any catch up on a Blackwell-like chip coming from a Chinese competitor anytime in the near future. I think the two countries and really ultimately the underlying companies are looking at AI very differently. In the US, it's really about an enterprise sale from Anthropic or OpenAI, really. In China, the large language models, those are open source. They're literally basically free. There's no moat to a lot of these large language models in China. Where the revenue is coming in is going to be on the cloud computing, and that's where Alibaba, Tencent, and Baidu really are going to be the main beneficiaries of AI via cloud computing.
Brennan, always great to have you on the show. Merry Christmas.
Yeah, likewise, Josh. Thank you so much.
2025 turned out to be quite the milestone year for Apple, and despite some turbulence, the tech giant has set itself up for its biggest change in years. Yahoo Finance's Dan Howley joins us now with Dan.
That's right, Josh. This was a huge year for Apple. Not only did they post record revenue, they sold their newest iPhone, seeing huge numbers as far as sales go so far. And oh yeah, they hit a $4 trillion market cap, the only other company to do that, Nvidia. And they're, kind of playing a little closer to Nvidia now than when Nvidia was at $5 trillion. But what's a trillion between friends, really? Some of the things that the company did, though, really didn't have to do with one of the biggest issues that they have, AI. That seems to be pushed off until next year. They did have their head of AI retire. They're bringing in more folks. They did see a number of other C-suite retirements, whether that was their legal counsel or their head of government affairs. And it seems as though, for the most part, what this is doing, as far as the year goes, is teeing up for a post-Tim Cook Apple. Now, there was that Financial Times report a month ago basically saying that Cook was ready to retire sometime in early 2026. Then Bloomberg's Mark Gurman said that's not exactly the case. Regardless, he is approaching retirement age. And so the company is clearly thinking about what that would look like. And so they've reportedly been grooming John Ternus, one of their VPs of hardware engineering, to be the next CEO. He's the top contender. Doesn't necessarily mean he will absolutely be the next CEO, but he's being kind of groomed for that position. And really, Apple kind of giving us a sense of, this is going to be a transitional era, and this is how we're going to handle it, kind of piecemeal. As people kind of take off, we'll fill in those slots, but it won't be kind of a all at once approach. And for a company like Apple that's remarkably stable despite being so large, it can feel a little odd seeing so many departures at once or throughout the year. But the experts that I spoke to say this is really the best course of action for this company.
Let me ask you, Dan, Apple's engine's still the iPhone. In 2026, what do you think innovation is going to look like there? What could we expect? Is it form factor changes? Is it foldables or revamped Siri? What do you think next year Tim Cook has to introduce to keep that engine humming?
Yeah, I mean, the big rumor is that there'll be a foldable iPhone for 2026, and kind of the iPhone Air was seen as kind of teeing that up. Showing off that they can put the goods inside of a smaller package. There's been different reports saying that the Air hasn't sold as well as the Pro or the Pro Max or the Base 17, which is a remarkably good phone for the price. But it appears as though that is what the Air was, kind of an appetizer almost, and the foldable will be the main course. Now, there's been obviously Samsung with their own foldable phones over time. They have their Fold 7, which is an incredible phone for what you get. It is priced relatively high, and you can imagine that a foldable iPhone would probably have the same kind of price premium. So, for the iPhone itself, that's kind of what we're looking for in 2026.
Dan, great to have you as always. Thank you, sir.
Thomas, what has surprised you this year on the AI trade?
Well, I'll tell you, Brian, it wasn't a surprise for us, but I think it was a dramatic surprise for the market and may still surprise some people when they hear it right now. The number one performing AI stock for 2025 was not Nvidia, it was Intel. Intel was up as of yesterday 81.4% year to date.
Intel's still around, Thomas. They're still around. They still do business.
They still do business, and the world, all of the chip designers are dramatically dependent on them succeeding in developing advanced chips. And the US government is standing behind that because we don't want to be dependent exclusively on Taiwan Semiconductor. So Intel was the number one chip and hyperscaler, followed by AMD. So Intel was up 81%, AMD up 77%, Nvidia up 36%, not bad, but less than half of the returns of Intel. Microsoft only 15%, Apple 8%, Amazon 4%. So I think people were a little surprised that that the most popular names were more subdued than expected. And I do think that theme is going to persist, but we'll get to that.
Angelo, hit me with a surprise. I think that Intel move, the fact that it outperformed Nvidia, certainly has surprised a lot of folks. What's been on your radar?
Yeah, I think one thing that may surprise many of your viewers is that valuations for the tech sector are lower now than what they were at the start of the year. So basically what has happened is that earnings have been growing faster than prices. So that pushes back against all that AI bubble narrative, because it is really earnings that have been doing the heavy lifting for the tech sector. And that, I think, is a comforting message. Yes, tech is the most expensive segment of the market, but it has been able to deliver earnings, solid earnings. And what has happened late in the year is probably a healthy pause, but the AI theme is likely to continue.
These are the surprises I needed. Tom and Angelo, you have clearly brought your A game here on Christmas Eve. Tom, back to you. I think Angelo makes a very good point on valuation. So, question to you: are AI stocks still cheap then?
I think that we have to be a little bit careful as we look into 2026. I think the theme is not going to be the AI stocks or the AI cost centers, rather, when we think about hyperscalers and some of the chip names. The theme for 2026, and the biggest surprise, is going to be AI beneficiaries, those that are implementing the technology into their businesses to improve productivity, to improve margins. And to Angelo's point, earnings have grown. But if we look out 3 quarters, it's expected that the earnings growth rate of the Magnificent Seven relative to the earnings growth of the unmagnificent 493, we could say cost centers versus AI beneficiaries, is going to converge, meaning the unmagnificent 493's earnings growth rate will be equal to or greater than the Magnificent Seven earnings growth rate by the 3rd quarter of this year. And that's why I think we're going to see, as we see in midterm election years, the indices a little bit more subdued, a little bit more choppy, a little bit more volatile, because the biggest weights of the S&P 500 are probably going to take a breather or consolidate their gains as that earning growth decelerates. The other thing that we have to keep in mind here, Brian, is that capex as a percentage of operating cash flow now for the hyperscalers is exceeding levels of big oil. Greater than 60% of operating cash flow is now going to capex, and that's part of the reason that that growth rate is declining. And I think we're going to see a lot of money made under the surface in individual stocks, the AI beneficiaries, and maybe more subdued returns again from the AI cost centers, aka hyperscalers, and the stocks that most people are crowded into at the moment.
Angelo, talking about subdued returns, this year hasn't been a great year, relatively speaking, for Meta and Amazon, but Amazon in particular up only 5%. I mean, that's an ugly performance versus the S&P 500 and the rest of the Mag 7. If in January, would you be inclined to buy these AI laggards like a Meta and Amazon?
I think our call for next year is rotation both within tech and outside of tech. It is interesting that 4 of the 7 Magnificent Seven names have lagged the S&P, but that's followed multiple years of very strong outperformance. So I think some of that rotation is healthy. We are seeing potentially the early stages of the move from the companies that really enable and facilitate the build out of AI towards the companies that are adopting it. And I think that's going to include a broader set of opportunities for investors. And that is beyond tech as well, thinking about industrials, healthcare. These are some sectors that we see potential benefits flow through. But I think the name of the game is diversification, not concentration in 2026.
Tom, tell me if I'm totally off base here. So you have the Fed cutting rates. Maybe they come in with one more rate cut early next year. You have a whole class of people that have been making bank off of CDs, low risk investments. Are they now forced back into this market to earn a good return?
They are forced back into the market, but guess where they're forced back into is probably one of the most unloved areas of the market. As a matter of fact, dividend payers are the most out of favor and lower relative valuation than they've had in 25 years.
That makes no sense to me, Tom. I mean, we're supposed to like dividends. We're supposed to champion dividends. We want this check coming to our mailbox every quarter.
Well, there's no question. And exactly to your point, as the Fed cuts and that free interest payments on those money markets goes down, they're going to be forced to find the yield elsewhere. That's going to be dividend payers. Now, what is dividend payers? Where do you find the dividend payers? Well, you tend to find them in defensive stocks, consumer staples, healthcare. Some of the stocks now, if you look at healthcare in particular, lowest weighting in the S&P in a handful of years, lowest relative valuation to the S&P in 25 years. I would say right now is a generational buying opportunity in the healthcare sector. Oh, and by the way, in midterm election years, healthcare dramatically outperforms the indices. Since 1950, the S&P tends to be more subdued in midterm election years, about 2% returns. Well, guess what? Healthcare does over 9%. And the last 3-4 years, you couldn't give healthcare away. So expect good things from healthcare for a couple of reasons. One, the dividend yields. 2, it tends to do well in volatile periods. And 3, I think it's going to be one of the major AI beneficiaries, not cost centers, AKA they're going to use AI to lower costs, increase productivity, and in a material way in drug development. So healthcare is the name of the game for 2026.
Angelo, next year, is that the year of the dividend?
I think it can have improved performance relative to the other years. We like mid-caps as well, thinking about asset classes. Mid-caps, some international, still emerging markets. We talk about AI and technology, but there's a lot of innovation also happening beyond the US borders. And as you talked about the Fed and slightly cutting interest rates next year, that gap now between cash returns on CDs, money market funds, and either you talk about fixed income or dividend-paying stocks, that gap is going to widen. So we could see some rotation out of heavy excess investments for many investors into cash towards other asset classes.
Tom, real quick, do you chase gold here?
No, we like productive assets, but just to jump on what Angelo said, he pointed to mid caps. Well, look at the earnings expected growth rate of the S&P at 14%. How about small caps? Expected earnings growth of 55%. They're just coming off the mat. I think you can get a lot of bang for your buck in 2026 in small caps as well.
Circular financing. It's a fancy way of saying OpenAI is at the core of most big AI deals. That means the pressure is on them to deliver on their bold ambitions, or it could put many tech companies at risk. Today, my Power Player segment is John Chambers, JC2 Ventures founder and CEO. He's also the former longtime Cisco CEO. John, good to see you. Always a treat. It's been a while. Welcome back. So let's start. You know all these players in the tech industry. I want to start with Oracle for a second because they report earnings. You know this company. You remember them from decades ago when you were competing with them in some capacity. How important is an earnings report from an Oracle at this stage in the AI trade?
So, Brian, first of all, it's good to see you. A little bit of report before we jump right in. I miss being on your show and look forward to seeing you in New York. In terms of the major players, whether it's the Magnificent Seven your prior guests talk about, or Oracle, Broadcom, obviously I'm not referring to the quarter at all. I tend to think for the year and 2 years out. I've learned a couple lessons. You never bet against the Fed. If it's lowering rates, you're probably going to see an up market. And don't bet against Larry Ellison or Hawk. And both of them, I think, are tremendous leaders. In terms of the players I love in this area, I like what Google's doing, and probably they've improved the most in the last 6 months on their hand. And then Microsoft, Satya's doing an amazing job. And then I like Lisa at AMD in terms of that group that I think are really making a difference there. But indications of what you just said, I would not look at one company as the bellwether. In the internet, that was fine, where Cisco had 50 or 60% of the business, and we often had the vast majority of every product category. But if you watch what's going on today, whether it's in semiconductors, whether it's in the software, the models, etc., you'll probably see a couple of the Magnificent Seven stumble over the next year or two. And I hope the market doesn't overreact to that. I think you need to look at the balance of the group. The balance will be up. But I think whether it's the Magnificent Seven or startups, you're going to see that mid-level group, several of them fall out at a fairly rapid pace, especially some of the smaller companies.
Who do you think stumbles, John?
The ones that I like to bet on Microsoft and Google. I think they're positioned well in terms of it. Nvidia, Jensen's a machine. So those would probably be my three that I like the best.
I have never seen a backlog like Larry Ellison has at Oracle. I think it was $455 billion. But the stock has been under pressure because of fears that they can't actually service that amount. If you were the CEO of a top of one of these large AI companies right now, John, how would you finance some of these big deals?
Well, I think the money's there as long as the market sees it. Financing in today's world, the market, if they really believe in your strategy and the implications of it, the financing's there, and that includes for venture capital and startups. Financing, if you haven't got a good plan or concern, it can be a little bit more challenging. But the AI play, I believe, is real. I do not believe it's a bubble. I think there will be people that trip within that, and there'll be some train wrecks. But the AI play, we're just getting started on. I think 2026 will be a great year for AI. Productivity will grow faster than almost anybody realizes. I think the market's underestimating that on earnings. And I think many of the CEOs are just getting started on how they're going to use AI in a major way. It doesn't matter whether you're in retail like a Walmart, or an automotive like a Ford, or in healthcare or government. You're seeing AI benefits start to occur real rapidly. It used to be just in coding and customer service. Now it goes across all functions. So I think this is a decade-long phenomena, and I like the play of taking the top players, bundling them together. I personally like the hot startups, the companies I've been fortunate enough to be associated with, very much like what KR is doing at Bloom Energy, or what Bipple is doing at Rubrik.
Yeah, I just talked to Bipple last week. I mean, another big quarter from them, big IPO too. What, everything I've heard the past month, John, everybody's been so enthused with Gemini 3. And look, I mean, it's a powerful model. What Google has done over there has been tremendous. But is the market now underestimating the potential for OpenAI? I mean, this company has huge, lofty ambitions over the next decade. They have a lot of commitments out there. And if they don't deliver, I mean, it's just not good for the tech ecosystem.
Well, first of all, I think it's very healthy to have two at least, and you prefer three players in a category. I think both those companies are going to do very well. I've been really impressed at how Google has moved, as I alluded earlier, in the last 6 months. And what you do with OpenAI, I actually did my 10 predictions for this year, and I didn't use any of the AI tools, but I went out and asked the questions on each of the 10. What did ChatGPT say, and what did Gemini say, and the odds of me being accurate on it. And then I said, what is the one or two area on each of the predictions you think that I'm most exposed on? The answers were amazing. So I think you've got two great tools. You're going to see people move back and forth in terms of utilization of them. And I think both of them are going to do fine. But again, just starting to see early innings of what this is going to produce.
Are you concerned that OpenAI is at the core of so many big deals? I mean, you mentioned AMD. I mean, they had a big deal, and OpenAI might be an investor with them looking out over the next 10 years.
Well, if you watch, what I think we've seen this time is normally the large players do not participate in the next generation of market movement. That was true of IBM, mini computers, client servers, the internet, software service, the cloud players. This time it's going to be exception. They're going to be there. And if you watch the model that we did at Cisco in the very early 90s, you do it yourself. You do it through acquisitions. I did 180 acquisitions, or you do it through strategic partnering. So I love the strategic partnering that many of the companies are doing. And actually for my startups, whether it's Nvidia or whether it's AMD or others, they're investing in the startups because they're driving their own core business, the implications. I think it's a very good strategy. It does show that if one company trips a little bit, it'll affect others. But I think in terms of accelerating the market, it'd be what I would do if I were in their position. And whoever wins the AI battle as a nation and as an industry will lead GDP growth, standard of living, et cetera. So I think it's a national priority, and I like it a little bit. It would be an understatement. I like their strategy. Do it yourself, acquire, strategically partner, invest. I think it's just smart.
Marianne, always a treat to get some time with you here. Take us through your thesis on tech stocks.
So they're still the leaders of the market. I still see them leading, particularly the semis. The semis really are the true leader of the secular bull market. But in our work, what we're seeing is that they may take a pause, or the word that we're using is a reset. Now, if you look, for example, at an Nvidia, it made a new high, but it was not able to hold its new high. It's been in a trading range for months. Now, either we're going to stay in that trading range or we'll get a pullback. And even if you look at the semiconductor ETFs, they're trading the same. So I think the leadership of tech takes a break. I do think we're going to get a pullback, a correction. But I'd be a buyer on the correction. Again, I still see them as leaders. But that's going to lead to volatility in 2026. And it's the midterm election year, and it's very normal to have volatility in a midterm year. So I'm just telling our clients to brace for volatility, to be fearless. You don't have to trade these. And if you don't own them, or if you want to add to them, you're going to get an opportunity in 2026.
Marianne, do you see that reset happening in the first quarter? And if you do, what is that? What triggers that moment?
Well, I think you're already in it. I think it's already started. And we got a really strong GDP report, and the market's not going to now like rate cuts. So, I think you've already started part of the volatility that we're going to see in 2026. So the other concern I have is earnings have been spectacular. And analysts didn't see the earnings right away. At least not all of the analysts saw the earnings right away. And now everybody seems to be on board. In general, the market is looking for earnings to grow 15% next year. And the market, maybe earnings can be up 15%. But if we don't meet expectations or the whisper numbers, the market is not going to like that. So I think that's another big hurdle that we're going to have in 2026 is, can we beat these now high expectations in the earnings forecasts?
You've been bullish, Marianne, if I'm right, semiconductors since 2012. How is covering this space and picking stocks in this space different today than it was in 2012? Outside of just the valuations, of course, are a lot different, I'm sure.
Well, when I first started to like semis, there was no theme. Certainly not an AI story. So now we have a theme. Now we understand why semiconductors are no longer commodities, and they're a growth story. So that's probably the big difference, is now we have a major growth story under AI. And, Nvidia has, basically rewritten the path for semiconductor chips and the whole stack build out. And yes, you're going to have ebbs and flows. Stocks are going to go up, stocks are going to come down. But in general, I see tech leading this rally, and particularly semiconductors, out into the end of the decade, into 2029, 2030. And that would target the S&P up around 10,000 to 13,000. So again, that's why we're calling 2026, to be fearless, that there's still significant upside in this market, particularly for technology.
So you don't see an AI bubble?
No, I don't see a bubble at all. However, I do believe we're going to be going into a bubble. We've compared this market to the late 90s, 2000 period. and the bubble that we had in the 20s, in the 1920s. And we're tracking pretty similarly. In fact, it's kind of eerie how we're actually tracking that pattern. So I see a bubble occurring, but not out until maybe 29 into 30.
You know what I find eerie, Marianne? If you're right on the S&P 500, it hits 10,000 or over, whatever it is, do you think it will be still concentrated in these 7 Mag 7 names?
The way the market is trading now, I would have to say yes. What the market really needs is for companies to become public. And that's been one of the big changes to our market is companies are staying private longer. And that's really changed the structure of how many companies that we have in the public markets. When I came to Wall Street, there were over 5,000 listed stocks on the New York Stock Exchange. And that's almost now contracted to almost half of that. So it's pretty scary in the sense that we don't have as many. And that's not allowing the markets to broaden out, because even though we have concentration in what we call Mag 7, you have concentration in almost every sector of the market. So it's the structure of the market has dramatically changed since I first entered Wall Street.
It sounds like you're still longer term bullish on semiconductors. If that's the case, and we're going to continue along this path of the AI revolution, what does it mean for software companies? I just had Dan Ives on with me a couple minutes ago. We were talking about software, Palantir, Salesforce. How are those big cap tech stocks that are not in the Mag 7, how are they impacted by this?
Well, it's kind of interesting because originally when I came into this year, I thought software could do well, and then all of AI happened, and then software has lagged. And I think software has to learn how to play in this new AI world. We're always going to need software. So I don't think it's an end of an industry, but they may have to up their game to play in an AI world.
Lastly, Marianne, I'm asking all my guests this week, what has been your biggest surprise in markets this year?
So I was bullish gold coming into the year, and I did have a 4,000 target. Now I'm not trying to pat myself on the back, but to be honest, I didn't necessarily think we would hit 4,000 this year. So what has really surprised me is not only the move in gold, but how now silver has broken out to a record all-time high and is in a new secular bull market. Copper has broken out to an all-time new high. We're seeing the whole metal space break out, and that has become extremely bullish for the metal stocks. And that is probably one of the biggest surprises. We now have metal stocks in a new secular bull market along with the metals.
All right, we'll have to leave it there. Marianne, big longtime fan of your work. Thanks for always making time for Yahoo Finance. Happy holidays.
Same to you.
So before we get to 2026, Joseph, obviously you want to talk about your outlook there. Let's just take a beat on 2025. What do you make of the year, Joseph? What did you learn?
Well, it was another great year. Averages now had 3 fantastic years in a row. I think that obviously the prevalence of AI, not just of the AI beneficiaries, but the spread of the impact has been enormous across the markets. And clearly that's been the dominant theme. Who are the winners? Who are the losers? Losers have obviously had a very tough years, and the winners have been fantastic stocks.
Let's talk about what's ahead here. With the SPX, if you look under the hood, it sounds like, Joseph, you're bullish on the 493 instead of just focusing on the Mag 7. Let's start there. Explain that. I mean, is that valuation, Joseph? Is it earnings growth, positioning? Explain it.
I think that there have been a number of businesses in the Magnificent 493 that are perceived as being hurt or compromised by the growth of AI. Valuations have gone significantly lower for a number of those companies, and businesses that are just not participants in the opportunity of AI have also not performed particularly well in that bucket of the Magnificent 493. And I think in 2026, what we're going to find is that many of these companies are harnessing AI to get better, to lower their costs, to improve the velocity of introducing new products. And those businesses will begin to get the benefits of that as people recognize it. It hasn't happened in the last couple of years, but I think we're going to notice that in the next couple of years.
Well, what does that suggest, Joseph, about what do you think I do with the Mag 7, though, in 2026? Am I avoiding those names? Am I trimming exposure? Do I have to be more discerning? Maybe next year, Joseph, it's more like, the Mag 3 or 4.
I think so. I think the Mag 7, it's tough to paint them with a broad brush because each one of them has a specific story associated with them. But I think just from a valuation perspective and the fact that they performed so well for such a long period of time, I think that some of them will take a break, some of them will perform well, but really the opportunities for outsized returns next year are going to be outside of those 7 businesses.
There was a story out there, Joseph, sort of a narrative that had built that, well, the AI trade and trend had better stay intact. If it doesn't, the market's going to come off its wheels. But having said that, I mean, recently you can look at, some poster childs of the AI trade. I think of an AI heavy name like an Nvidia. It's well off its 52-week high, Joseph, but this market has continued to grind higher. I'm just curious what you make of that.
Well, I think that it bolsters the thesis that the 493 certainly have legs. And I think more broadly, the economy is stronger than people thought it would be when we started the year. Rates are probably lower today than where we thought they would be. Inflation is probably a tick lower than we thought it would be. So the underlying conditions are somewhat better for the broad market, and the broad market has been able to weather, as you talked about, the bumps in the road that are inevitable with regard to the Mag 7 and the AI trade. So I think it's positive for the index as we enter 2026 that we've seen some level of broadening. And obviously we see opportunities in the defense sector, in healthcare, and selectively in technology as well as this rally continues to broaden.
Yeah, let's get to some of those specific names and picks, Joseph. You like Broadcom here, for example. How come? What do you like about CEO Hock Tan's company specifically? Is the business model, margins, his AI story?
Well, our strategy is to invest in recurring revenue businesses, and Broadcom has one of the great technology recurring revenue businesses. When you think about how they're positioned with regard to AI, they're really very, very well positioned in a category where the product, the GPU, is 90% of the cost of the solution. And Broadcom with their XPUs is dramatically reducing the cost of effectuating the outcome that AI provides. And so we think that they'll continue to take market share among the hyperscalers, which is going to drive fantastic revenue growth in the AI business. We see the AI business doubling in 2026 for Broadcom, and we see it growing very, very rapidly after 2026. So long term, they're very, very well positioned with a product that is highly efficient for the customers.
And Joseph, you also mentioned you like healthcare. At a high level, what do you like about that sector, and what, in your opinion, is a smart way to play it?
Look, healthcare has been out of favor for the last 3 or 4 years. Healthcare spending peaked in the pandemic, and a lot of demand was pulled forward for the businesses that we like. And those businesses tend to be the recurring revenue tools providers to the healthcare industry. Think of Thermo Fisher, think of Agilent, Mettler Toledo, provider of products into medical labs. And so those businesses are beginning to see better demand, and it's slowly getting better for those companies. And generally speaking, when things get better in healthcare, they stay better for a long period of time. So we see a very long-term growth opportunity among most of the healthcare industry, but particularly in the medical tool space.
And finally, Joseph, you mentioned you like defense. Now, President Trump, you saw this. He's been making some headlines there saying he wants these companies focused more on spending on new plants, not buybacks. Walk me through why you like defense, Joseph, and what, in your opinion, are some smart ways to invest in that sector.
Well, the big picture trend in defense is that European NATO spend has to go, basically is going to triple over the next 10 years. And so we're thinking about which businesses are going to benefit from that multi-year trend of growth in that end market. And so what we like are the recurring revenue aftermarket providers of parts to the defense industry. So we own HEICO, we own General Electric, and TransDigm, and all of them will be benefiting. All of them have about 40% of their revenues tied to the end market. All of them have very, very strong recurring revenue business models, and they're very well positioned for a number of years to benefit from that what we think is a very long-term and durable trend.
Dryden, it is always great to see you. So let's start with that CPI print today. I'm interested, Dryden, what do you make of it? What do you think the Fed makes of it?
Well, I think it's good that we're beginning to see inflation come down as things are working their way through the economy. Everybody's been a little hypersensitive to that. And so now we're getting some data. Now people discount some of this data because they're saying, well, the shutdown, we don't really know. But I think what we're seeing is inflation's cooling. That gives the Fed the ability to look at that fourth cut. Right, we were at 5.5, we went to 4.5, 4.5, now 3.75. Let's get down to 3.5. That's going to be a 20% plus reduction in interest rates. That's going to be accretive to earnings next year. It's going to be expansive. So there is another cut. The question is, does it come early in the year or does it come after June? This allows it to come maybe January or earlier or during the first quarter. And I think that that's important because that'll be stimulative to the economy.
You remain constructive on equities in 2026. You call out monetary stimulus, Dryden, fiscal stimulus, productivity. Is there one of those variables that you say, okay, this one matters the most? Is there one that you think even now might be underappreciated?
I think what's underappreciated is the fact that because of the great big beautiful bill, right? You had two things going on, and people have unappreciated that. We withheld really too much, right? So we have about $150 billion worth of over withholding from 2025 that's going to go into consumers in 2026 when they pay their taxes. The average person's going to get an extra $1,000 more back. Then when you look at the rest of the tax cuts, that's about $670 billion. So you have coming in as stimulus in the early part of the year, roughly $750 billion that's going to go into consumers' pocket. And we both know what does a consumer do when they get money? They spend it. So that's going to be constructive. That's going to be constructive to earnings. Most of the earnings look pretty good next year. And record earnings turn into a record market.
Let's talk about earnings. You did note here 82% of S&P 500 companies, they beat earnings in Q3, Dryden, you point out. So when you look ahead, what do you see for profit growth in 2026?
Well, the average, the Mag 7 are probably going to grow at about 18%, and we probably look at the rest of it around 13%. Those are most of the predictions. And the underappreciated thing here in earnings is as companies are implementing AI, you're seeing increased labor productivity. Increased labor productivity turns into higher margins. So I think we're going to have to see this implementation work its way through, but you're going to begin to see companies have margin expansion because of their adoption of AI because it increases labor productivity.
On Mag 7, you did point out here, you see growing earnings faster than the rest of the market, Dryden, but you did note here margin of outperformance narrows.
Exactly.
So, okay, does that mean, what are the implications of that? Should I be trimming my exposure then?
I think if you're way overexposed and you're in a taxable account, you got to pay attention to capital gains. But I think you look at positioning a little bit higher weightings to the 493 because we think that this earnings growth is going to spread out. There's going to be companies like we talked about here that are going to really take advantage of some of this margin expansion. So what's going to happen is Mag 7 does about 18, but everybody else begins to rise up and catches up to it. And I think that that's where there's a lot of opportunity next year.
I was talking to another strategist this week, sat in that chair. She was more cautious than you. And I said, well, hold on a second, you're cautious. And I said, monetary stimulus, fiscal stimulus, AI capex, right? She said, yeah, but you know what? A lot of that's now priced in, Josh. Do you see valuation risk?
Not as much as a lot of people. And
Why so, Dryden?
Part of this, everyone wants to say, oh, it's like the old dot-com bubble or something like that, right? Well, that's not true. The companies have real earnings, have real growth. These are large companies. If you take a look at Microsoft. Microsoft has 5 times the fixed assets as Ford. So you take these companies that used to be just tech and asset light, they now have real assets, real growth. That kind of puts even if you have a pullback in the market, all of this, the quality of earnings are better, the quality of the balance sheets are better. So when we have these moments of volatility, you have a backstop to it because it's real assets there. You have a backstop to it. It's real earnings. So I'm not as, we're constructive on next year and we're going to hold to that. You have fiscal stimulus, you have monetary stimulus, you have all these things in alignment, and we think that that's going to be positive for the year.
What do you make of, listen, broadly when you look at that AI trade, you see some evidence that maybe investors getting some jitters are popping up, some nerves. But then you see the companies drawing, like I broke Micron earnings after the bell. I did a double take on that guidance. I thought I had been reading it wrong, right? It was that much of a beat. That thing reported and surged, and it's this story of demand strong, supply tight. I'm just curious what you make of that.
We're in the infrastructure building period of the next new economy. This is like the Transcontinental Railroad, which transformed our entire economy with transportation stuff back in the 1870s. So when you look at right now, we're spending a tremendous amount of money. Not all the companies are going to be winners. You got to look at it one by one. But when you recognize the amount of capital that's going into this, we're just in the early stages. We're in the infrastructure stage. What's going to happen when we go to the implementation stage, where companies are now going to use this AI technology and all of this infrastructure to increase labor productivity and jobs? That's really going to push earnings, not just for the Mag 7, but for the entire economy.
Let's end here before I let you go on some picks, Dryden. Got three here. Amazon, GE Aerospace, United Rentals. Is there a common theme or themes for those three names?
All of them have to do with what's next, okay? For Amazon, obviously 4 out of 10, every $10 goes through the Amazon platform. They're absolutely dominant. So the common theme is all of these companies occupy a choke point in their business. So Amazon is online shopping, which is, we shop more than we do anything else, right? So 4 out of $10. They're getting that, and we're going into Christmas, right? So they're dominant at that choke point. They're going to move. When you look at GE Aerospace has, in some of their components, 10 years of a backlog in making aircraft engines. We're going to continue to fly. Every plane's got at least 2 engines, and most of them are going to be GE Aerospace. So you're going to have the CFM. So you have about 80-90% of the NEO, about 100% of the 737, and you have these huge backlogs. So they got a 4-year backlog of total earnings, already orders on the books. They've got 10,000 engines for the CFMs on, and so they're dominant. You're not going to be able to fly without GE engines. So that's going to move forward. And then the third piece of this, when you look at URI, the roads and bridges in this country are deteriorating fast. We have to replace them. About $1.2 trillion worth of, you take the deficient bridges in this country and you line them up end to end, they stretch from Seattle to Las Vegas. It's 1,100 miles of them, right? And so when you look at that, we got to rebuild them all. Well, URI is a dominant rental into heavy construction. You got to have equipment. Not all the companies own it. They're going to rent it to it. They have a 17% market share there. They're the dominant player. So they're going to always be who everybody's renting from for the equipment that's necessary for the next bit of industrial build out of America.
Dryden, always great to see you, especially on set. Thank you, sir.
Thank you, appreciate it.
We've been trying to follow the sort of day-by-day developments in this AI arms race. Reportedly OpenAI declaring a code red recently because of the increasing market share of Gemini. As an investor, how do you know where to look, what to pick? Do you just invest in it all? What do you do?
I think you do have to have a core exposure in all of these companies because it is an AI arms race, and a lot of these companies, their businesses are good. But we do feel that at this point, they've run up a lot. They're trading on expectations of the business that they're going to do 5 years from now. And we feel that a pullback in the market is imminent. And these are the companies that are going to get hit the most when the market does pull back. So we've been talking to our clients about the leadership in the market changing from the AI winners to the AI enablers.
Okay, I want to get to that in a minute, but I do want to ask you about this latest headline that we got about Microsoft, the information reporting that Microsoft is lowering its AI sales quotas. And this brings me to the question I was just discussing with my colleague Dan Halley, which is not just where's the adoption going to be, but where is the money going to be spent, which kind of speaks to your AI enablers versus who's putting it out in the world. Where is this money going to be spent? Or do you look at where it's being spent now?
Yeah, I think we think that a lot of it is going to be spent on data centers because a lot of this money, the AI-related data centers, we expect that by 2030 are going to triple and globally. And we feel that north of $7 trillion is going to be spent globally on AI-related infrastructure. So companies that are involved in building and maintaining those type of data centers and the infrastructure companies, that's where we are seeing more value right now.
Well, but I guess my question is, we know the money is planning to be spent on those data centers. Eventually, you got to bring in more revenue to fund those data centers. Now, the hyperscalers that are out there now, the Alphabets, the Microsofts of the world, they have lots of cash to do this. And they are starting to make some revenue related directly to AI.
Sure.
But especially the likes of OpenAI are going to have to make a lot more in order to continue to fund that $7 trillion that you're talking about.
Yes. And that's where we think the risk is, right? Because a lot of them are trading based on expectations that they're going to draw in that profitability. But we just feel that at this point in time, and then also what we are seeing is that a lot of them are benefiting from that bonus depreciation in the big beautiful bill, which is pulling forward a lot of that capital spending. So the balance sheets are looking really good now, but when the time comes for the show me, like when the revenues are coming, that's where we think there could be some vulnerability in these names.
Okay, so as you say, look at the infrastructure builders now, and you're not talking about an Nvidia, for example. You're talking more about the actual physical stuff. I mean, Nvidia makes chips, but the buildings, if you will.
Yes, absolutely. We are talking about like the brick and mortar companies. So if we believe that AI is real, which we think it is, then we have to invest in the companies that build the infrastructure that makes it possible for AI to exist. So we are talking about construction, equipment, utilities, electricities. These type of companies are necessary for AI to do well.
What do you think about this now what's become a sort of new battleground about electricity prices, which in some jurisdictions, the data centers have been pushing up those prices. How is that push-pull going to work out for the companies that are trying to build this infrastructure?
I think a lot of these companies, because the prices are going to go up, there's a lot of demand for this. So a lot of these companies are going to really benefit from it as well. And we've talked about this on the show before. We've been investing in utilities. We've been overweight that sector for the past 2 years. And they are a direct beneficiary of this AI build out because electricity is going to be needed.
Right. Okay. So other than that, I am curious where you're looking for opportunities. We've been talking a lot about Bitcoin recently, so I'm curious how you're thinking about that in terms of how clients should be positioned.
Yeah, in terms of Bitcoin and clients, I think we view it more as an asset diversifier, right? Like for us, one of the best investments so far has been gold. Right, gold, we've been consistently investing in that. That has been one of the best performers this year, up more than 50%. Similarly, we view Bitcoin. And I think this sell-off in Bitcoin is possibly an opportunity for those that missed out on the rally to get involved. And an easy way to do it for our clients is that Bitcoin ETF, IBIT, we have exposure there. And a lot of the sell-off is probably driven by potential unwinding of the Japanese carry trade, where risk assets are being sold. So
the global economy is rapidly evolving from shifting monetary policy to inflation pressures and structural changes thanks to technology. In the backdrop, record-setting markets that are sparking fears of a correction or even worse. Joining me now is Mohamed El-Erian, Allianz Chief Economic Advisor. Mohamed, a real treat to have you here at Invest. Thank you for always making time for us. Let's start out of the block here on cockroaches. There's a lot of talk on Wall Street right now on cockroaches, and this essentially is risks coming out of various places, and it's hard to stop them. What say you? Where's the next, economic cockroach to be found?
So let me just say, we will have cockroaches, but not termites. And this is a fundamental differentiation. Cockroaches are unpleasant. They come in groups, but they don't eat away at the integrity of the system. Termites eat away at the integrity of the foundation. So why are we going to have cockroaches? We're coming from a period where people have stretched really far for additional returns. They have been encouraged to do so by a strong economy, by very loose financial conditions. And some people went beyond their comfort zone and beyond their ability to do due diligence. So I don't think we should be surprised that we will have these accidents
these credit accidents. We'll have some economic accidents, but I don't think we're going to have any systemic shock.
That is, of course, a good thing. And when you mention potential economic accidents, what keeps you up at night? Well, what are you most concerned about for 2026?
So what used to keep me up was a trade war. But the US has been able to impose higher tariffs without triggering much retaliation. So that doesn't keep me up as it used to. What does keep me up is what's happening at the lower ends of the income distribution for households, where there is significant pressure. And what keeps me up is the amount of debt that has to be refinanced at higher interest rates. So those two things are potential areas of pressure, which would be made worse if we get a policy mistake.
Mohamed, you bring up a really great point. It's something I've been thinking on very deeply of late. We've seen tremendous wealth created in the market this year, and the bull market has continued, but we're not seeing it. I guess this goes to your point. We're not seeing it translate into that average U.S. household, that lower income consumer. Is that cohort of the U.S., are they in a recession?
They're near recession, and they are spreading this concern about affordability, which is not just an economic issue, it's a social and political issue. The first shock to affordability was, of course, the 2021-2022 inflation shock. But that was offset, Brian, by income transfers. Now we have inflation stuck at 3%. We have insecurity about future income. The Challenger report showed you that layoffs were surging. AI will change the workplace. And in addition, we have high debt and credit cards that have been maxed out. So there is real concern on the bottom bit of what people call the K-shaped economy. And this is not isolated concern. If the lower household incomes stop spending, not because they don't want to spend, but they're not able to spend, that will contaminate upwards for the economy as a whole.
So you think that pressure on the low end, so the high income consumer, the person that is exposed to the markets, they've enjoyed a good year, they're not immune to what's happening on the low end.
Okay. So they're doing fine. They're doing fine from an income perspective. They're doing fine from a wealth perspective. So I'm not worried about middle to upper class. I am worried about lower income households and their ability to continue to navigate this uncertain environment.
How do we bridge this gap? Because if you listen to the current administration, Mohamed, they are talking, the president has floated a potential $2,000 dividend. There's been interest in that. The One Big Beautiful Bill was passed. More jobs are being created in the U.S. in terms of tech companies building out AI data centers. How do you bridge that gap between what's happening on the high end and low end?
So they also, you could have added to that list that they've moved on some very sensitive prices, gasoline being one, and the other one being some pharmaceuticals. So they are taking steps, Brian, but this has been long in the making. This is not something that is recent, and therefore it is deep-rooted. It is made more complex by two other issues. One is the difference between real and perceived, and the other one is the difference between relative and absolute. So it is a really complicated issue, and if you go through it, the bottom line is it will take years of effort, both on the income side and the price side, to get us out of these situations.
I wanted to leave enough time in this conversation, Mohamed, because you are known as a foremost thinker on Federal Reserve policy. It has been quite the year for all things Federal Reserve, of course. Attacks from the Trump administration. We're coming up on the end of Chair Powell's tenure. Where is your head at as it pertains to the Fed in 2026? What is a new Fed chair? What will they bring? And where do you see the ultimate end game for rate cuts this cycle?
What a new chair will inherit is a divided Fed. And it's divided by two things. One is whether they are sensitive to the employment side of the dual mandate or to the inflation side of the dual mandate. Both are flashing yellow right now. So it does matter where your bias is. And what we see is that people are on both sides of this divide. The second thing that they will inherit is a division between people who are totally comfortable being backward-looking, so-called data-dependent, and those who realize they also need to be forward-looking. They need to have a strategic view of the economy, and in particular, Brian, of something you've been talking about a lot, AI and its impact on productivity and growth. So what a new chair has to bring is a unifying narrative. And I think that narrative has to be forward-looking. And the new chair has to have a view as to what the future economy looks like. I am a great believer, as you know, in the promise of AI. If we get diffusion right, we will have a significant productivity increase. And as a result, monetary policy will be able to be looser than it would otherwise have been.
Do you view the attacks on the Fed and what it does for the administration, will that leave lasting damage on this institution? And if you do think that's the case, what does that damage even mean to markets?
So I believe deeply in the independence of the Fed, deeply, that I think a Fed with policy autonomy is the best thing we can have. But I also believe, as you know, that this Fed went to sleep. There are many areas of reform that require attention. There are many best practices that from the rest of the world that we should be looking at more seriously. And there's lots of hard questions that we need to ask, including what is the right inflation target in a structurally changing economy. So the good news is you're starting to hear debate from within the Fed. You've had two Fed officials, as you know, come out and saying, maybe we should have a range for inflation, our inflation target, not a point estimate. You've had another one come up saying we target the wrong intermediate policy variable. So I'm encouraged by the fact that the Fed itself is now finally talking about reforms. And that is something that, if you look at the 5 candidates on the short list, all of them understand that you need to reform the way the Fed operates. Otherwise, the Fed will continue to be behind. And if you look at the recent years, not only have we had decisions that were too late, but we've had a culture issue. We've had 5 officials that were accused of irregularities. So I think it's really important to reform this Fed. And what this political pressure has done is it has made certain Fed officials realize that it's better to reform from the inside than to have it imposed on you.
The 5 contenders you mentioned on the short list for the next Fed chair, do you have confidence that they will keep the Fed independent?
I do. I think all of them understand the history of central banking. They understand the importance of keeping the Fed independent, but they also understand that an independent Fed needs to be an accountable Fed, and an independent Fed needs to reform itself to keep up with changes. It is striking to me, Brian, that we don't have external members serving on the FOMC, like the Bank of England does. So we end up with groupthink, and that groupthink ends up by the Fed being behind. We saw that in 2021, 22, and we've seen it again this year. So there are things that can be done and should be done. And I think that all 5 realize that an independent Fed is critical, but it doesn't mean a Fed that goes to sleep on how it operates.
Do you think the 2% inflation target should be scrapped?
I don't think it should be scrapped. I think it should be changed. I have been of the view that a better inflation target is a range, not a point estimate. A point estimate suggests precision that is elusive. Second, that range should be higher than 2%. It should be the 2.5% to 3%. And what is undeniable is that we are at a stable 3% inflation, and that hasn't in any way unanchored inflation expectations.
Out of the 5 candidates, Mohamed, look, I agree with you. These are incredibly qualified people. Of course, shout out Rick Reeder, friend of Yahoo Finance. We all know him very well. What do you think their biggest problem they will have to solve? That first 6 months on the job of leading the Federal Reserve after a long tenure like Jerome Powell has had, what do they need to get right out of the box?
Shifting the Fed from an excessively data-dependent, backward-looking institution that is reactive to one that has the confidence to take a strategic view and be proactive. That's going to be a major change that is really needed, has been needed for a while, and that hasn't happened under Chair Powell.
I wanted to get back to what you mentioned on AI and productivity. You could see AI chatbots, at least for now, this current wave of innovation is already starting to drive a lot of productivity. How much of a risk is it to jobs around the world? How concerned are you?
I'm concerned mainly because of the corporate mindset, Brian. If you look at the promise of AI, there is a labor displacement risk, and there's a massive labor enhancing opportunity. And the worry I have that with the exception of a few companies, the mindset right now in corporate America is about cost minimization. AI is viewed as a cost minimizer. What AI really is an enabler, a productivity enabler that gets there from better work and more work. And I worry a little bit that the mindset is too focused right now on cost minimization, because the real promise of AI is not labor displacement, it's labor enhancement.
I told myself coming into this, Mohamed, I didn't want to be that guy that asked you about a bubble. I just think it doesn't capture the nuances it deserves. So let me, if I can frame it a little more academically, how concerned are you that AI stocks are grossly overvalued?
So let me share the work that I've been doing with Mike Spence, a friend and a Nobel Prize winner. We believe that we are in a rational bubble. So yes, there are elements of a bubble. And there's three elements in particular of this bubble. First, the frontier, those working on foundational models. Not all of them are going to succeed. And yet all of them are attracting significant investment. Second, diffusion isn't being talked about enough. Diffusion means getting AI into the workplace in an orderly fashion, in a comprehensive fashion. We don't have a diffusion policy so far. Other countries, China does, UAE does, we haven't. We've got to get diffusion right. Otherwise, the promise of AI is not going to be fully realized. And then you and I remember the dot-com era. We remember companies simply putting a label on what they do and attracting investment. Well, that label today is AI. So there are elements of a bubble, which means that people will end up with losses. But the aggregate value of what's being created is significant. And therefore, the rationality part comes in, Brian. It makes sense to take a venture capital approach to AI. The payoff is so large that it is rational to have multiple investments and to overinvest. So the good news is that it's a construct that will make us more innovative, more competitive. The bad news is there will be tears, there will be losses, because elements of it are elements of a bubble.
I wanted to leave Invest viewers thinking with one deep thought. And let me come at you with this question, Mohamed, before we get going here. If you were writing a short message to policymakers right now, one key action they should take, what would it be and why?
That realize that our future is going to be at the tails of distribution, not in the belly. You know, for a long time, we grew up with unifying themes, the Washington Consensus, globalization. We are now living in a world of fragmentation, in a world that structurally changes. And what happens at the tails are going to determine where we end up. So don't get fooled by a normal distribution, a bell-shaped distribution. Realize we're in a multimodal world.
Always a treat to get some time with you. I always enjoy our conversations. Mohamed El-Erian, Allianz Chief Economic Advisor. We'll talk to you soon. Thanks for joining us here.
I'm Jared Blickry, your host, and with me is Yahoo Finance senior reporter Brooke DePalma, who's here to connect the dots and to be that bridge between Wall Street and Main Street. Today, we're going to be talking about the AI trade as we look ahead to 2026, which leads us to our word of the day, productivity. It is the holy grail for central bankers that lets you juice growth without runaway inflation. And it's all thanks to our little chatbot friends. And chip maker Micron has been ripping. On today's Market Show and Tell, we're going to translate the ride using one word that explains why it can feel like a roller coaster, beta. And this episode is brought to you by the number $309.22. That is the estimate for next year's S&P 500 earnings per share, which would be a record. We're going to tell you why rising corporate profits have helped justify soaring stock prices. And today we are welcoming Hardika Singh. Before she joined the market intelligence team at Tom Lee's Fundstrat, she covered financial markets as a reporter at the Wall Street Journal. And nowadays, she's producing macro and stock market research for Fundstrat's client notes and also their strategy work. So, Hardika, it's great to see you here. Before we dig in, any surprises from 2025?
I'll take the easy one, tariffs and Liberation Day.
Yeah.
I was actually off at that time. I was on my way to Cancun.
That's your fault. Okay.
Cancun of all places too. Yeah, and my husband and I, we took this trip and we were like, we're not gonna look at our phones. We're just gonna be completely detached. Second I land, I'm seeing all these headlines and I'm low-key having a panic attack of sorts. I'm like, oh my gosh, what's gonna happen to stock market? And then what was funnier was that Tom Lee, who, is typically has a more bullish outlook because he's so long-term, he was still bullish on the stock market. And he said that, stocks fell so much so fast. So I think that they could recover. And at the time, I didn't really see it, to be honest. But later on, he ended up being right.
Win for Tom Lee and the Bulls.
Yeah.
Seriously. What a year it's been, though. But I do want to get to our word of the day. And that word of the day is productivity. Now, it's pretty simple. Think of it as a ratio, output over input. It's how much we produce in goods and services, the output, over the amount of hours worked, the input. The more we increase output relative to input, well, productivity increases. And central bankers just love this. And here's why. It means the economy is growing without inflationary pressures getting too high. And that's because we're all able to do more work throughout the day thanks to our AI pals. That's the big picture here. Hardika, what are some specifics that Fed Chair Jerome Powell is looking at when it comes to this productivity gains?
So the most important thing and the biggest takeaway for me at the last Fed meeting was that for the first time ever, Chair Powell said that people who use AI are likely more productive. At the September meeting, what he said was, yeah, it's probably making people more productive, but it wasn't a clear-cut answer. But now we're hearing that even he, as a central bank chair, is noticing the transformational power of AI. And the biggest example of that comes in through the dot plot. So if we look at the dot plot that was released at the last meeting, we see that they actually upped their expectations for where GDP is going to go next year. It's at 2.3% for 2026. And in September meeting, the expectation was 1.8%. So it's a huge jump, right? It's a huge jump. And what's even more surprising about this jump is that they lowered their inflation expectations. So next year, they expect inflation to be at 2.4 something compared to 2.6 at the September meeting. And the only way, or like one of the biggest populist theories that these dynamic forces can exist together is that productivity is improving, which is so crazy to think about because GDP is just basically consumer spending. And if people are spending more, it can push up the demand for prices, push up the demand, and it can lead to higher prices. But at the same time, the Fed doesn't really see that happening. So it means that they're probably going to expect AI to lead to higher productivity.
I'm going to rewind here a little bit, and this is way before both of your time, but in the late 90s, we saw something very similar evolve, which Alan Greenspan. He was the chair of the Fed, the market whisperer. You couldn't understand anything he was saying, but he did say that productivity was increasing. In fact, it was. And so just back to my original statement, or Brooke, as you were breaking it down, the chance for inflation, although it still exists, is a lot lower. And that's why the central bankers love this. So, I know that Chair Powell, he wasn't all in on productivity just yet. He was kind of hedging his bets. Right. But, if this continues, how does this play out in 2026?
I think, well, first of all, productivity itself is really hard to measure other than this formula. There's all these intellectual arguments about what's the best way to measure it and whether AI is actually showing up in these numbers. And it's still unclear, even though he did give a really clear signal. And I think for next year, what remains key is for companies to actually start demonstrating it. What we have seen in earnings calls and plans outlined for next year is that companies aren't really looking to hire more people. They're looking to do more with less. They're looking to be more lean, more efficient. So I think for 2026, the companies that can tout the biggest revenue per employee number will be the biggest outperformers. I think that's the story. And sure, it's easier as a tech company to have higher revenue per employee, but then you think about all these industries where you do need more people to do the manual labor, and for them, it'll be a little harder. So how do they come in, use AI to their benefit and improve their revenue per employee stats?
And I think the one thing that really isn't clear with Fed Chair Jerome Powell is the impact that AI directly has on the labor market. He references other companies like, we're maybe not word for word, but Walmart sort of saying that this is going to have an impact on jobs. So when you think about what Fed Chair Jerome Powell, the sort of the indifference that he has on what exactly this impact will be, and then the statements that we're getting from these companies, what's your team's outlook on the impact that AI will have on the labor market next year?
The hope is what the market wants to see is productivity increase and the labor market to continue to, improve, of course, but lead to jobs that are in sectors other than healthcare and social assistance. This job market this year, there's been really not all that much to be excited about. Sure, we haven't, just tanked completely, but we're surviving. We're not thriving in this job market. So I think the health and social assistance sectors, they can continue to do whatever it is they're doing so far, but we still need to see other industries participate in a meaningful manner, like construction, manufacturing. These are the typical sectors that drive economic growth, at least like conventionally, they're supposed to. So we need to see that. For next year, I think the biggest thing is whether these companies can continue to grow in a sustainable manner without needing more employees or without, and if they do shed more employees, can they still continue to grow their profit? We have seen Walmart and Amazon do a really good job at that, Nvidia too, but others not so much. So I think that's the trend that's going to define next year.
Excellent. And, as hard as it is to measure productivity, I have no doubt that AI is going to help us do that a little bit better. It's time now for Market Show and Tell, where we are drilling into the concept of beta. And we're going to use memory chip maker Micron as an example, which the share price of which has more than tripled this year. So huge run for Micron. And if you're on the Yahoo Finance app or website and click into the statistics page of Micron, you're going to find a stat called beta and a number that's about 1.55. So this means that the stock has tended to swing about 55% more than the broader market, and we measure that over 5 years with monthly data. So it's not a surprise that Micron stock has moved much more than the S&P 500 this year, but bigger swings also mean bigger risks, and the gains, while they seem quick, the pullbacks can come fast and hard. So I know you're looking at Micron from a fundamental point of view, and just make the case, why has the stock moved so much, and then what do we expect for next year?
So Micron's business is basically making memory chips.
DRAM.
Yeah, DRAM. That's right. So we did have to look it up earlier in the year, but it was an interesting stock. But what they specialize in and why they're benefiting so much in AI is basically because they stack those DRAMs to make high bandwidth memory, which is super useful for AI data centers. And as we all know, data centers, we just can't get enough of them at this moment. We need more and more. And Micron really fills this niche market gap where they can supply that HBM. And there's the strangest part about all this is that there's not that many companies that are making these DRAMs or HBMs. There's SK Hynix, there's Samsung, but they're South Korean. So you can't really directly invest in them. You have to buy ADRs. But Micron is really like one of the big players. And that's why they've benefited so much this year, because they help fill that niche market
And it's
gap.
driving up prices of consumer gadgets too, because we need DRAM in a lot of our devices. So.
Yes. So my husband, who's a gamer, he's been complaining that RAM prices are through the roof now because Micron actually in early December made the announcement that they're no longer going to make it for consumer segment because the demand for AI is just so high right now. They can't fill it up. So through 2026, they're actually completely booked out, they said, for the most part, which is just crazy to think about. But yeah, Micron is ripping higher because of that. And I am not necessarily a fan of this move, I will say, because if you pin it against the prices for, memory chips, you can see the move exactly relates to that. So it leaves the company's share price very vulnerable, very exposed.
Yeah, it's very
cyclical. This in particular, just that.
Yes, and as we saw back in early pandemic, when you make too much of these things, then you're just stuck with all this inventory.
Great point.
And then
you think we'll have a backlog of inventory, even though the CEO has said explicitly on the call that there's just so much demand?
Yeah, I don't think we'll have it this time. I do think this move can last for a little bit longer, but I do think that it's very vulnerable to becoming unraveled if we do develop new technology or another player comes in and says, hey, actually I can help supply this. So the prices come down, and then Micron's share price is probably also going to come down with it. So it's not a sustainable move in my opinion, but that doesn't mean that it can't keep happening for a little bit longer. Isn't the saying that like markets can remain irrational longer?
Then you and I can remain solvent. And that's kind of what happens sometimes. Again, .com.
All right, guys, we do need to take a quick short break, but coming up, we're talking about what will likely be record profits in the U.S. and a run rate showdown between the two Kevins in their battle to become Fed chief. As always, it all comes down to the accessories. Stay tuned. This episode is brought to you by the number $309.22. That's the estimate from FactSet for the next year's S&P 500 earnings per share, and it would easily be the highest on record. And this matters because a lot of people are getting nervous as some valuation gauges are putting the market around the expensive levels we saw during the .com era. And if earnings are hitting records, maybe record stock prices are, well, justified, or so the thinking goes. So Radhika, tell us how you're seeing these companies' earnings versus the stock price right now. Is it justified?
100%. And they can easily go even higher. I think at least for next year. That's what our view is. I would say that with valuations, a lot of people are really worried about, them being too high, close to perilous levels from .com bubble. But I just don't think that's an argument that's solid and grounded in reality to not own stocks for next year. So we commonly hear people talk about forward price to sales ratio, forward price to earnings, cap-Shiller ratio.
All these are just multiple ways to...
So many ways.
Actually, multiple. So, I mean, that's what it comes down to. So we're trying to gauge the expensiveness or cheapness of the market. Happens to be expensive right now, but it can stay that way for a long time.
Yeah, exactly. So price to earnings ratio on a forward basis for the S&P 500, it's at 2050. So if they're at 2050 right now, what that basically means is that you're paying $50 to buy 1 unit of earnings. And the reason why people don't like them getting to higher levels is because that means you're paying more to get the same stock. And everybody likes to get a good deal, right? So we're uncomfortable, notably, because of that. I don't think that's a good argument, though, because of 2 data points. Number one, we actually did an analysis going back to 2015 where we looked at the most expensive stocks. And out of 10 of the top 10 most expensive stocks, 7 of them outperformed the S&P 500 over the next 5 years. So it's not necessary.
Expensive isn't always bad.
Yeah, exactly. Price is what you pay. Value is what you get.
Warren Buffett said that.
Yeah, exactly. So it's not really a good argument. And then second point, if you had paid attention to valuations, then you would have completely missed out. On the past 3 years long bull run. And as we're seeing, this year might end up being another 20% gain. So
yeah, let's focus in on that, because I remember a year ago I was sitting here, we were talking to a bunch of people, and they were all saying, well, when you have 2 back-to-back years of 20% gains, well, then the third year you tend not to do as well. But here we are. I think we're going to be up 16, 17%. Full disclosure, we got 2 more trading days in the year, and maybe we hit that 20% mark, but we're getting close there. So it's unusual maybe, and I don't think it's happened since the late 90s, but what are your thoughts on this?
On a 4th annual year of gains.
Yeah, big gain, double digit.
Really extraordinary, right? But it's actually not that extraordinary, we found out. So since 1928, there's been 12 instances where across global equity markets, they've notched 3 years of 20% plus gains. And out of that, 5 times there's been a 4th year of gains. So S&P 500 too could have that. Of course, history is not meant to be a guide. History is not meant to dictate our future performance. It can help guide us in the direction of where stocks could go. And how I'm really looking at this is as not completely discounting what could happen in the fourth year. Fundamentals look great. Going back to earnings, next year analysts expect that we're going to have a record number of earnings, and they always overestimate it by a little. That's one of their reputations. But even if we cut it by what they typically overestimate it by, it's still going to be a record year of earnings. It's very, very good to see stocks rise when earnings are growing too, because it supports that rise. So I think it can still be another good year. And in the past 3 years, I think the median gain across those global equity indexes was 170%. And the S&P is only at 75 something. So there's room to grow. Maybe we'll have like another 75% gain next year. But I'm joking.
I will say too, we're hearing from so many different firms, Goldman Sachs, Wells Fargo, even Edgar Denny, well-known person on the street. Yeah, very bullish calls about what 2026 could look like, and so it really supports what you're saying. Edgar Denny calling out for 7,700 by the end of 2026. That would apply about a 10% gain there. So definitely lots of bullishness that supports what you're saying too.
Yeah, it's funny when people say, well, over the last 80 years, the S&P 500 has averaged 8 to 10%, but it's almost never 8 to 10%. It's usually a lot higher or a lot lower. And so when you hear all these statistics, especially averages, medians, take it with a grain of salt. I think the bottom line is that we have a bullish potential for next year, and expectations are probably reasonable, as I think we've been discussing here. So let's keep it on the markets. What are you thinking about the markets that we haven't hit on so far?
The biggest thing I would say is gold.
Oh, gold. Metals, let's talk about it.
Yeah. Silver,
up
copper,
65,
gold.
70%. Silver's up 170%.
It was not on my bingo card for this year at all. That gold was going to have such a skyrocketing year, and silver too. Where did silver come out of, by the way?
It's the AI trade, so it's an industrial metal, but I think you're right in that you have to have a perfect storm of not only industrial use, but also of speculation. And we saw that, I think, when you see gold kind of capture the imaginations of people buy the ETFs, they buy the coins, and it's all this virtuous cycle.
The miners.
And the biggest purchasers of gold are the central banks, but that's kind of this steady backdrop. And I think it's the retail buyers that just are the marginals. But does FundStrat have any big expectations for gold or Bitcoin next year? Because Bitcoin hasn't done as well.
Yeah, I wish I could talk about Bitcoin, but that's
out
for
of your
Tom.
That's
that's for Tom. But gold, it feels so weird to see gold do as well as it has, while at the same time you're seeing tech stocks just going higher and higher in the AI trade. Maybe it's part of this defensive play that people are worried if AI trade falters, at least I'll still have my gold holdings and whatnot. But at the same time, it's like, who are these people that are buying all this gold? And it's unclear. It's central banks, sure, but what's happening right now for central banks to continue to amp up their activity? Because I think they started increasing their purchases in 23. 24?
China and other countries, Russia, have been de-dollarizing since 2015. But you're right.
Yeah.
Over the last 3 years, it's been like 1,000 plus tons per year. Tons. I mean, that's a huge number. So
what are they seeing that we aren't?
Right.
Well, I think they're looking at all the conflict around the world and saying, well, we don't know what's going to happen. Maybe we'll just double down on gold.
And I think also, too, the extraordinary run that silver and metal, these other precious metals have also seen. I read this crazy stat today, guys, that copper, obviously seeing lower supply, then leading to more demand, increasing prices there. But you think about it with solely data centers, as many on the street are focusing on, but think about how much copper is in the everyday American's home. And this stat that I read is the average single family house uses 439 pounds of copper in your wires, in your appliances. And so, what are the implications there? How much is it going to cost us to redo a house, guys?
Yeah,
about that
copper
one.
could become the new reserve currency here.
Exactly.
We do have to get to our final segment of the day. It's a market's take on a classic Hollywood gab show staple, Who Wore It Better? And today it's all about the battle to become the next Fed chair. It's Kevin versus Kevin. That is Kevin Warsh versus Kevin Hassett. On the left runway saunters Kevin Warsh in pure Wall Street tailoring, clean lines, sharp shoulders, and a little balance sheet trimming energy because He's a former Fed governor with an M&A background, and in the past, he has been a vocal critic of quantitative easing and also the bloated Fed balance sheet. Then on the right, in walks Kevin Hassett, an economist who's not too shy to bring his own spreadsheet, decked out in tweed, a growth lapel pin, and also a pocket calculator. A trained economist who's been a big voice on productivity and an architect of the 2017 tax cuts. So Hardika, the question for you is, who do you think eventually wears that Fed chair this May when Jay Powell gives up the top spot at the Fed?
So I'm gonna have two answers.
Don't say
to this.
Kevin. Don't say Kevin.
Don't say Kevin.
Which Kevin?
Which Kevin? Okay. So I think the market's probably gonna like Hassett more. I do think Borsch also could also be a good fit. So that's my cop out answer. But Hassett, I think the market would like him because he isn't looking to redevelop or revamp what the Fed does and what the Fed's activities are, whereas Borsch, as you said, is so vocal about QE and going away from QE, which obviously could have huge implications for Wall Street. I do think that Borsch does have a point when he says the Fed's balance sheet has become bloated. They're becoming bigger and bigger. Whenever they stepped in to, calm the markets after financial crisis, they kind of never stepped away, even though the financial crisis...
Not in a big way. I mean, they ratchet up, not so much ratchet down.
Yeah, so it's a valid point, but I do think Hassett would be a better fit for Wall Street.
I think also, too, what's interesting is that both of these gentlemen have said that they plan to maintain the Fed's independence. What's your take on both these gentlemen and the ability for them both to do that?
This is going to sound funny, but I think at the end of the day, they're both Kevin. So whichever one goes in, it's okay. Because Trump has made it clear, the president has laid out the Trump rule, saying that if they disagree with him on where interest rates are supposed to go, they will never be the Fed chair. If that's the outline, then whoever does come in will likely be dovish, and market's going to understand that. So I think the risk that comes then is what happens to long-term rates, because while the Fed has control over the short-term rates, the long-term rates, not so much. So the Fed's probably going to need to step in if long-term rates go up even more and start doing more QE, which then puts them in this cycle.
Or Operation Twist, which is kind of crazy again.
Yeah, that would be crazy too. But, long-term rates, that's where most of us feel the impact of higher interest rates. They affect mortgages, they affect your student loans and whatnot. So I think it's a tough spot, but I do think that at the end of the day, whichever one comes in, it's likely going to be a dovish Fed chair.
Yeah, and I think you rewind the clock. There's always a little bit of hesitancy when we get a new Fed chair. Sometimes the market stumbles a little bit, but in the end, I got to think that most of the Fed chairs throughout history have leaned a little bit dovish. So that's my take on things. Well, it has been an absolute pleasure hosting you here, Hardika, at Stocks in Translation. And just to review some of the things that we were learning earlier, productivity, the holy grail for central bankers. You can get that economic growth without the inflationary pressures, but that's all on the backs of workers who are doing more. And hopefully those workers have a good ChatGPT or Claude account that they can base that on. And then, we're also talking about the earnings for this season. We're going to have in a couple of weeks, we're going to get JP Morgan and the big bank earnings. We're going to see exactly how that shakes out. But there are big expectations for 2026 like there is every year. And I think we start off a little wobbly, but in the end, we usually kind of find our footing. So we have officially wound things down here at Stocks in Translation, but make sure to check out all our other episodes of our video podcast on the Yahoo Finance site and mobile app. We will see you next time on Stocks in Translation. All right, I try not to get involved when Bitcoin is going sideways. It's been going sideways for 6 weeks, but some technical developments have happened. And you tell me, is it time to go long finally?
Well, we were just talking before that you astutely pointed out there was a big options expiration on Friday. And before that, most of the dealer community was basically long optionality, and they were their hedging activity was helping to kind of pin Bitcoin into where it's resided in the sort of the high 80s for the last couple of weeks. It's been kind of a numbing and confounding market, right, since this liquidity event that the market had on October 10th.
Big sell-off, yeah.
Right, big sell-off and big liquidity event that kind of really spooked the market pretty good and drew out a lot of the fast money into other places. Has given us basically a heartbreak quarter, which has ended a year where a lot of the slow money progress in integration and legislation and building in M&A has been great, but the fast money seems to have evacuated from the token space. So I guess the best way to put it is I think Bitcoin and the rest of the crypto market, its attention span seems to be a quarter. Things happen in quarters. We've had almost exactly a solid quarter of downtrend, so this too shall pass.
Yeah, I like that because guess what? It's the end of the quarter.
It is.
And I think the first quarter has been a pretty good time. The beginning of the first quarter has been a pretty good time to buy Bitcoin. And if we go to the Wi-Fi Interactive, I'm just going to show a chart real quickly because I was mentioning to you also, I like the technicals. Here's the year to date in Bitcoin. And we got a pretty steep trend line, and you got to be careful about these sometimes, but we have just crossed over that. So you gently step over that. I would point out here, 75,000 is the low of the year. I'm going to put a 2-year chart. That was a year to date. And so here's that same level I just highlighted, 75,000. It was also the peak the prior year. So kind of a line in the sand for a lot of investors. Where do you see the money coming into Bitcoin? The ETF, I keep hearing all these new companies finally onboarding Bitcoin onto their platforms. Anything there?
I think the bullish case for Bitcoin is that its investment thesis is intact. I think what's happening a lot with other tokens, right, with everything from Ethereum all the way down is people are starting to scratch their heads and say, I get that there's going to be more adoption of blockchain technology, but what does this token have to do with it? How do I relate those two things into an investment thesis that gets me in for the long term? Bitcoin on its own, it's fine. Store value, it moves from one place to another. It has a very simple purpose. And therefore, people who want to invest for the long term can kind of count on that. The precious metals have taken away a lot of the fire in terms of the debasement trade, but there are a lot of technical reasons and geopolitical reasons that are driving those movements as well. So I think you point out some really interesting levels of that $75,000 level, which was due to some flush outs of perps back during the taper tantrum back in Q1 of last year, right? That was kind of a region where we haven't had a lot of price discovery. Remember, after the election in 2024, Bitcoin raced from about 69,000, pretty very close
quickly.
to one, very quickly, right? So there wasn't a lot of kind of price discovery and kind of settlement there. Things just raced up. So that's a tender area, that sort of $85,000 to $75,000 level. We've held on to 85 pretty well. We've seen, as you pointed out overnight, whether it's been MicroStrategy buying or option dealers being short gamma, that the race up to 90 can be pretty fast. And then we'll have to see where things go from there. We don't have a lot of the baggage that we did in the first quarter of 2025 with the inauguration and then with an immediate tariff policy. Things seem a little smoother with a little bit more precise expectations for the Fed. So if things roll out pretty slowly and a trend begins to develop, I think investors can start to watch that and make their decisions there.
Another thing I remember from the beginning of last year, there was, as soon as Bitcoin made that humongous rally into the inauguration, and it stopped shortly thereafter, I heard $200,000, $300,000 price targets. Those were coming out pretty quickly. And we had probably, arguably, the most favorable regulatory backdrop for crypto in a long time, if not ever. Without those tailwinds, though, I mean, what has to happen? What's the catalyst that gets Bitcoin to 200?
Great. It's a great question. And I think the answer is not in Bitcoin. The answer, and what ended up happening a month later, was that Ether found a bottom and had its massive, very powerful rally. Ether was the poster child, was the representation of blockchain technology, stablecoins, tokenization, payments, things like that being adopted. And that led a massive rally which had breadth. Bitcoin needs breadth.
Yes.
Breadth needs Ether. Ether will lead the way of the adoption and technology names. High quality names will benefit more than low quality names. So I think ETH is a very, very important name to watch. It's starting out the year or ending the year around 3,000. The high was around, a little bit short of 5,000. So keep an eye on ETH for the adoption of blockchain technology representing itself into investments into tokens outside of Bitcoin.
Yeah, I'm so glad you mentioned breadth because I'm a big breadth guy when it comes to stocks, but it also applies to crypto. I'm going to get you out on this. Anything we haven't covered here or outlook for 2026? I'll give you the floor.
Yep. We have an index called the CoinDesk 20, which is now around 3,000, like ETH. It started out around 1,000 in the fall of 2022 when we based it. There's a mid-cap index called the CoinDesk 80. It's spaced the same way.
Yeah.
It's under 500, right? So we're really seeing a pull away of high-quality names and important critical names versus low-quality names. Get some diversification, get some breadth. An ETH-led rally will bring a lot of other names with it. Bitcoin will handle itself, and just go for some breadth in 2026.
All right, breadth in 2026. Love it. Andy, thank you for stopping by here. Great to see you.
Good to see you.
Bitcoin has spent 2025 in a turbulent up and down pattern, but as U.S. banks deepen their involvement in digital currencies, there may be a sliver of light in an otherwise cloudy crypto market. Yahoo Finance's Inez Ferre joining us now with the very latest. Inez.
Yeah, Josh, and today we saw Bitcoin bumping up to 90,000 per token. This is as JP Morgan is reportedly considering crypto trading for its institutional clients. So that sent the token higher and the rest of the crypto space higher. But as with other sessions, we have seen that it hasn't been able really to maintain those levels. And then you see some selling in afternoon trading. Look, we've been in a range-bound mode here for Bitcoin over the last several weeks. You can see the range bound there after it sold off and from 126,000 level in October. It has tumbled in October and November. Strategists are basically saying that you could be seeing a better entry point going into 2026 because there are a few headwinds that investors should keep in mind. One is the threat perhaps of another government shutdown in January. Then that foreseeably could be a headwind. If that's the case, who will be the next Fed chair? But then again, there are tailwinds as well going into 2026. You've got liquidity that should be improving next year. You've got a run it hot policy that's expected, and the expectation for long-term holders for their selling to sort of subside in 2026. This is part of the reason why we've seen this big downturn with crypto are those OGs that have been selling in October and November, and ETF flows haven't been able to keep with that selling. But careful chasing the rallies is what some strategists are saying also, because the cost basis for the sellers who bought 6 months or later is around $103,000. So they may be selling into these rallies.
Ines, I want to go to you on that roller coaster that we have seen for crypto this year. And to be clear, it's not unusual for Bitcoin, right, to see a roller coaster. What was perhaps unexpected is that it would have such institutional and policy support and still see that roller coaster, Ines.
100%. I mean, the Bitcoin community got everything that it wanted this year as far as regulation, as far as a friendly SEC, as far as the administration really going forward with crypto and Bitcoin in general. And yet you are seeing prices that tumbled from the 126,000 level in October, and also calling into question, is the 4-year cycle really over or not? I mean, you had some very prominent voices that were talking about that 4-year cycle being over, but now we are in a crypto winter, so to speak. And what's been sobering are some of the also price targets that have come out from Wall Street, because you had a lot of bullishness going into the end of this year, and now you're looking for next year some sobering calls. I mean, you've got Sean Farrell from Fundstrat that basically is saying that you are going to probably be seeing a drawdown in the first half of the year, and calling for 60 to 65,000 for Bitcoin in the first half, and then you would see a rally going into the end of next year, and Bitcoin reaching 115,000. Now, he says this is for a variety of reasons, but nevertheless, I mean, he got quite a lot of pushback online because of that, because he's been a big bull. But we have seen sort of a changing narrative. I don't think that it was helpful that you saw OGs, whales, selling heavily into this drawdown that we've seen with Bitcoin. That has created quite a bit of negative sentiment for the overall crypto industry.
And Mish, I know you're watching the technical levels on Bitcoin, as you tend to do with a lot of assets. And so what is that telling you about what we should be watching and where it could be going in 2026?
Well, just from a pure technical standpoint, we're sort of trying to scrape our way back over the 200-day moving average if we're looking at Bitcoin. And that would be a move over 91,000. I think that would be a sigh of a relief to the bulls. And if we break down under 85, obviously that would be some trouble. And what's interesting about the technicals right now, Julie, is that it's perfectly coinciding with the biggest news that could impact Bitcoin right now, which is that MSCI and possibly the S&P 500 and the FTSE are all talking about the potential of removing MicroStrategy, Michael Saylor's company, from the listing on the S&P 500. That fate could be decided as soon as January 15th. That would have tremendous implications because essentially, and by the way, when that news came out, that's where we started to see the top. That would have, the implication would be, first of all, a cash removal of $8 to $9 billion for one. But more importantly, perhaps, is that all this mass adoption that we just talked about would now come into question as institutional investors would basically be rejecting it. Now, this is very political. Some people will say Goldman Sachs behind it. They may have some reasons. It may not even go through. But I think it's something you have to watch. So coiled spring, if it doesn't go through, I think we'll see a massive rally. And if it does, that 65,000 may not even hold.
Well, and the interesting thing about all of that is it doesn't seem to be that MSCI is saying that there's a particular deadline or so we don't even know when it would happen. And it's interesting also because we went from a discussion of whether strategy would go into the S&P 500 to now saying it might be excluded from these various other indices. And it's not just strategy, by the way. It also seems like they're weighing a rule that would affect companies that have 50% or more of their assets in digital assets, these so-called digital asset treasury companies, which have become a trend this year. So it's quite interesting. Ines, meanwhile, we were talking this morning that Strategy's weekly Bitcoin buying announcement this week was not a buying announcement.
That's right. 0 Bitcoin that were bought last week. So again, this doesn't bode well. I mean, the strategy when strategy announces its Bitcoin purchases, it's tended to give a boost to crypto in general. I mean, this is seen as bullish. But look, to your point, Strategy has been saying they are an operating company. They should be included in these indices, and that these DATs are operating companies, and they kind of speaking for. I mean, they put out an open letter, kind of speaking for sort of the industry as a whole. But there is a case to be made by strategists that are saying that now with this crypto winter, you are going to see a sort of Darwinian sort of era for these DATs, and which can outlast the others, and you could see also consolidation in this space as well.
All right, let's put a pin in the strategy debate for now, because David, I got to bring you into this situation and this conversation, because as we talk about Bitcoin, we got to also talk about gold. Bitcoin's supposed to be digital gold, but gold, physical gold, has done a lot better than Bitcoin this year.
Oh yeah, I mean, it's definitely been a bit of opposites this year. I mean, gold's had a record year, 60% plus, while as Bitcoin, I don't know about the term crypto winter, when Bitcoin's around 90,000 a coin, a couple 100% higher than it was five years ago. Crypto winter's not what it used to be, I guess. Right. But you still have this situation where it's clearly not digital gold if gold can have a record year and Bitcoin can be down in the same year.
Do you think that gold is, I don't know how much you allocate even to crypto, but do you think that gold will continue to be an outperforming asset next year?
Long term, I'm both bullish on gold and Bitcoin, but I think it's important to take a little bit of a step back and not treat investing as gambling. I think when people make these predictions of, hey, it's going to go down in the first half of the year and up in the second half of the year, it gets to be a bit of a parlay bet as opposed to something that you can say that there's a really clear reason for. I think there is a very clear reason why gold makes sense in a portfolio, and I also think there's a great reason why Bitcoin makes sense in a portfolio, largely because the dollar doesn't make a lot of sense, because if I owed $38 trillion personally and I was spending $1.9 trillion more than I was bringing in, and I had a printing press, there's a pretty good chance I'd use it. And that long term is both bullish for gold and for Bitcoin, but what happens in the near term is too hard to predict.
And what does gold do for you that Bitcoin cannot?
So what gold does that Bitcoin definitely can't is it's an actual alternative as a reserve asset to a currency, meaning that Bitcoin is really a retail play, whereas gold is very much institutional, meaning that if you look at all the central banks, they're huge owners of gold and they're hoarding gold and they're buying more in a big way to replace dollar reserves, because they don't trust the US as a solid ally for many of these countries, especially those that are not allies, to treat them the way that they'd like to be treated, which I'd understand. If I was China and I held 760 billion of T-bills and I saw what happened to the 300 billion of Russia's treasuries, where we know where those went, I would probably want an alternative. It's just that Bitcoin isn't an actual alternative yet, aside for retail, which makes it a risk asset, whereas gold can really be risk off.
And Mitch, finally, I want to ask you, we're talking about gold, we're talking about Bitcoin, we're talking about these digital asset treasuries. What do you think is going to be most attractive across these categories going into next year?
Well, I think you have to kind of choose carefully. So we're talking about Bitcoin, obviously, but there's no doubt that stable coins and the whole blockchain space and the need for cheaper, faster, borderless transactions is a thing. So I think you really have to look there, and obviously Ethereum might still continue to outperform. It started to, and then of course sold off with Bitcoin, but that would be a place that I would be looking at blockchain itself, at any instruments that are related to stablecoins. So right now we have Visa, MasterCard, PayPal, all these companies talking about these borderless transactions that they're using. And then of course I'd look at Ethereum itself, and I still wouldn't discount Bitcoin, but maybe in terms of that be at the bottom. And of course I love gold. I've loved gold for years already. And I love silver. And obviously you have to kind of love platinum and palladium right now, although I don't really trade those metals as much. But I see gold 4,700, maybe 5,000. Silver right now touched at $69 this morning. I was looking at about 75. But these are the moves that are really showing other cracks. And that's why I don't think those cracks are going to go away. So I'm very bullish in the metals still.
Bitcoin falling once again in the last full trading week of 2025. And Yahoo Finance's Inez Ferre is here with more. Inez.
Josh, you're looking at Bitcoin that's below 86,000. I'm going to pull up a year-to-date chart so you can see Bitcoin down 9% year-to-date. But take a look at where we have been over the last couple of weeks, because Bitcoin has been unable to hold the 94,000 level that we saw just last week. So there aren't a lot of catalysts that are sending crypto higher. Look, you've got the Bank of Japan that may be increasing interest rates, and that would be bearish for assets like Bitcoin. You have liquidations, you have traders that are talking about trading volumes that have been depressed. You've got the lack of conviction when it comes to crypto. So what you could see with Bitcoin, for example, is some consolidation period. The same with some of the other tokens as well, as we've seen Ether down more than 4% today, unwinding some of the bumps that it saw last week. And then just taking a look also at the difference between what we've seen with crypto and what we've seen with the metals, which is like night and day. So if you take a look at gold, gold is nearing a new high. It is at 4,343. If we take a look at a year-to-date chart for gold, I mean, it's just unstoppable. You've got Wall Street that is bullish going into next year for gold. You've got the whole debasement trade that's going on with the metals, with silver as well, as we're watching silver up more than 115%. Year to date. Even the copper trade has been bullish this year because of demand, because of the tariff concerns, but because you've got hoarding that's happening in the US, but also because of the AI demand, because of electricity, the grid. All of that is going to require copper, and that's why we've seen the metals rally this year. Very different picture than crypto.
A number of companies that have used crypto to boost their share price. Never has ended well, probably never will.
Before I came on, Noel, there was a good post out there on X. I believe that Michael Saylor has come out and bought $1 billion worth of Bitcoin. What's the signal you think he's trying to send to market? I mean, of course, Michael Saylor, very bullish, always on Bitcoin and crypto, but how does the crypto market take that at a time where prices, they have stabilized, but things are still volatile out there?
Things are volatile. I would say they're muted as well, and there are many factors behind that. Michael Saylor's move comes after there were many concerns floating around on X that, hey, he's not buying what's going on here, because we're so used to counting on that steady buying force in the market. We have to remember now, though, Brian, that he is just one of many digital asset treasuries, the largest easily, but others have pretty much stepped back, and some of them are even selling. So while he is an important force, he's no longer the only one, and there are offsetting factors.
Tim, Fed comes out this week, cuts rates by 25 basis points as people expect. Is it Bitcoin back to record highs?
Well, Brian, I think it raises a lot of questions for various different asset classes. And one of the things that we're really focused in on right now is who's going to be the president's pick for Fed chair next year. I can tell you one thing, they're going to be more dovish than Jay Powell was. And I think that has ramifications across many different asset classes. For Bitcoin, we would view it as a positive. We think this spooks, the same narratives that we've seen spooked all year long. And we also think it's a boon for different asset classes like small caps and even a broadening out in the S&P 500. Lower rates we think can be a catalyst to help propel small caps forward. We think it can also help stocks outside of the Mag 7 really start to accelerate their earnings. So we're preparing for a more dovish Fed next year for more rate cuts, and we think that has ramifications for small caps, and we also think it's bullish for Bitcoin.
You think the lows are in for Bitcoin for this year?
It's tough to say, Brian, but one of the things that we've noticed this year and really over the last several years is you're seeing this asset class mature, right? Volatility is starting to come down. Even in a year what we would consider to be more of a crypto winter, right, this year, you're seeing volatility come down. And I think that is just a different phase that we're heading into. And broadly speaking, Brian, we definitely think this opens up more pockets for various investor types to really get involved and really drive the price higher. So, you've seen these drawdowns before. 30% drawdowns are nothing new for the asset class, but we think we're heading into a new era, which is really going to open up new pockets for different capital that didn't exist before.
Michael, so good to see you right off the jump here. Look, we had Bitcoin hit a record high just a few weeks ago, $126,000. We've seen this pullback here over the past few weeks. I look at strategy stock down about 27% over the past month. Are investors losing faith in the Bitcoin movement?
No, I don't think they're losing faith. If you're an investor, it really comes down to what your time horizon is and how much volatility can you stomach. So if you want max performance, you're going to take max volatility. Strategies up 75% a year on average for the last 5 years. So you can actually outperform Bitcoin if you buy an equity that's amplified like MSTR. If you don't want to trust anybody, you want no counterparty risk, you buy Bitcoin. Bitcoin's up 50% a year over 5 years. No counterparty risk. It's very straightforward. If you want to have your cake and eat it too, you could buy some convertible preferred like STRK. STRK will get the vol. The vol on MSTR is like 60, 70. The vol on Bitcoin is 45. STRK would get your vol to like high 20s. And you get a mixture of a dividend and principal protection and some of the upside of the common equity. And if your time horizon is less than 4 years and you don't have much volatility to stomach, you shouldn't buy the equity or the equity hybrids. You should buy the credit, something like STRC. STRC is meant to be very, very stable, around $100 plus or minus a few pennies. And you get like a 10 and 10.5% dividend, that's tax deferred, and you're getting the benefit of the crypto economy, but you're not on the volatility roller coaster. So everybody's got different risk tolerance. They've all got different pools of capital. The good news this year is now you've got a variety of different instruments you can use to ride the digital wave.
Michael, and as we've gotten more instruments to ride the digital wave, particularly as people have had more and more ways to directly invest in Bitcoin, strategy stock has not done as well. To your point, it has over the past several years. But again, if you're talking about getting in now, or if you got in earlier this year, you wrote it down even as Bitcoin was going up. Are you concerned at all that the crypto treasury, the digital asset treasury strategy that you pioneered is losing a little bit of steam?
Over the last year, there's been 100 companies that have added Bitcoin to their balance sheet. The derivatives market and Ives has surged. The flows into the ETFs have surged. All the major banks have announced support. The accounting has dramatically improved. The tax regime has improved. The administration support at the SEC, the CFTC, the Treasury level has improved. And so, and the technology has improved. Companies like Block have rolled out support for Bitcoin on Square and Cash App. So all the fundamentals are good. If you're going to be an equity investor, you have to think for yourself, and you have to have a time horizon of 4 years or longer. And equity markets are either going to lead or lag, and occasionally they'll perfectly reflect reality, but generally it's only a few days a year when they'll be perfectly rational. So if you don't have that 4-year time horizon, and if you don't want to make decisions based on fundamentals, if you simply want to park your money in a stable instrument and pick up a stable yield, you should be a credit investor. You shouldn't be an equity investor. I think the irony is the fundamentals of the industry are so much better today than they were 12 months ago, that you've now got an extraordinary risk-reward opportunity. Now's a much better time to invest. You know all the things that you wanted to happen have happened. The market sentiment is negative, but that's an opportunity for the equity investor that makes their own decisions.
Michael, you're seen as a pioneer in this industry, charting new territory in cryptos and Bitcoin. What do you think about the likes of a Jim Chanos and others like him that are trying to profit off of you not doing so well?
I don't really think about Jim Chanos. I think that there'll be some skeptics. They don't really appreciate what Bitcoin is doing. They don't understand digital capital. They don't understand digital credit. But at the end of the day, the big dynamic in the industry is digital capital has gone from nothing to $2.5 trillion over 15 years. Digital credit didn't exist 12 months ago. We've issued nearly $8 billion of digital credit. Digital credit has got a tax equivalent yield of 4 times higher than bank credit. You can have a bank account, in New York City that pays you 4% and it's taxable, or you could buy something like STRC that pays you 10.5% that's tax deferred. So the market's evolving, and the short sellers aren't really interested in the impact of AI or the impact on digital assets to change the way the world works. They're just interested in being skeptical as a business. So I don't really focus on them. Nothing great has ever been created by a short seller.
Michael, you've referred a couple times to this new digital asset credit that you guys have developed, STRC Stretch. It's a preferred security that, as you mentioned, pays out 10.5% in yield. And this is also a way for you all to not necessarily issue more stock in the underlying equity in order to pay for buying more Bitcoin, and therefore maybe not diluting those underlying shares as much. But how far do you think you can take that as sort of a funding mechanism for your Bitcoin strategy?
Well, I think the money market industry is massive. There's $30 trillion worth of assets invested in treasury-type instruments in the United States. Stretch is about 1% of 1% of that industry. It's about a $3 billion issuance. And the big idea here is you take an asset appreciating 50% a year with a volatility in the mid-40s, and you strip the volatility from 45 down to below 5, maybe to 2, 3, or 4, or even 1. And then you extract about 10% dividend yield. And if you do that, you end up with something which is yielding 6% more than the risk-free rate. And when the vol gets to 1, you've got a Sharpe ratio of 6. So we're really engaging in financial engineering to distill pure currency yield above the risk-free rate. And of course, the common stock shareholders in MSTR get the difference between the 10% that we pay and the 50% that Bitcoin's been performing. Long term, the math is pretty simple. We expect Bitcoin to appreciate about 30% a year for the next 20 years. We expect to pay about 10% dividend yield on the preferreds. 2/3 of the benefit go to the common equity shareholders, and most of the volatility is stomached by the common equity shareholders and the corporation. And the credit investors get this pure 10% return of capital dividend. That means it's tax deferred. They don't have to pay tax on it until they sell the underlying instrument. And that means that they're able to invest in a credit instrument that pays them a 10% dividend instead of holding a money market that pays them 4% and a taxable coupon.
Michael, of course, we're having this conversation the day after the government shutdown officially has ended. Things have to restart up again, but still record-setting shutdown. What did you think about the length of the shutdown, and do you believe it reinforces your long-term view on Bitcoin and various other cryptos? Because look, at the end of the day, record-setting shutdown, I mean, how can you have trust in the dollar?
Well, you know, we joke there's no tariffs on Bitcoin. Bitcoin has no employees. It's got no corporate headquarters. It is an index reflecting the digital economy or the global digital economy. So if you just like to buy 1/21 millionth of the global free market, then you buy one Bitcoin. As people lose confidence in a currency in Africa or South America or Asia, as they lose confidence in a government, if they think that their favorite company might make a mistake, war, famine, pestilence, fire, flood, uncertainty, acts of God, all of these things are risk factors, and they're all risk factors that Bitcoin doesn't undergo and doesn't experience. So as people get educated, I think they can see the appeal of buying digital capital instead of investing their money in equity capital or real estate capital or fiat capital or corporate credit capital instruments. And so this is all a teaching moment, but I think that every single month that goes by, more and more people start to appreciate the benefit of owning 1/21 millionth of all the money in the world forever.
Michael, do you think, in light of the shutdown, that investors have lost faith in our country?
No, I don't think they've lost faith in our country. I think the country's going to do just fine. This is a hiccup. It's not our finest moment, but right now, the exciting things that are going on are digital intelligence, digital assets, digital capital, digital credit. It's pretty clear that money's going to move at the speed of light. It's pretty clear that 1 billion AIs are going to think 1 billion times faster than us human beings. You can see a world where 1 billion robots are going to build everything we need, where the cars are going to drive themselves, where the products are going to figure stuff out for us. So we're moving toward an intelligent world that is millions of times more efficient and more empowering. So in a world where 1 billion robots do everything I want before I think to ask for the thing, I don't know how I won't be better off.
Michael, is there a risk that some of those robots or perhaps quantum computers combined with generative AI, that they crack Bitcoin, or that they think of something better than Bitcoin and it becomes obsolete?
No, I don't think there is a risk. I think that technology will improve and hardware will improve, and at some point, if the hardware gets more powerful, we'll have to upgrade the software that protects our system. So just like you can expect your bank to upgrade their software, and you can expect to upgrade your Apple software and your Google software and your Microsoft software, and you can expect to upgrade your hardware devices. I'm on the iPhone 17 Pro Max right now. You'll upgrade your computer. Bitcoin is a protocol, but it runs on hardware and software nodes all around the world. The hardware is being upgraded every few months. The software is being upgraded annually. And so the software and hardware that runs the Bitcoin protocol is going to get upgraded just like your Apple and Android and Microsoft software will get upgraded.
I was going to say Tim Cook's sending you a check in the mail, but I guess now Microsoft and Alphabet have got to send you a check too, because you mentioned all of those. Let's talk a little bit about the bigger market because of the AI advances that you're talking about. You know, you're very familiar with the dot-com bubble, right? Because you founded MicroStrategy in '89, you went public in '98. I was looking at the history of the stock chart here. You went public at $12 a share. The stock at that time spiked as high as $313 in 2000. And then crashed down or remained below 20 until you initiated your Bitcoin buying strategy. I'm curious, you know, as you look back at that crash, what that taught you and whether you see any parallels today. Obviously, you're aware of the big bubble debate going on right now.
I think it teaches you to focus. overextend. You might have 10 good ideas, but you're better to focus upon your one idea and commercialize the one idea. It also just reminds you that no matter where you are as a corporation, you can always improve the company's outlook, and you can improve and create shareholder value by harnessing the next wave. People wrote off Apple for dead. I mean, Michael Dell famously told Apple to shut down and give the money back to the shareholders back around 97. And then Steve Jobs returned and he harnessed the internet, and then he harnessed MP3 files and digital music in order to revive Apple, and then eventually created a crazy thing called the iPhone, and it became the most valuable company in the world. I think history is replete with examples, whether it's the internet or whether it's AI chips. People wrote off GPUs as being irrelevant, and all of a sudden we have the ChatGPT moment. The Bitcoin miners were struggling, and then AI explodes, and now everybody wants their energy. I think that digital intelligence, digital assets, digital capital are creating the most compelling opportunities for corporations in the world today. I think the important thing is to use them the right way. For example, we used AI in order to design those 5 digital credit instruments. So people ask, how do you make $1 billion with AI? Well, we created $8 billion with AI just by designing new types of securities. Yesterday, STRC traded $175 million. It's the most successful preferred stock in the century, maybe ever in the history of the capital markets. It was designed completely with AI. It's 100 times better than a good preferred stock. I would encourage anybody with any corporation to think about how you turbocharge your company by using digital assets, digital currency, digital capital, or digital intelligence. There isn't a company that you can't improve using technology in the year 2025.
Michael, later on in the program, I'm going to be sitting down with Eric Trump and Asher Ganut. They're, of course, working American Bitcoin and Hut 8 mining those operations for American Bitcoin. And I know they're very focused on power generation. As you look at your long-term outlook for Bitcoin, other cryptocurrencies, how concerned are you that this country can't produce the power it needs to meet the demands of cryptocurrency?
I think the company got a wake-up call. Back in 2020 and 2021, I talked to a lot of power companies and energy companies, and they were about to decommission all their nuclear reactors. We were staring at all the nuclear reactors getting decommissioned, and there was a movement to shut down nuclear energy in this country. And of course, in Germany, they shut them all down. From early 70s, 73, all the way till 2023, the nuclear industry was persona non grata, and it was politically incorrect. And I think the explosion of AI, and when people started using these AIs and realized they're actually quite useful and they're transformational, it created a reconsideration and a political shift in the United States. The Overton window shifted. And as soon as Google and Microsoft and Apple and Amazon realized they needed energy, nuclear became cool again. And we flipped from 50 years of not wanting to build power, whether it's nuclear or natural gas was out of favor too. People wanted to shut down natural gas. All of that changed in the past 2 years. And now the political sentiment in this country is we should develop natural gas, we should develop nuclear power. And of course, we're only about 1 to 2 years into that sentiment shift. But I have confidence that the United States is going to move from a laggard to a leader in the energy generation business, because now we see we need the energy to drive our cars, we need the energy to power up our robots, we need the energy to think 1 billion times faster, 1 billion times quicker, and we need the energy to defend our digital assets like the Bitcoin network. And the only thing that was lacking was the political will, and I think that has flipped 180 degrees. There's bipartisan consensus. There's not even a debate right now about whether we should generate more energy or build more power plants. 4 years ago, you couldn't have done it. And so I think we've been saved by the explosion of digital intelligence and digital assets in this country. It'll be good for the nation. It'll be good for the world.
Michael, obviously you're a serious guy, right? We've talked a number of times. You think very deeply about all these issues. But then sometimes I look at your X account and I see you posting or reposting these various sort of digitally generated images, AI generated images of yourself. They're a lot of fun, right? Of you, we're showing one of you in a top hat, various Bitcoin paraphernalia, superheroes, etc. Like, you know, I'm just curious how you think about that. Is that, you know, is your Bitcoin, you know, advocacy, is there an element of shtick to it as well? Are you having a little fun with it? How do you think about all of that?
You know, when I was growing up, there were 3 channels on television, and they turned off the television, the signal at like 11 o'clock at night or midnight, and for 8 hours there was no programming. There was no internet. We didn't have, today, we have infinite free music, infinite free television, infinite streaming video, infinite free YouTube. You can get lost, fall in a TikTok hole, an Instagram hole. You can get on stream and Twitch. We have managed to manufacture infinite everything. It used to be you had to have money to get a newspaper or a magazine. And now you can see we live in a world where we have, to say 1 million times more content would be probably an understatement. So the entire society is being inundated with information, and their attention span has shrunk. And so people just don't have an hour to listen to what you have to say. Sometimes they don't have a minute. Oftentimes I think, you know, should I say it in a podcast? Well, maybe someone will listen to it. Can I say it in 5 minutes? That might be too long. Can I say it in 30 seconds? Sometimes I'll write a paragraph and you think, no, I don't have a paragraph. People will read the first sentence, and then I write the sentence and I think people aren't going to read to the end of the sentence. And so the thing you learn from social media is you need to get to the point. So how about tell me what you want to say in 1 second? And the cliche is a picture is worth 1,000 words. And so sometimes I don't give you 1,000 words because you would lose 99.9% of the audience. In fact, I would say you'd probably lose 99.99% of the audience. If it took 1,000 words, show me the picture, and that will go viral. And you're doing people a service to give them an idea that travels 1 million times faster, that is 1 million times easier to digest, because people just don't have time. They're busy. They're being inundated. And when you see those images, that is us communicating something cheerful, constructive, useful, perhaps profitable to someone. But, you know, like if someone says, hey, I wrote a book on this, here's the book, do you want to read it? I mean, how many books can you read? You know, literally every book written in the history of the human race is available for free to you right now. Do you really want someone with a good idea to give you 250 pages and tell you to read it? Or do you just want them to boil it down to 1 sentence, 1 tagline, or 1 picture? Because I'm like, show me the picture. Okay, got it. Now I can move on with my life. Thank you.
You're making a lot of sense to me, Michael. Stay with us for a second. Let's bring in our social correspondent for the day, Yahoo Finance's Ali Canal, with some of what she's hearing from our online audience during this interview. Ali.
Yeah, well, Brian, Michael Saylor just talking about infinite content on social media, which is the perfect segue since we are talking and taking your questions on social media. Plenty of viewers chiming in, and starting off with a strong one here, Michael. First question, do you see Bitcoin catching up to and surpassing gold's market cap by 2035? What say you?
I do. I think we're in a Bitcoin. We're in the digital gold rush, and 2035 is the 0.99 year. That means that 99% of all the Bitcoin will have been mined in the year 2035. If you want Bitcoin, you need to get it between now and then, because the last 1% of Bitcoin comes out over 100 years. Yeah, there's no doubt in my mind Bitcoin will be a larger asset class than gold by the year 2035.
And another social viewer wants to know, why should an investor buy strategy stock instead of a Bitcoin or spot ETF?
Yeah, if you don't want to take any counterparty risk, and if you have a long time horizon, then you should probably buy the Bitcoin because you can take custody and take it anywhere in the world. If you simply want the asset, you want it in a brokerage account, you should buy the ETF like IBIT. It's going to take you 10 seconds to do that. It's easy to borrow against it. If you're a believer and you want amplified exposure to digital capital, and also if you believe in digital credit, like our mission at Strategy is we want to give 1 billion people a bank account that pays them 10% tax deferred. If you think that's a cool idea to give someone in Japan or Europe or Switzerland or New York City a bank account that pays them 10% with no volatility, and if you think that Bitcoin can power that, then you're buying our stock because we're a digital credit factory. And if you want to outperform Bitcoin and you're ready to get on the roller coaster, you should buy the equity. But if your time horizon is less than 4 years, if you need the money back in 4 weeks or 4 months, then you probably want something principal protected. You want low volatility. You should buy a credit instrument. Like STRC is literally designed to get the vol, down. Right now it's 7, whereas Bitcoin's vol is 45 and Strategy's vol is 65. And if you want something that's going to be extremely low vol, you should buy a credit instrument like a treasury credit product like STRC. You'll outperform your money market. You might very well do as good as the S&P index, but you'll be able to buy it and sell it and get your capital back.
The Federal Reserve just released the minutes from its December meeting showing a tight split over the latest rate cut. Yahoo Finance senior Fed correspondent Jennifer Schomburger joins us now with the details. Jen?
Hey there, Brooke. That's right. Cutting rates in December was a close call for some on the Federal Reserve. While some think it will be some time before they cut rates again, according to minutes from the December policy meeting that were released this afternoon. Those minutes read, quote, most participants judged that further downward adjustments to the target range for the Fed funds rate would likely be appropriate if inflation declined over time as expected. With respect to the extent and timing of additional adjustments to the target range for the Fed funds rate, some participants suggested that under their economic outlook, it would likely be appropriate to keep the target range unchanged for some time after a lowering of the range at this meeting. Now, when it came to cutting rates this month, officials were split. While most officials did favor cutting rates because of concerns about the job market, there were some who favored holding interest rates steady because they are concerned that inflation has stalled here. Now, there were some who did vote in favor of cutting rates, but could have voted in favor of keeping rates unchanged because they thought we're going to get a bunch of new data post-meeting that will better inform our decision about whether we need to cut rates again. And still, there were a few, some of which we know, including Kansas City Fed President Jeff Schmidt, who thought a rate cut was not justified because there wasn't significant deterioration in the job market. Now, looking ahead to next year, as far as the outlook for inflation and the job market, Fed officials still believe that inflation will remain, quote, somewhat elevated in the near term. They do think, however, that any upward pressure from tariffs on inflation will begin to subside, though the extent and timing of that remains uncertain. And there is a concern that perhaps the upward pressure and tariffs on costs for businesses could still be passed on to consumers. So they're keeping an eye on that. Now, when it comes to the job market, they think that that will stabilize next year, though the outlook is uncertain because we have had a delay with official government data due to the shutdown. Still, many see downside risks to the job market. Bottom line here, Brooke, these minutes signaling that the Fed is not likely to cut rates again anytime soon.
Now, Jen, to add to all of this, President Trump is also threatening to sue Fed Chair Jerome Powell and saying that he would, quote, love to fire him. I mean, how much of a risk is this for the Fed in 2026?
Yeah, I mean, look, I would never put it past the president to do something on this front, right? It's always on the table. But these comments that you referenced, which the president made late yesterday afternoon, he also said in the same sentence that look, it is kind of close to the time with which I'm going to be nominating the next chair of the Federal Reserve, so maybe I won't do it, maybe I will. He left the question mark up in the air. But by the time he does announce that nominee and that nominee goes through the confirmation process, it's just about time for that person to take the helm. So it may not be worth it for the president to do that. If he were to bring a lawsuit, I would expect that it would escalate to the Supreme Court. Something that we have seen with Fed Governor Lisa Cook, a case that the High Court is going to hear next month in January. So it's
Jennifer, so what are the policy implications that we can expect next year?
Hey there, Jared. Good morning to you. Happy holidays. We are going to be seeing a change in composition of the central bank with the new year that could bring implications for policy. At the beginning of every year, we see a rotation off of 4 regional Fed bank presidents who were voting members and a rotation on of 4 new ones. Rotating off of the committee at the beginning of the new year are Kansas City Fed President Jeff Schmid, Chicago Fed President Austin Goolsbee, both of which were hawks and dissented at meetings this year. We will also see Boston Fed President Susan Collins roll off, as well as Alberto Musalem of the St. Louis Fed. Now, rotating on to the committee as a voting member next year are Cleveland Fed President Beth Hammack, Lori Logan of the Dallas Fed. Both of those ladies are hawkish. They have said outright that they are not concerned about the job market right now. They're more concerned about inflation, and they favor holding rates steady at this point. So 2 major hawks joining the committee next year. We will also see the new head of the Philadelphia Fed, Anna Paulson, join. She leans more dovish, however. And we will also see Minneapolis Fed President Neil Kashkari, who will join. He hasn't spoken in public about his views on monetary policy for a good month and a half, though the last time we heard from him, he sort of seemed to lean more hawkish, saying that the bar was higher for further cuts. So net with those 4 members, slightly leaning dovish with the addition of the Philly Fed president. Now, we will also see a new Federal Reserve chair next year who will take the helm in May. And President Trump is expected to name this person early next year, and he has said that this person must favor lower interest rates. So we know that the new Fed chair is going to lean dovish. However, he will have to contend with the rest of the committee. And the rest of the committee at this point, after having done 3 rate cuts, insurance cuts, if you will, at the end of 2025, is more hesitant to do further rate cuts in 26. They've certainly signaled that they're looking to take a pause in January, and they've only penciled in 1 rate cut for the whole year. So while we could see overall a committee that leans a little bit more dovish, there are a number of hawks on this committee that could hold things back and certainly will be loud voices. And lastly, Jared, I just want to add that we need to watch the Supreme Court case in January with Fed Governor Lisa Cook and whether President Trump has the authority to fire her, because if he does, then she will be replaced by a member who will probably be more dovish. And we also have the Atlanta Fed President, Raphael Bostic, who is retiring in the end of February. We don't know who the replacement will be, if he or she will lean dovish or hawkish. However, that person will not have a vote until 2027.
Great rundown there. I'm going to get my popcorn. I want to ask you, I mentioned Brian Moynihan. He's the chief of B of A, and he made some comments about Fed independence, which you were just talking about. Maybe just tell us briefly about that.
Yes. So as we know, President Trump expected to name a new Fed chair in the new year who will take the helm in May, as I mentioned. And he has said that the requirement is that that person needs to favor lower rates. So there is concern that perhaps whoever the next Fed chair will be will not be perhaps as independent as every other Fed chair we've seen over the course of history because of what the president wants. The president wants loyalty. And Bank of America CEO Brian Moynihan warned over the weekend on CBS's Face the Nation that the market will punish people if we don't have an independent Fed. And everybody knows that. However, I would just note, as I mentioned, this is a committee that sets interest rates. It's not just the Fed chair. And so if the Fed chair is in favor of lowering rates, but many others on the committee are not, he is going to have to contend with that. So I think we will see perhaps more of a dovish slant, but we could see a very large number of dissents given the amount of hawks that are also on the committee next year. It'll be very interesting to watch in the second half of next year.
Yes, you don't often see this level of division. I mean, we have to see how the year plays out at the Fed. Thank you for that report, Jennifer.
The global economy is rapidly evolving from shifting monetary policy to inflation pressures and structural changes thanks to technology. In the backdrop, record-setting markets that are sparking fears of a correction, or even worse. Joining me now is Mohamed El-Erian, Allianz Chief Economic Advisor. Mohamed, a real treat to have you here at Invest. Thank you for always making time for us. Let's start out of the block here on cockroaches. There's a lot of talk on Wall Street right now on cockroaches, and this essentially is risks coming out of various places, and it's hard to stop them. What say you? Where's the next, I guess, economic cockroach to be found?
So let me just say, we will have cockroaches, but not termites. And this is a fundamental differentiation. Cockroaches are unpleasant. They come in groups, but they don't eat away at the integrity of the system. Termites eat away at the integrity of the foundation. So why are we going to have cockroaches? We're coming from a period where people have stretched really far for additional returns. They have been encouraged to do so by a strong economy, by very loose financial conditions. And some people went beyond their comfort zone and beyond their ability to do due diligence. So I don't think we should be surprised that we will have these accidents, these credit accidents. We'll have some economic accidents, but I don't think we're going to have any systemic shock.
That is, of course, a good thing. And when you mention potential economic accidents, what keeps you up at night? Well, what are you most concerned about for 2026?
So what used to keep me up was a trade war. But the US has been able to impose higher tariffs without triggering much retaliation. So that doesn't keep me up as it used to. What does keep me up is what's happening at the lower ends of the income distribution for households, where there is significant pressure. And what keeps me up is the amount of debt that has to be refinanced at higher interest rates. So those two things are potential areas of pressure, which would be made worse if we get a policy mistake.
Mohamed, you bring up a really great point. It's something I've been thinking on very deeply of late. We've seen tremendous wealth created in the market this year, and the bull market has continued, but we're not seeing it. I guess this goes to your point. We're not seeing it translate into that average U.S. household, that lower income consumer. Is that cohort of the U.S., are they in a recession?
They're near recession, and they are spreading this concern about affordability, which is not just an economic issue, it's a social and political issue. The first shock to affordability was, of course, the 2021-2022 inflation shock. But that was offset, Brian, by income transfers. Now we have inflation stuck at 3%. We have insecurity about future income. The Challenger report showed you that layoffs were surging. AI will change the workplace. And in addition, we have high debt and credit cards that have been maxed out. So there is real concern on the bottom bit of what people call the K-shaped economy. And this is not isolated concern. If the lower household incomes stop spending, not because they don't want to spend, but they're not able to spend, that will contaminate upwards for the economy as a whole.
So you think that pressure on the low end, so the high income consumer, the person that is exposed to the markets, they've enjoyed a good year, they're not immune to what's happening on the low end.
Okay. So they're doing fine. They're doing fine from an income perspective. They're doing fine from a wealth perspective. So I'm not worried about middle to upper class. I am worried about lower income households and their ability to continue to navigate this uncertain environment.
How do we bridge this gap? Because if you listen to the current administration, Mohamed, they are talking, the president has floated a potential $2,000 dividend. There's been interest in that. The one big beautiful bill was passed. More jobs are being created in the U.S. in terms of tech companies building out AI data centers. Like, how do you bridge that gap between what's happening on the high end and low end?
So they also, you could have added to that list that they've moved on some very sensitive prices, gasoline being one, and the other one being some pharmaceuticals. So they are taking steps, Brian, but this has been long in the making. This is not something that is recent, and therefore it is deep-rooted. It is made more complex by two other issues. One is the difference between real and perceived. And the other one is the difference between relative and absolute. So it is a really complicated issue. And if you go through it, the bottom line is it will take years of effort, both on the income side and the price side, to get us out of these situations.
I want to leave enough time in this conversation, Mohamed, because you are known as a foremost thinker on Federal Reserve policy. It has been quite the year for all things Federal Reserve, of course. Attacks from the Trump administration. We're coming up on the end of Chair Powell's tenure. Where is your head at as it pertains to the Fed in 2026? What is a new Fed chair? What will they bring? And where do you see the ultimate endgame for rate cuts this cycle?
What a new chair will inherit is a divided Fed. And it's divided by two things. One is whether they are sensitive to the employment side of the dual mandate or to the inflation side of the dual mandate. Both are flashing yellow right now. So it does matter where your bias is. And what we see is that people are on both sides of this divide. The second thing that they will inherit is a division between people who are totally comfortable being backward-looking, so-called data-dependent, and those who realize they also need to be forward-looking. They need to have a strategic view of the economy, and in particular, Brian, of something you've been talking about a lot, AI and its impact on productivity and growth. So what a new chair has to bring is a unifying narrative. And I think that narrative has to be forward-looking. And the new chair has to have a view as to what the future economy looks like. I am a great believer, as you know, in the promise of AI. If we get diffusion right, we will have a significant productivity increase. And as a result, monetary policy will be able to be looser than it would otherwise have been.
Do you view the attacks on the Fed and what it does for the administration, will that leave lasting damage on this institution? And if you do think that's the case, what does that damage even mean to markets?
So I believe deeply in the independence of the Fed, deeply, that I think a Fed with policy autonomy is the best thing we can have. But I also believe, as you know, that this Fed went to sleep. There are many areas of reform that require attention. There are many best practices that from the rest of the world that we should be looking at more seriously. And there's lots of hard questions that we need to ask, including what is the right inflation target in a structurally changing economy. So the good news is you're starting to hear debate from within the Fed. You've had two Fed officials, as you know, come out and saying, maybe we should have a range for inflation, our inflation target, not a point estimate. You've had another one come up saying we target the wrong intermediate policy variable. So I'm encouraged by the fact that the Fed itself is now finally talking about reforms. And that is something that, if you look at the 5 candidates on the short list, all of them understand that you need to reform the way the Fed operates. Otherwise, the Fed will continue to be behind. And if you look at the recent years, not only have we had decisions that were too late, but we've had a culture issue. We've had 5 officials that were accused of irregularities. So I think it's really important to reform this Fed. And what this political pressure has done is it has made certain Fed officials realize that it's better to reform from the inside than to have it imposed on you.
The 5 contenders you mentioned on the short list for the next Fed chair, do you have confidence that they will keep the Fed independent?
I do. I think all of them understand the history of central banking. They understand the importance of keeping the Fed independent, but they also understand that an independent Fed needs to be an accountable Fed, and an independent Fed needs to reform itself to keep up with changes. It is striking to me, Brian, that we don't have external members serving on the FOMC, like the Bank of England does. So we end up with groupthink, and that groupthink ends up by the Fed being behind. We saw that in 2021, 22, and we've seen it again this year. So there are things that can be done and should be done, and I think that all five realize that an independent Fed is critical, but it doesn't mean a Fed that goes to sleep on how it operates.
Do you think the 2% inflation target should be scrapped?
I don't think it should be scrapped. I think it should be changed. I have been of the view that a better inflation target is a range, not a point estimate. A point estimate suggests precision that is elusive. Second, that range should be higher than 2%. It should be the 2.5% to 3%. And what is undeniable is that we are at a stable 3% inflation, and that hasn't in any way unanchored inflation expectations.
Out of the five candidates, Mohamed, look, I agree with you. These are incredibly qualified people. Of course, shout out Rick Reeder, friend of Yahoo Finance. We all know him very well. What do you think their biggest problem they will have to solve? That first 6 months on the job of leading the Federal Reserve after a long tenure like Jerome Powell has had, what do they need to get right out of the box?
Shifting the Fed from an excessively data-dependent, backward-looking institution that is reactive to one that has the confidence to take a strategic view and be proactive. That's going to be a major change that is really needed, has been needed for a while, and that hasn't happened under Chair Powell.
I wanted to get back to what you mentioned on AI and productivity. You can see AI chatbots, at least for now, this current wave of innovation is already starting to drive a lot of productivity. How much of a risk is it to jobs around the world? How concerned are you?
I'm concerned mainly because of the corporate mindset, Brian. If you look at the promise of AI, there is a labor displacement risk, and there's a massive labor enhancing opportunity. And the worry I have that with the exception of a few companies, the mindset right now in corporate America is about cost minimization. AI is viewed as a cost minimizer. What AI really is an enabler, a productivity enabler that gets there from better work and more work. And I worry a little bit that the mindset is too focused right now on cost minimization, because the real promise of AI is not labor displacement, it's labor enhancement.
I told myself coming into this, Mohamed, I didn't want to be that guy that asked you about a bubble. I just think it doesn't capture the nuances it deserves. So let me, if I can frame it a little more academically, how concerned are you that AI stocks are grossly overvalued?
So let me share the work that I've been doing with Mike Spence, a friend and a Nobel Prize winner. We believe that we are in a rational bubble. So yes, there are elements of a bubble. And there's three elements in particular of this bubble. First, the frontier, those working on foundational models. Not all of them are going to succeed. And yet all of them are attracting significant investment. Second, diffusion isn't being talked about enough. Diffusion means getting AI into the workplace in an orderly fashion, in a comprehensive fashion. We don't have a diffusion policy so far. Other countries, China does, UAE does, we haven't. We've got to get diffusion right. Otherwise, the promise of AI is not going to be fully realized. And then you and I remember the dot-com era. We remember companies simply putting a label on what they do and attracting investment. Well, that label today is AI. So there are elements of a bubble, which means that people will end up with losses. But the aggregate value of what's being created is significant. And therefore, the rationality part comes in, Brian. It makes sense to take a venture capital approach to AI. The payoff is so large that it is rational to have multiple investments and to overinvest. So the good news is that it's a construct that will make us more innovative, more competitive. The bad news is there will be tears, there will be losses, because elements of it are elements of a bubble.
I wanted to leave Invest viewers thinking with one deep thought. And let me come at you with this question, Mohamed, before we get going here. If you were writing a short message to policymakers right now, one key action they should take, what would it be and why?
That realize that our future is going to be at the tails of distribution, not in the belly. For a long time, we grew up with unifying themes, the Washington Consensus, globalization. We are now living in a world of fragmentation, in a world that structurally changes. And what happens at the tails are going to determine where we end up. So don't get fooled by a normal distribution, a bell-shaped distribution. Realize we're in a multimodal world.
Always a treat to get some time with you. I always enjoy our conversations. Mohamed El-Erian, Allianz Chief Economic Advisor. We'll talk to you soon. Thanks for joining us here at Invest. We appreciate it.
Thank you.
I want to talk about the Fed because we know that the Fed composition changes every year in terms of the voting members of the FOMC, but we get an additional change this May when we're going to get a new Fed chair. We'll probably find that out exactly who it is in the coming weeks, but what should we expect there?
Yeah, so obviously all eyes are on the Kevin still. The president said he hasn't changed his mind, so that's good news for Kevin Hassett. I think the market is sending a pretty clear message that they do not want Kevin Hassett to join the Fed. But that conversation is going to stay under pressure because also, as the president said, he is thinking about ways to continue trying to fire Jay Powell early before May. And certainly to get him off the board before 2028. And I think the Lisa Cook case, as we hear about that early next month, will be really indicative of how aggressive the president feels like he needs to be on the Fed. I think Jay Powell is a useful foil for the president. He can blame all the concerns about the economy on the Federal Reserve, and Too Slow Powell and all those nicknames is really helpful to the White House as they're dealing with inflation and saying, prices would be lower if we had a different Fed chair, or, everybody needs to help the housing market. We need a new Fed chair. It's a constructive use of his time to blame it on Jay Powell. I don't think that we'll see him completely relitigate trying to fire Powell. The market did not respond well to that last year or this year, but they're not going to respond to it well next year either. But it will definitely be a continued theme, and hopefully we'll get a nominee in the next couple of weeks.
Hopefully. Henrietta, it has been enlightening. Thank you so much for joining us here.
Thanks for having me. Happy New Year.
Happy New Year.
Terry, thanks so much for joining us. Let's start out with the possibility of a Big Beautiful Bill 2.0, which you mentioned is also certainly this could happen. So why do you think so, and what could be included in that bill?
Good morning, Ines. A couple of things. The Big Beautiful Bill 2.0, I think, is almost certain to happen for two reasons. One is that there's some unfinished business policy-wise from 1.0, so they'll want to take that up. And the second catalyst here, I think, frankly, is political. Trump is going to throw everything in the kitchen sink at the affordability crisis and the affordability problem. And neither he nor anybody in Congress at the end of the day is going to want to look like they left anything undone to address that. So, legislative action, legislative busyness helps that on a practical level. Now, as to what's in it, Senate Budget Chair Lindsey Graham talks about it as being a little bit more of everything, a little more on entitlement reform outside of Social Security, a little more on Medicaid. So this is going to be, I think, another opportunity for Congress to take another swing at Obamacare subsidies, a little more on tax, likely including expensing, a little more money for the military. Graham's also talked about something relating to a minimum tariff, and maybe including the tariff rebates that Trump talks about. And finally, I would bet there'd be a lot more on manufacturing incentives. One of the big priorities here for this administration is to onshore as much manufacturing as possible, particularly for things that relate to military. So they're going to want to do that too. So that's my rundown.
Terry, speaking of tariffs, Polymarket trades show only 28% believe that President Trump's tariffs will be upheld. So why are you confident that the Supreme Court will not strike down the current tariff regime?
Well, a couple of reasons. First, I say this about prediction markets. You're not looking at a gallery of solely expert opinion. You're looking, if you're sitting in a casino playing a game, you're basically the prediction markets are the people kibitzing behind you about how you're going to do and whether you're going to get it done or not. So it's a little more colloquial than authoritative. Beyond that, though, I think people look at, I'm very much non-consensus on the tariffs. They survive for two reasons. One is they survive outside the court case because the president's got an awful lot of other sort of tariff authority to deal with. So should he be told he can't use this particular authority, he'll use the others. Secondly, on this, I think what people don't understand about the court case is that the Supreme Court does not question that the president has wide-ranging ability to deal with international crises of all kinds, including economic crises. So the question for the court really comes down to whether the statute permits or forbids him to use tariffs. That's a pretty small question. And the court could rule that he's got broad authority that includes the ability to use tariffs, even though it wasn't enumerated in the law. It could also conclude reasonably, I think, that he doesn't. But if he doesn't, the Congress will have the opportunity to cure that by making that explicit. And again, Big Beautiful Bill 2.0 could very well include that kind of fix.
Let's just switch over to AI, data centers, manufacturing, onshoring. Yeah. All of that requires vast amounts of resources. So do you see the Trump administration's policy in South America as a move towards securing more resources and also keeping them away from China?
Yeah, I think that question is very well put. I think people look, a lot of people in markets look less broadly than they should about what's going on with South America, for example. You got a situation in South America where Trump has announced as of last month in the national security strategy what he calls the Trump corollary to the Monroe Doctrine, which 200 years ago, President Monroe basically announced that we were going to police our own hemisphere, including South America. And China right now is the biggest trading partner and striving to be the biggest influencer in South America. And I think everything you see in South America, from propping up Argentina to dealing with Colombian drugs to the current Venezuelan situation and more, is designed to try to take back hemispheric supremacy. That includes resources. Sure, there's an awful lot of opportunity there, whether it be for oil or other sorts of minerals, and the administration wants to make deals on that front as well. But I look at it fundamentally and suggest markets look at it fundamentally as a geopolitical matter that has economic consequences.
And switching over to regulation for crypto, because it's been such a theme this year. We had the Genius Act with stable coins. The crypto community is really looking for the Clarity Act to pass next year. What are your thoughts on the chances of that going through?
I have the chances of serious crypto legislation going through as slim and none, frankly. I've been telling markets for years that the idea that the Trump administration was going to come in on the heels of the scandals of the past few years and that slim margins in the Republican Congress were going to drive through major crypto legislation was a fantasy. And looking beyond all that, the exception of the stablecoin legislation, there is no coherence around policy at all. You need bipartisanship, but you also need policy coherence in order to figure out where things are going. There isn't any right now. There isn't likely to be. The footnote to this too is, frankly, there's a lot of disquiet in Washington, some above the surface, some below, about the Trump family involvement in crypto. I don't make any case for it one way or the other. My point being that Congress people, particularly in election years, tend to shy away from anything that looks controversial. And crypto now has always been controversial, but now it looks a little bit more controversial than it had been, thanks to all that. They don't want any part of that.
And lastly, what if there's a government shutdown in January? What would this do to policy making in next year?
Well, my view has been that the market should look for a shutdown at the end of January. Today, I don't think it's likely, but I'd give it about 40-60, and it could very easily tip over. I was about the only person out here telling people in July and August that I thought a shutdown in the fall, this past fall, was likely, and the same kind of environment exists today. If you have a situation where by the end of January, which looks increasingly likely, where the Obamacare subsidy issue and Obamacare spending more broadly isn't solved, it is not a given that the 8 Democratic senators who voted to end the shutdown will do so again. And if they don't do that, then we're back in the shutdown zone, and we're back in the world where policy consequences, including year-long defense spending, that sort of thing, and data for markets, not so incidentally, are in peril again.
Let's get back to CPI because we have more inflation data coming out tomorrow with that consumer price index, giving us a key piece of economic data ahead of the Fed's interest rate decision next week. For more on the state of the U.S. economy, not just for the rest of the year, but beyond, let's welcome in Torsten Slok, chief economist at Apollo Global Management. And of course, we should mention Apollo is also the parent company of Yahoo Finance. Torsten, always great to see you. Let's focus in the near term, and then we'll get to the longer term. Let's talk about CPI tomorrow, what you're expecting, and kind of what the implications are then for the Fed.
Yeah, the big picture here is that CPI peaked in 2022 at 9%. Now it's come down to 3%. And the Fed's target for where we're going is 2%. So we got from 9 to 3. And the big question, of course, is 3 enough, or do we need to get further down? The Fed has obviously started cutting rates. And as you just talked about, I agree that they will cut rates again next week. But the big question is with the CPI tomorrow that, well, there is some evidence in the last few months that inflation is beginning to move up again. And that's throwing a bit of a wrench into the narrative from the Fed, because that might imply that we're not going to get as many Fed cuts over the next 12 months as the Fed has been saying. So the short version of what's going on, in my view, is that inflation has come down a lot, but it's not quite there yet. And now the question is what the Fed needs to do, in particular with the economy still strong and some risk to the upside to inflation from tariffs, some risk to the upside to inflation from restrictions on immigration, and potentially also some upside risk coming from lower taxes.
As you said, Torsten, inflation has moderated, but as you point out, it's not where Jay Powell wants it to be. Can you try and model out, Torsten, when you do think inflation gets back to that 2% target and importantly stays there?
Yeah, that's very important, Josh, because the key question then becomes, well, what does the Fed need to do today to get inflation back to 2%? And our strong opinion at the moment is that they need to keep interest rates higher for longer. In other words, in bond markets, we will see front-end yields be more elevated than what markets are pricing as we speak. In other words, we only anticipate that they will cut next week, but then we also anticipate that they will skip in January, because now they need interest rates to stay higher in order to slow the economy down enough to begin to get inflation down to 2%. So that means that for private credit, for fixed income more broadly, yield levels will still remain elevated for at least the next several quarters in our view.
I guess the question is, and you basically raised this question in your outlook for 2025, is what is the Fed's effectiveness at this point? And one of the ways you illustrate that is simply by looking at a chart of GDP growth since the Fed began raising rates, and which in theory should have then slowed GDP and slowed inflation much closer to its target. And yet GDP has been stubbornly good, right? So I guess the question is, what good is the Fed at this point? How effective are they?
Absolutely. Look at the chart that you're showing here. GDP growth has been remarkably resilient since the Fed began to raise interest rates in March of 2022. In other words, this chart here is the reason why the S&P 500 has done so well. This chart is the reason why credit spreads continue to trade very tight, because the economy continues to do remarkably well. Why is the economy doing so well? Well, first of all, because during the pandemic, consumers and firms locked in low interest rates. Remember, in the US, 95% of mortgages are 30-year fixed rate. That means that when the Fed raises rates, it does not have much impact on homeowners. That's a dramatic difference, for example, to the UK, where when the Bank of England raises interest rates, it immediately has an impact on mortgage payments for homeowners. Likewise, in the US, we also have had a very strong data center boom. We had a strong AI boom. And we also in the US have still, even before we know what Trump will do, still have strong effects of the CHIPS Act, the Inflation Reduction Act, and the Infrastructure Act. And all these three effects have been very strong tailwinds that are the key reasons, to your point, Julie, of why the economy continues to do so well, and therefore why the Fed does not need to cut interest rates as much as they thought just 6 months ago.
When you look ahead, Torsten, you see this U.S. economy that's resilient, it's chugging along. What, when you talk to your clients, do you outline as sort of downside risks for that?
Yeah, this becomes very important because I do think that tomorrow's number that we're getting on the CPI is very important, because if inflation tomorrow is a little bit higher, and the consensus is actually expecting both on core and on headline a little bit higher number, that runs the major risk, of course, that we in 2025 bring back the environment we had in 2022. Remember, as we all know, in 2022, interest rates went up and stocks went down. That meant that the 60-40 portfolio in 2022 underperformed dramatically. And the fear that one can have going into 2025 is that if inflation does go up again, and therefore interest rates begin to go up again, then of course the stock market will begin to sell off. And again, in that case, the 60-40 portfolio will not be doing very well. So we really mainly worry about whether inflation tomorrow will continue to show this steady uptrend that we've seen in the last 2 months.
One thing we've been talking about monetary policy, we haven't really talked about fiscal policy, Torsten, and obviously there's a lot to consider, from tariffs to regulation to tax cuts. What is sort of your base case? And on that last point, when it comes to tax cuts, do you think we will see not only an extension, but more tax cuts, deeper tax cuts coming in the next year?
No, that's right, Julian. This is really where we don't really know much at this stage, but we do know that the Trump tax cuts will run out, meaning the tax cuts that got implemented in 2017 will run out on the 31st of December in 2025. Remember, as we all know, in 2017, you saw corporate taxes come down from 36 to 21%. You saw household taxes come down from 39.6 to 37%. So both household taxes were lowered and corporate taxes were lowered. So the result of that is that something needs to be done on continuing the Trump tax cuts, or at least some version, unless we will get some significant slowdown in the economy. Other things, of course, that Trump has talked about on the campaign trail, he's talked about lowering corporate taxes for domestic manufacturers to 15%. So that's giving an additional tax cut to companies that produce domestically. So if that does come around, that will also be a tailwind to economic growth, which will add to the chart that we just looked at, namely GDP growth already being strong, and therefore add a tailwind to the economic outlook.
So when we talk about Trump, Torsten, we talk taxes and deregulation. Of course, we also have to talk about tariffs, which is difficult, I would imagine, for an economist like you to model, because you're trying to figure out how much, what actually will be the policy. How much is this is just negotiating tactic, negotiating strategy. But when your clients ask you, Torsten, about potential tariffs and its impact on the economy, what do you tell them?
Yeah, no, this is very important also, Josh, because what we do know, at least, of the three things that Trump has talked about, namely talked about not only tariffs, but also restrictions on immigration, and also on lower tax rates for corporate manufacturers. All these three effects happen to have a lifting effect on inflation. So the conclusion and the issue, at least in terms of how one can look at what might be coming next year, is that if the main three areas where new policies might be coming is lower taxes, more tariffs, restrictions on immigration, it happens to be the case that the textbook would be predicting that all those things should be putting upward pressure on inflation. So if we already have, as we started out talking about, inflation still only at 3, not quite down at 2, and showing an uptrend in the last few months, then adding to that the risk that there might be some more modest upside pressure to inflation, that does again bring you to the conclusion that interest rates will stay higher for longer. As you can see in the chart you are showing here, we have seen in the white line inflation tick up a little bit more recently, and that is exactly the worry that is why the Fed probably will keep interest rates more elevated than, again, what the market is currently expecting. And that, again, means bonds and fixed income giving yields that are higher than what people are currently anticipating.
And Torsten, in addition to fiscal, in addition to monetary, one of the long-term trends that we've talked about all year has been the rise of AI. And I thought the point that you made in your note was quite interesting on this front, which is that you think that the U.S. is pretty far ahead of most developed markets when it comes to data center build-out and AI. Are we going to retain that lead, and how important is that then for our economic growth?
Yeah, this is really important. Have a look at this chart you are showing exactly here, that at the moment there is more data centers in the US than all other countries in the world combined. It tells you that there is a significant need for capital for long-term investments. Of course, in AI and data centers is one very obvious place, but across the board in energy transition, we also have the Inflation Reduction Act, we have the CHIPS Act. We might now have more, again, on the manufacturing front. Just today, Trump announced that anyone who invests more than $1 billion in the US, of course, will be very welcome. So there are very significant tailwinds to long-term capital projects, and therefore financing from companies to long-term projects over the next 20, 30 years to transform the US economy, not only on the AI and data center front, but also on the energy transition. That is what we and others have called, of course, and talked about as the industrial renaissance that needs financing and needs capital. And that requires long-term financing, long-term capital to get exactly more data centers and more investment in the US.
Torsten, a final question here. If I was a viewer and I was listening, and I think, you know what, Torsten makes a lot of sense. I think we're higher for longer. What are some of the implications for the stock market, Torsten? You know, because if I believe that we're going to be higher for longer, do I avoid small caps, for example, Torsten?
Yeah, exactly. So let's add up all this to what it means for the stock market. So importantly, the challenge for the S&P 500 at the moment is that it's so highly concentrated. Roughly a third of the index is made up of the top 10 companies in the S&P 500. We all know how important Nvidia is and how critical it has been for returns this year. The problem for the small caps is that 40% of the Russell 2000 have no earnings. So that means that if rates are higher for longer, that means that small cap companies will continue to struggle with earnings and therefore not being able to service the debt servicing costs. So that brings you to the conclusion that if you have to be in public equities, the mid cap or S&P 400 still continues to look like the most interesting place to be, simply because the risk is too high when it comes to the large cap companies, because it's so focused on a handful of names. And for the small cap companies, again, in my view, the bubble in small cap is still growing and continues to be significant when you take into account the fact that, again, 40% of companies in the Russell 2000 have no earnings. So in public markets, sticking with the mid-cap companies is perhaps the best strategy. But when it comes to general asset allocation, rates higher for longer, of course, means that you could be cutting coupons in fixed income that can still, including in private credit, still give you some very interesting yields. So let me summarize that by saying I love the adrenaline rush from looking at Nvidia and looking at a Wednesday afternoon where they deliver on earnings, will they not deliver on earnings. But why don't I sleep well at night and get some nice cash flows that are treating, of course, investors very well, given where yields are and given rates are going to be higher for longer.
So you can have your adrenaline rush and still sleep at night. I like it, Torsten. I like it. All right, It's great to see you. Thank you so much for joining us.
Thank you.
Hello and welcome to Berkshire Beyond Buffett. I'm Jared Blickery, and for the next half hour, we're taking you inside the leadership transition at Berkshire Hathaway. The Oracle of Omaha, Warren Buffett, is stepping away from the CEO role at the start of the year, and Buffett began his transformation of Berkshire into the conglomerate we know today way back in 1965. And over the decades, he has added dozens of businesses to the portfolio, including brands you know, like Geico, Dairy Queen, Brooks Running, and Benjamin Moore. We're going to hear from shareholders who will provide insight and analysis on what to expect when incoming CEO Greg Abel takes the reins. So let's dive right in. Before you hear stories from investors, I broke down the key business and growth drivers for Berkshire in an earlier edition of Stocks in Translation. In just a few weeks, Warren Buffett will no longer be CEO of Berkshire Hathaway, a job he's held for 6 decades. His number 2, Greg Abel, will take the reins. But this isn't a retirement story. Buffett is still chairman of the board. It is, however, a succession moment for one of the most unusual, most successful companies in history. And for anyone who's ever looked at this stock and wondered what it's all about, on today's Stocks in Translation, we are breaking down Berkshire basics. Berkshire is not a normal mega cap. It's a holding company with 3 distinct engines. The first is its operating business. These are companies that Berkshire owns outright. They throw off real cash flow year after year, good times and bad, a Buffett staple. Engine number 2 is a Berkshire stock portfolio, which probably gets the most attention. It holds big stakes in many public companies, with Apple as the largest. And despite Warren saying that his favorite holding period is forever, there's a decent amount of trading churn in the portfolio from quarter to quarter, and Buffett has slowly given up control over its stock-picking decisions since 2010. Engine number 3, and this is the quirky one, is Berkshire's insurance business, including what's called the float. Insurance companies collect money from premiums first and they pay claims later. And that in-between float money can be invested. That's a structural advantage that many companies do not have, and it helps explain why Berkshire can afford to be patient when others cannot. Now, let's check out a Berkshire stock chart. And here we're comparing Berkshire to the S&P 500 over the last 5 years, which includes several market cycles. And you can see Berkshire's up 120% versus 80% for America's benchmark index. And you can credit the higher return to Berkshire's ability to hold up better during both the 22 bear market and during the post-Liberation Day sell-off earlier this year. And while the rest of the market started soaring in mid-April at the right of the chart, Berkshire has lagged a bit, and many credit the overhang of Buffett's departure, which only means that 2026 could be a defining year for the conglomerate. Now let's take a look inside at the many businesses that make up Berkshire's own mini real economy. Starting with Geico, their insurance business provides a real-time risk on risk pricing across the world. And through its BNSF Railway, it gauges freight, shipping, and industrial demand. And Berkshire Hathaway Energy, not surprisingly, gives a read on the energy markets, including business investment spending and the power grid. In manufacturing, it has Precision Castparts, which provides a window into aerospace and industrial orders and demand. And Berkshire has a bunch of household brands, from Dairy Queen to Fruit of the Loom to Brooks Running Shoes. Along with its McLean Supply Chain Services business, it has many eyes on the health of the consumer. Finally, from services like flight safety, it gets business travel and training insights. So Berkshire doesn't just track the economy, it lives inside it. And then it brings to us that next question: what happens next? As 2026 kicks off with Abel at the helm, we're going to want to pay attention to Berkshire's capital deployment, as this is always the game. When do they move? When do they sit on their hands? Because investors have been wondering for the last decade when Berkshire will shell out cash for a big buyout. Will Greg Abel be just as willing to wait for the fat pitch? Meanwhile, that cash pile sits north of $300 billion, and it is growing. Next up is stock buybacks. Buffett has always been clear. He's only going to buy a stock, including his own, when the price is attractive or wonderful. So watch that closely. Then there's insurance discipline, the quiet engine. If that stays tight, the whole machine stays healthy. And finally, watch the communication tone and listen to that. We might miss the marathon Q&A sessions and watching Buffett hold court for hours like a folksy oracle behind a can of Coca-Cola, but clarity is what matters. And now a closer look at some of the key decisions Warren Buffett made to make Berkshire Hathaway what we know today. Portfolio Wealth Advisors President and CIO Lee Munson explained how the insurance business, especially Geico, were crucial in the company's growth.
It's the total engine behind Berkshire Hathaway. Now, a lot of us like the old Warren Buffett grandpa with his sweater, telling stories by the fireplace about See's Candy. And most people have heard about he bought See's Candy and he used all the cash flow from See's Candy to buy other things. Not unlike what Philip Morris did during the last century of taking all the money they made from cigarettes and buying cheese companies, right? But more profoundly, it was always really about Geico. I think that we talk about the See's Candy story because it's easier to understand, but he bought Geico and then basically he made all of his policyholders investors, because what he got with the float from Geico, you take money in for insurance, and then what you don't pay out in claims, you can invest. Well, he was one of the greatest investors of all time, so he had a source of capital that had very, very low cost. It was liquidity that, he didn't have a liquidity problem with investors saying, hey, we need to nab this cash. So his ability to look forward into the future and know how much cash flow he was going to get made it a lot easier to take over companies and to buy things and have a schedule. Nobody had done this up until Buffett.
Well, as you say, there's this sort of image of him as this sort of grandfatherly figure, but that's also calculated in some ways. It can be authentic and calculated at the same time, I suppose. But the way that he communicated with investors, in addition to the shareholders meeting, was through his annual shareholder letter. How did he use that as a tool?
He used it for social engineering. He wanted to engineer his client base. He wanted to make sure that he was selling long-term value. He wanted to be sure that he was the original Bitcoin tout, right? He wanted to make sure that people bought Berkshire and held it forever and never sell your Berkshire. And so not only was the structure designed that way, not only did he have permanent capital, but through his letters, he would talk about moving beyond volatility and not having to think about volatility, talking about a margin of safety. Everything he bought was, a value. He was buying dollars for 50 cents. And on top of that, he was a salesman, right? He talked about underperforming during bubbles and that compounding was really the way. And I think he convinced people that the moats were really about competition. I think that was one of his greatest magic tricks, because really what he invested in through the most part of his life were monopolies and places that didn't have competition and were not based necessarily on the innovation of America, but was based on companies like an Apple computer that just had all the cards. And I think he made people comfortable with that type of, monopolistic oligopoly inside of America.
Lee, how many of these things do you think will continue at a post-Buffett Berkshire Hathaway, right? I mean, obviously the structures, which were sort of original to Berkshire and Geico, they're already in place. But, the letter and sort of how do you think that all evolves?
Well, I think it's going to stop, right? I always look at book value versus the price. We've had times where the net asset value of Berkshire has, gone negative. Here's what the thing is. Buffett's legacy is the architecture of Berkshire Hathaway. His legacy is how he did this. Greg Abel, I'm sure, he's a brilliant guy. He knows how to operate. He's been doing it for years. This transition has been signaled. It's nothing new. Everybody on Wall Street knows. But we're not going to have the magic duo of Warren Buffett and Charlie Munger telling these stories and keeping investors focused, solid. And also, those Berkshire Hathaway shareholder meetings were also sales productions to get people to buy the products that Berkshire had bought within its holding company. So do I think that the operations and the culture will stay the same? Absolutely. But how are we going to get that next generation of disciples of Buffett who just buy that stock and never, ever sell it? That remains to be seen.
Next, hear directly from two Berkshire shareholders on what they won and expect to see from Greg Abel, Warren Buffett's chosen successor. Greg Abel is taking over for Warren Buffett in the new year. But with new leadership, many come new moves, even though Abel has been at the company for 25 years. Jonathan Boyer, president of Boyer Research, sat down with Yahoo Finance's Josh Lipton and spoke about what differences he expects to see.
Warren Buffett is known to be a hands-off manager. He has a decentralized structure. Many businesses sold themselves to him because they wanted the autonomy to do whatever they want. And that's obviously worked out extremely well for Berkshire over time. However, by having this decentralized structure and not having management oversight, there's probably a lot of fat to cut. There's probably divisions that could be consolidated. There's many things that they could do to enhance profitability that Buffett just hasn't wanted to do. Buffett is the greatest capital allocator and the greatest investor of all time. He's not known as the best manager of all time. Greg Abel might be able to do things that he wouldn't or couldn't do.
What could Greg Abel do with that giant cash hoard? What would you like to see him do with it as a shareholder? As a shareholder, I mean, the amount of cash they have is excessive. Since Buffett is going to be gone, he's the greatest stock picker of all time, I'd like them to de-emphasize the actual stock picking. I'd like them to start paying a dividend. Hopefully over time they do that. That might not happen right away, but it would be a nice thing. I would like them also to buy back shares. It'd be great if they could make acquisitions, if they could find them. Unfortunately, a company that size, it's hard to find an acquisition that's cheap that also moves the needle. What do you think, Jonathan, Greg Abel can do to try and, as quickly as possible, sort of earn the street's trust? Like if he came to you, Jonathan, and he was asking you for guidance on that topic, what would you tell him?
Well, I would love for him to give me a call. But one thing I would like him to do is, he owns a fair amount of Berkshire stock, but all of that was bought when obviously Buffett ran it. To me, a great sign for Wall Street would be for him to buy an extremely large amount of Berkshire stock personally and really put his money where his mouth is.
As a shareholder, how much leash you want to give Greg Abel to prove his merit here? I mean, do you give him what's the time frame, Jonathan, for you? Is it 1 year, 3? Is it 5?
Listen, we're long-term patient investors. Buffett has created a business that can basically run itself. You want him to be a great steward of these assets. You want him to go in and manage them better. And I think after a 3 or 5 year period, you would be able to see, is he doing a good job or not? And I don't think you can judge anyone on a 1 year period.
You say here, the days of extraordinary returns are behind Berkshire. So as a shareholder, what would be a more realistic return profile, do you think?
I mean, I think over a 3, 5, 10 year period, I think it should be able to beat the S&P 500. I think, certainly the returns have been massive historically. I mean, it'd be impossible, the law of large numbers comes into play. But I think it could be a very good long-term core holding for people. That's a good diversification away from the tech-heavy, S&P 500 and NASDAQ.
What have you been doing with your own position here, Jonathan? Have you been holding steady, trimming, buying?
We've basically been holding steady. If for whatever reason shares dip because people are worried that Buffett is leaving, I would view that as an opportunity to buy more.
What are the negatives, if you can try and quantify them or qualify them, of Buffett leaving? He is the Oracle. What do you think can't be replaced?
Him. I mean, he is the secret sauce. People love to do deals with Warren Buffett. He got the great deals during the financial crisis. But over the last couple of years, with the exception of Allegheny, most of the deals, they haven't done much, and the deals that they've done have not been good, which is partially a result of their size. And also that PE is much more involved than ever before. So I think he will obviously be missed. I wish he could stay CEO for another 10 or 15 years, but he certainly earned his retirement.
In your opinion, Jonathan, I'll get you out of here on this, greatest value investor of all time?
Absolutely, hands down.
How so? Why so? Explain that for us.
Because he's done this for a period starting in, I believe, the 50s and 60s up until today. I mean, the longevity that he has, the discipline that he has. He did it as a hedge fund manager. He's done it by investing in companies, buying back his own shares. He's just a fantastic capital allocator.
Meantime, Julie Hyman spoke with long-term Berkshire Hathaway holder Bill Stone of Glenview Trust about what matters most in this transition.
Don't try and be Warren Buffett, following the greatest of all time, and certainly, throw Charlie Munger in the greatest duo of all time. trying to beat them at their game, so to speak, is probably not the right thing. It's also a different company that it was when it started. It was a failing textile company, and they turned it into a massive, successful conglomerate. We now have a massive, successful conglomerate. So I think it leaves you with, I'm just going to essentially take right from what Warren Buffett has laid out, which is how he would really judge management if he was on the outside, which is watch for them to grow operating earnings over time. Secondly, decrease share count. And he's got a couple caveats on that. You want to do it when it's the right time to do it. Buy shares when it's below intrinsic value, so you're not diluting shareholder wealth. Also, if you buy those shares in, you're growing operating earnings per share at an even faster rate. And last but not least is look out for big opportunities. And that is really two things about that. One is Berkshire Hathaway is so big now that you have to find bigger opportunities to move the needle. Two is they have the balance sheet and $380 billion in cash. So they're one of the few, or, amongst the few that, especially when times are tough, can actually take advantage of those. And I think if you looked back at Buffett and Munger's track record, a few very good decisions was the majority of the great performance. Now, I will say they avoided making very many disastrous decisions, certainly made no large scale disastrous decisions. So that's also an important part of it.
Well, and I guess that's then my next question about Greg Abel is it a matter of more of avoiding mistakes and sort of steering the ship than it is sort of finding those big investments and big bets to make?
Yeah, I mean, I think you're probably right that it's tilted a little bit toward the, maybe I'd say toward managing it more, managing the conglomerate more, certainly more than Buffett and Munger did, which was frankly very little because they didn't enjoy doing that. And then secondly, you really can't force the opportunities. You have to, find them along the way. That certainly is a major part of it, to grow and to find opportunities. But you're probably right that some things have maybe moved more to the forefront.
You were a long time sort of student of Buffett and Berkshire shareholder. And I wonder kind of how his sort of lessons have filtered down into your investing.
Yeah, I think so. Personally, so I was at Salomon Brothers when he took over and saved the firm. So it meant a lot to me. So I think one thing I always think of, my family didn't come from the business, but so I kind of got exposed to it through Gordon Gekko and Liar's Poker by Michael Lewis. And I would say, one of the things is you don't have to be like, I'll say those villains or whatever. Shouldn't maybe say that about my coworkers at Salomon Brothers, but not all of them. But at least I think you can act a bit differently. I think the next part is just really quite amazing that he viewed it as a duty to gather more wealth, but really just in the end to give it all away to society. And I think that's some really, touching parts of it. When you go to the more investment side, I think he's been amazing in getting Benjamin Graham's ideas out there, where you just say stocks aren't pieces of paper to us or to me. They are really looking at a company, and that's how I think about them. And, that was a big part of my change to thinking of it that way. And lastly is kind of the thing we all, as value investors, think about is the margin of safety. Can I buy this with enough margin of safety that if I made a mistake in my analysis, I don't have a catastrophe on my hands? That's a big part of it. And it really gets to my, or things he said, which I certainly believe, which is all investing is value investing. So while we in the industry kind of break things between value and growth, the fact is what you pay for something, whether it's a company that's growing earnings fast or not, matters.
Stick around for more perspective on Berkshire beyond Buffett. If you're thinking about investing in Berkshire Hathaway after Buffett steps back, Josh Lipton got a closer look at the bull and bear case on investing in the company with Berkshire shareholder Mel Casey, FBB Capital Partners Senior Portfolio Manager.
I think if you look at the at Berkshire Hathaway, it's primarily an insurance business, but really it's large enough that it's a conglomerate. It's involved in many different places. So there's kind of a cyclicality and a counter-cyclicality within that portfolio. So you could almost even think of it as an alternative to a lower risk alternative to owning the broader market. And you're going to find some of the businesses like the insurance are counter-cyclical, but then other parts like the railroad are going to be more sensitive to the economy.
How would you characterize valuation here, Mel?
So in a year of pretty high valuations for U.S. large cap stocks, I think Berkshire's still pretty reasonably valued. If you look at the estimates for next year, it looks a little closer to the overall market on a price to earnings ratio. They prefer book value. I think that's fair because there's so many different businesses here. On book value, it's around about 1.5 times. That's historically a little bit higher than it had been before. Also, shareholders who pay attention know that Warren Buffett advocates repurchasing stock at 1.2. So it's a little bit above his level. But when you look at some of the other companies that make up the market, it's certainly reasonable, if a little bit higher than it has been in recent past.
And Mel, post Buffett, how does the bench look at Berkshire? Would you say that falls into the bullish column?
Cautiously bullish. We've had a couple of changes in that bench recently. That was a little surprising, I think, to investors. Todd Combs' departure in particular. Been there a couple of decades. You would have thought that this was the exact moment that he was waiting for, but there's been a change there, and that's fine. The bench is still deep. Greg and Ajay, these are very, very seasoned folk. It's reasonable to think that a lot of the values that have brought the company to this point will continue to be in place. We wouldn't expect major changes. Wouldn't be holding out for a dividend, or I wouldn't be expecting major swings and aggressive allocations of capital. But there's definitely a culture in place that I think the bench will probably continue to keep in there.
So we walked through the bull case. Let's talk about the bear case, Mel. Let's outline that one. One concern you have, the risk of losing the Buffett premium. Explain that.
Yeah, there's no question. There's no investor out there. There's no CEO or investor spoken about as much, quoted as often. There's so many books out there. I mean, there's an iconic investor. We lost Charlie not that long ago, Charlie Munger. Warren Buffett is stepping down. And so, and anyone who's been to the annual event in Omaha will testify that it feels different. It's not a regular company meeting. So is there some premium there? You could argue that some of that's been coming out over the course of the year. It's performed about 2/3 of the overall market performance this year. Some of that is related to some of the underlying business trends, which we can get into in a second. But there's definitely a caution out there that some of the core investors are investors in Buffett rather than in the actual fundamentals of the company itself.
Here are 5 things that I have learned specifically from the Oracle of Omaha the past 25 years of my waking life. First, you can be a ruthless business person, but you don't have to be a total jerk in the process. Buffett is viewed as having done business in a right and honest way. Good to see. 2, saying no is a powerful tool in life. You have never seen Buffett do 30 TV interviews a year, even though we all want him to. He has been able to channel all his focus on building a successful Berkshire empire. 3, it's great to be the go-to person. In times of crisis, Buffett has been the person to visit for a loan or great advice. In turn, that has allowed Buffett to make great deals for Berkshire shareholders. 4, having an amazing business partner is often critical to success. Berkshire and Buffett wouldn't be where it is today without the guidance of longtime partner Charlie Munger, who died in 2023. And lastly, know when to strike. Buffett has scored favorable deals and investments because he knew when the time was right to strike. Is his way of investing over? Given where the market and what drives the market here, it's likely to be AI for the next day. Can you still be a fan of how Warren Buffett has invested?
Absolutely. I think his message is really consistency over time and compounding returns, the power of kind of just sticking with it and sticking with positions. And I think it was either a Buffett or a Munger aphorism at one of the annual meetings that you only have to be right in stocks like 51% of the time, and you look like a genius. And so you don't have to be, 9 out of 10. And people can complain and say that he didn't catch the tech wave. But so I think the lesson for today's investors is really just having a long-term view, whether it's about a Carvana or an Open Door. It's sort of like some stock that you think is misunderstood and sticking with it through the drawdowns and the volatility. He proved that compounding over decades is how you really become wealthy, not just sort of trading in and out of stocks.
Michael, how has Warren Buffett influenced what you do?
No, I mean, the man has a 75-year track record of incredible success. He knew at 20 years old what it took me 25 years to figure out in this business. And I think that's incredibly impressive. I definitely teach his lessons to my children. And, I try to tell them you should read everything he said, watch the annual meetings. Like I said, it's incredible to have a 75-year track record of success. And I don't think anyone has ever done it better and will do it better ever again.
Stocks close lower. Yahoo Finance's master of the Wi-Fi Interactive, Ines Ferre, is standing by with the latest. Ines, what are you watching to close 2025?
Jared, I'm watching those double-digit percentage gains in all three major averages for 2025, even though today we saw the major averages lower. But look, for the year, I'm pulling up the year-to-date chart so you can see the Dow up almost 13% year-to-date, the NASDAQ Composite up 20% year-to-date, and the S&P 500 up more than 16% year-to-date. Do want to mention the small caps also up more than 11%. If we take a look under the hood, it's the tech trade that was really powering the markets this year. Take a look at the technology stocks up 23%, communication services up 21%, industrials up 17% as well. And then looking at the NASDAQ 100, you can see the green on the Mag 7 stocks with Alphabet that has led the gains year to date, up 65% for 2025, and also Nvidia up nearly 39% for 2025. You've got Tesla that's up double-digit percentage gains, 11% for the year, and Microsoft as well. Also, the semiconductors, because we mentioned Nvidia, but these were really on fire this year as the AI trade has boomed the markets higher. And so you're looking at Broadcom up 50% for the year, AMD, Micron up 230% for 2025. We did see crypto this year in the red, down 7% for the year after it tumbled from all-time highs in October. And then looking at ETH, that down 11%. And over on commodities, we have seen a lot of action in the commodities space, with crude oil down for the year, down more than 21%. Brent crude down 20% for 2025. The ones that really had a stellar year were gold, up 62% for the year, and silver. Despite the volatility that we saw this week, silver still up 137% for 2025, Jared.